Mic check.
Check two.
Mic check.
Check two.
Mic check.
All right, let's bring this proceeding to order and go on the record. Today is March 5th, 2025. The time is 9:05 a.m. The Commission has set this time for an evidentiary hearing in the case captioned as "In the matter of Missouri American Water Company's request for authority to implement a general rate increase for water and sewer service provided in Missouri service areas." It is the Commission file number WR-2024-0320. My name is Ken Sire. I am the regulatory law judge presiding over this hearing. The hearing is taking place in the Public Service Commission hearing room, room 310 of the Governor Office Building in Jefferson City, Missouri. However, there are counsel and some witnesses who will be participating over the internet via Cisco WebEx. At this time, let's have counsel for the parties make their entries of appearance, beginning with Missouri American Water Company.
Thank you, Judge. Dean Cooper from the law firm of Brydon, Swearingen, England, PC, appearing for Missouri American Water Company. Also appearing for Missouri American will be Rachel Niemeyer of Missouri American Water Company. And in addition, you're going to hear from both Hillary Close and Nicholas Kyle of the Indiana law firm of Barnes and Thornburg. These attorneys have helped with preparation of this case, have been admitted to practice in Missouri for purposes of this case, and will assist in the hearing. We would note that they are experienced and knowledgeable regulatory attorneys whose work includes the representation of Indiana American Water Company, and we believe their participation will be helpful in presenting this case to the Commission. And while I'm speaking about that, in fact, when we get to the first issue today, the cost of money issue, Ms. Close will be handling that for the company, Judge.
All right.
And the court reporter has the addresses.
Okay. All right, for the staff.
Thank you, Judge. Travis Pringle appearing on behalf of staff, and my contact information is with the court reporter.
Thank you. For the Office of the Public Counsel.
Thank you, Your Honor. John Kleiser on behalf of the Missouri Office of the Public Counsel. My contact information is with the court reporter.
For Consumers Counsel of Missouri.
Yes, good morning. John B. Kaufman, appearing on behalf of the Consumers Council of Missouri. I'm also appearing on behalf of AARP.
Okay, thank you. And then for the City of Riverside?
Joe Bednar from the law firm Spencer Fain. My contact information has been provided to the court reporter.
Thank you. For the Empire District Electric Company, doing business as Liberty. I thought she might be online this morning. Okay. For Midwest Energy Consumers Group.
Good morning, Your Honor. Tim Opitz on behalf of MECG.
Okay. And then for Missouri Industrial Energy Consumers. She may not be on yet. Okay. And Mr. Fisher, I know you're on. I think we heard you earlier.
Yes, Judge, on behalf of the... Excuse.
Go ahead, Mr. Fisher.
Thank you, Judge. On behalf of the Public Water Supply Districts number 1 and 2 of Andrew County, let the record reflect the appearance of James Fisher, and I think our contact information is in the file.
All right.
Thank you.
And then for Triumph Foods, LLC.
Yes, thank you, Your Honor. Joshua Harden, on behalf of Triumph Foods, LLC, located in St. Joe, Missouri. The address of law firm Harden Law, 22500 West 75th Street, Shawnee, Kansas. I think the court reporter probably already has it in something, but 66227.
All right. And representing the city of St. Joseph, William Steinmeier filed a request yesterday to be excused from the hearing and reserving the right to join the hearing when issues were pertinent to his client. So I will grant that request.
Your Honor?
Yes.
Your Honor? This is Diana Plessa. I just had a when you asked for my interference, so I'd like to go ahead and give that. Diana Plessa, Curtis, Hines, Garrett, and O'Keefe for the MIEC.
And that's Missouri Industrial Energy Consumers.
Missouri Industrial Energy Consumers. Thank you.
And could you spell your last name for the court reporter?
Yes. P as in Paul, L as in Larry, ESCIA.
All right, thank you. For those in the hearing room, I ask everyone to silence their cell phones and any other mobile devices. For those participating via WebEx, I ask that you mute your microphone when you're not speaking.
And Judge, quick question from staff real fast. Just because we will have a few staff attorneys coming and going throughout the hearing, would you like me to enter all of their entries of appearance as well, or have them do it as they come to the desk?
They'll actually ask questions and what have you?
They will be on different issues, yes.
Yes, I would say let's just wait till then.
All right.
All right, and there has been a partial stipulation and agreement that was filed last Friday, and so there are remaining issues, and that's why we are here today. But before we get to those issues, you should know that, and there was talk about it before we went on the record, there will be a tornado drill today at 11 a.m., but we should be in recess at that time. But you should also know that this room is considered a safe room during the tornado drill. And in addition, the commission's agenda meeting is scheduled for 11 o'clock this morning. So we will break no later than 10:45 a.m. and we will likely reconvene around 12:30 p.m. It is my intention for the hearing this week at least that we try to end the hearing as close as we can to 5 o'clock, assuming that we're staying fairly on schedule. If I want you to keep that in mind in case there is a witness who can only testify on a particular day. So we will try to work with you and get that witness testimony in on that particular day. If we do find that we're into next week and we're running behind, we may go late or we may go into that Wednesday hearing date that's kind of reserved for extra time. Before we go any further, Mr. Pringle, I do have a question for you. There were, I think, 3 reconciliations filed on behalf of staff. Which witness or witnesses would be best to ask questions of those reconciliations?
Let me take a look back at staff behind me.
Gotcha.
I'm being told Amanda McMillan and Ashley Sarver would be the best staff witnesses for those questions.
Okay, and for the sake of the, excuse me, for the sake of the court reporter, that's Amanda McMillan, McMillen, and Ashley Sarver, Sarver, correct?
That's correct, Judge.
All right. All right. Friday, there was an amended order of witnesses filed and an amended hearing schedule. Are there any changes to that? Can we pretty much rely on that schedule? I'm seeing no shaking heads, so I'm assuming.
I think under depreciation, Judge, there may be a Malachi Bowman listed for a staff witness. His issues were resolved in the partial stip. So he would not be testifying on that, on the remaining depreciation issues.
Right, and he is currently scheduled for Friday.
Yeah, so we would ask that, yeah, his issue has been settled.
Okay.
Your Honor, I would simply ask that the list of issues has been rewritten multiple times, and to the extent that, you know, a party may need to move around a witness, that kind of got lost in the shuffle a little bit, but yeah.
Right, I will not be so strict that I will hold you to that revised hearing schedule. There was something mentioned, though, in in that pleading as far as many opening statements. Is that something that we're going to do this morning?
Yes, Your Honor.
Okay.
Judge, before you move on, you had mentioned witnesses that need to appear on certain days. We do have Mr. Barronbrook and Mr. Mustich on the schedule for today, and we do need to get them on and off this stand today if that's at all possible. So I just wanted to bring that to your attention.
Okay. All right. Would Missouri American Water like to make an opening statement?
We would, and as mentioned previously, Ms. Close is going to do that for the company.
Okay.
Thank you, Your Honor. Good morning. As Mr. Cooper alluded, I'm Hillary Close of Barnes and Thornburg, and I'm going to open us up here with the rate of return discussion. May it please the Commission, the issues to be heard today by this Commission concern the rate of return that Missouri American Water will be authorized to earn for purposes of setting rates. To calculate an overall rate of return, the Commission must determine Missouri American Water's capital structure and the cost of obtaining the capital it needs, including the cost of debt and an appropriate return on equity. The Commission must balance the interests of the investor and the consumer in accordance with the principles established by the U.S. Supreme Court decisions in Hope Natural Gas Company and Bluefield Waterworks, which you will have seen cited repeatedly in testimony and which this Commission has itself cited regularly. Bluefield and Hope provide guidance for determining the proper return to which a public utility is entitled. One, it must be commensurate with returns on investments in other enterprises with corresponding risks. Two, it must assure confidence in the financial soundness of the utility. And three, it must be adequate to maintain the utility's credit and attract capital. The return on equity and capital structure must provide Missouri American Water with the ability to attract capital on reasonable terms on a standalone basis and within the American Water system. The standalone rate-making principle is the foundation of jurisdictional rate-making. This principle ensures that customers in each jurisdiction only pay for the costs of the service provided in that jurisdiction. All American Water utility operating subsidiaries compete for proactive investment capital. Unless Missouri American Water is provided a reasonable opportunity to earn a reasonable return on equity with an appropriate capital structure, it will be at a disadvantage in attracting capital from its parent company resources. As in most cases, the financial analysts in this case used a variety of methods to estimate the company's cost of equity and recommend a fair return on equity, or ROE. Missouri American Water has presented evidence supporting as reasonable an ROE of 10.75%. Company witness Ann Bulkley developed this recommendation based on a reasonable range of 10.25% to 11.25%, and after taking into consideration the Hope and Bluefield standards, current and prospective capital market conditions, Missouri American Water's capital expenditure requirements, and Missouri American Water's regulatory, business, and financial risks as compared to her proxy group of utility companies that face operating and financial risks substantially comparable to those faced by Missouri American Water. When determining the appropriate ROE, the Commission must consider the relative risks of the company and the proxy group companies. To her proxy group, Ms. Bulkley applied the constant growth form of the discounted cash flow model, or DCF, the capital asset pricing model, or CAPM, and the empirical capital asset pricing model, or ECAPM. In contrast, staff recommends an authorized ROE of 9.5%, having determined a range of reasonableness from 9.25% to 9.75%. Ms. Malky's recommendation of 9.5% appears to be based on the average results of her risk premium analysis rather than her DCF or CAPM analyses. OPC recommends an allowed return on equity of 9.25%. Although Mr. Murray conducted DCF, CAPM, and risk premium analyses and estimated the cost of equity to be 7.25% to 8.25%, Mr. Murray appears to abandon those model results based on his position that authorized ROEs are often set higher than cost of equity estimation model results and therefore recommends an ROE of 9.25%. Directionally, both Ms. Malky and Mr. Murray acknowledge that the cost of equity has increased since the time of the company's 2022 rate case, yet their recommended authorized ROEs do not reflect that fact. Mr. Murray, while acknowledging that increased interest rates indicate an increase in the cost of equity, nevertheless recommends an ROE that is 28 basis points below what he states is the average authorized ROE nationally for water utilities in 2024. It's not enough, however, to look only to comparable ROEs. The Commission must also ensure that the capital structure to which that ROE is applied achieves the objectives set forth in the Hope and Bluefield cases. In this proceeding, the dispute over the appropriate capital structure to use for rate-making purposes hinges on the relative amounts of common equity and long-term debt in the capital structure. As a part of the rate-making equation, a lower equity ratio would have the immediate effect of producing a lower overall rate of return. All else equal, a higher debt ratio increases the risk to investors. However, simply artificially increasing the level of debt within the capital structure will not necessarily reduce the cost for customers over the long term, because it increases financial risk, as higher leverage leads to lower coverage ratios, lower credit ratings, and a higher cost of debt. Both staff and OPC recommend imputing to Missouri American Water the consolidated capital structure of its parent company, American Water. As a result, their equity ratios are 43.60% and 45%, respectively. Compared to the actual standalone capital structure of Missouri American Water, consisting of 50.39% equity and 49.61% long-term debt. Missouri American's capital structure should reflect the standalone operations of Missouri American Water. As noted earlier, the standalone rate-making principle is fundamental to rate-making. Missouri American Water's actual standalone capital structure reflects the capital that will be used to fund the company's rate base and costs to serve customers during the time that rates will be in effect. Missouri American Water is a standalone business enterprise in all material respects. It has an independent board of directors responsible for authorizing the company to enter contracts, issue debt, and make dividend payments. The utility operations this commission regulates are unique to Missouri. The investment needs are unique to Missouri. The challenges and risks, regulatory and financial, are also unique to Missouri. And the customer base is unique to Missouri. The other regulated utilities of American Water operate in different geographic locations with different operational characteristics, including size and customer base, and most importantly, different regulatory environments. The circumstances where use of a hypothetical or imputed capital structure may be necessary are not present in the case of Missouri American Water. Missouri American Water's actual standalone capital structure is in line with utility companies with similar risk profiles, and so there's no need to manipulate the equity ratio artificially as staff and OPC propose. Its equity ratio of 50.39% is within the range of actual equity ratios of the utility operating companies held by the proxy group, as well as the capital structures that have recently been authorized for natural gas and water utilities. Using staff's or OPC's approach would make Missouri American Water an outlier in comparison to the proxy group. In addition, the Commission has previously acknowledged in its Spire 2018 rate case decision that where a parent company has multiple operating utilities in different states, it is not appropriate to use the parent company's consolidated capital structure for setting rates for the Missouri utility subsidiary. Use of American Water's consolidated capital structure, as proposed by staff and OPC, does not reflect the difference in the risk profile of Missouri American Water and American Water. Ms. Malky's own testimony recognizes that American Water's diversification reduces the risk that it faces compared to Missouri American Water. They should not be viewed as one and the same. Use of a consolidated capital structure also creates barriers to Missouri American Water's access to capital. Missouri American Water competes for capital with operating utility subsidiaries within the American Water system. Those affiliates operate in other jurisdictions most of which use the actual utility capital structure for setting rates. This can result in constrained capital as it places Missouri American Water at a comparative disadvantage. Mr. Murray has suggested that the commission should use his recommended capital structure to ensure that Missouri American Water is not over-incentivized to invest in Missouri. The commission has the authority to disallow recovery on expenditures it deems to be imprudent. Notably, Mr. Murray has not argued in his testimony that the company's projected capital expenditures are imprudent. To use an artificially low rate of return to chill investment in a more arbitrary or blanket manner is not sound policy. It is not in the customer's long-term interest and is not consistent with the Hope and Bluefield standards, and it's therefore unreasonable and should be rejected by this commission. The NARUC primer on cost of capital and capital markets that Mr. Furious cites in his direct testimony advises that regulators are more effective at serving customers when they harness investors' desire to provide capital rather than constrain it. The final component regarding the overall rate of return of Missouri American Water is the cost of debt. Staff seeks to impute to Missouri American Water's consolidated cost of debt, which was 4.22% as of June 30, 2024. OPC seeks to impute to Missouri American Water a cost of debt of 4.13% based on weighted results from American Water Capital Corp's embedded cost of debt and certain legacy debt issuances of Missouri American Water. Notably, Mr. Murray's recommended cost of debt is lower than the range for other utilities that he cites as of June 30, 2024, which ranged from 4.24% to 4.45%. Missouri American Water's cost of long-term debt for the test year as adjusted through May 2025 is 4.56%, which represents the actual cost of debt that Missouri American Water will incur and will be obligated to pay on its long-term debt during the period rates will be in effect. While Missouri American Water does issue its own debt outside of the arrangement with American Water Capital Corp., the majority of Missouri American Water's long-term debt is issued pursuant to the Financial Services Agreement with American Water Capital Corp., which represents an efficient and cost-effective means for Missouri American to raise debt financing. Just as imputing the parent company's capital structure to Missouri American Water will ultimately not necessarily reduce the cost to customers of that capital over the long term, so too imputing a cost of debt other than what Missouri American Water actually pays discourages prudent financing transactions, ultimately risking an increase in the overall financial risk profile of the utility and constraining Missouri American Water's access to the beneficial debt financing arrangement. That's all I had.
All right, thank you. Chair Hahn?
Good morning.
Good morning.
Question, you cited the Spire 2018 case on imputing cost of capital. The commission, I think it was last year, had a Central States Water Resources rate case where we imputed a hypothetical capital structure of 50-50, largely based on the fact that, similar to American Water and Missouri American, that capital structures can be manipulated between parent companies and subsidiaries. So how does that case, how is it distinct or different than this one? And then, or who should I ask about that?
First of all, it is my understanding that that case is distinct. It's my understanding that this is the Confluence Rivers utility, that utility had a distinct fact pattern in some of its corporate structure and what its actual capital structure was, including how it was receiving its long-term debt financing. I'm not intimately familiar with the details of that case. I don't know whether we have any witnesses here that are, but you're certainly, welcome to ask the witnesses how they could reconcile that as well. But what I will say is that it's my understanding that the actual capital structure in that case was not shown necessarily to be in line with what we're saying here, comparable utilities, a proxy group similarly situated utilities.
Thank you.
Are there any other questions from the commissioners? All right, hearing none, thank you.
Thank you.
All right, Mr. Pringle, would you like to make an opening statement?
Thank you, Judge Sire. Good morning, Chair Hahn, Commissioners, and may it please the Commission. My name is Travis Pringle, and I represent staff regarding the return on equity, capital structure, and cost of debt issues today. Staff witness Kelly Malky will be taking the stand to answer any questions you may have regarding staff's positions on these issues. Regarding all three, I ask that you order the reasonable recommendations put forward by staff. 3 parties filed testimony regarding the proper return on equity in this case: Missouri American Water Company, staff, and the Office of the Public Counsel. When determining the proper return on equity for a utility, focus should be on what is called the zone of reasonableness. This zone is meant to represent the lowest rate that would not be deemed confiscatory and the highest rate that would be fair to the public. Staff's proposed range for a reasonable return on equity is 9.25% to 9.75%. Ultimately, staff recommends the Commission authorize a return of equity of 9.5% for Missouri American Water Company. The Office of the Public Counsel's proposed range for a reasonable return on equity is 9.0% to 9.5%. The OPC ultimately recommends the Commission authorize a return of equity of 9.25% for Missouri American Water Company. While this is on the lower end of staff's range, the OPC's number would be considered reasonable under staff's analysis. Missouri American Water Company, on the other hand, proposes a range of 10.25% to 11.25% and ultimately recommends the Commission authorize a return of equity of 10.75%. The company's idea of a reasonable low return on equity is 50 basis points higher than what staff views as the highest rate that would still be fair to ratepayers. Missouri American Water Company's ultimate recommendation is 100 basis points higher than what staff views would be reasonable and fair to the public. As outlined in the direct rebuttal testimony of Ms. Malky, Missouri American Water Company's recommended return on equity is a result of a methodology that assumes return on equity is equal to cost of equity. It also includes a projected growth rate for the company over the next 10 years that is almost 300 basis points higher than the current projected growth rate of the United States GDP. As Ms. Malky further points out in her testimony, this is simply far too excessive, too unrealistic, and thus unreasonable. I implore you to ask Ms. Malky about her reasonable analysis and how that compares to that of the company. The next issue before you today regards the reasonable capital structure for Missouri American Water Company. Typically, it is reasonable to use a utility's actual capital structure. However, when a utility is part of a holding company situation, as Missouri American Water Company is in regards to its parent company, American Water Works Company Incorporated, using MAWC's capital structure and capital costs may not accurately reflect the actual capital costs. Because this is such a situation, staff recommends that the most economical capital structure to use is that of American Water's capital structure as of June 30th, 2024. That capital structure consists of 43.60% common equity, 0.01% preferred stock, and 56.38% long-term debt. Staff is continuing to monitor American Water and Missouri American Water Company's capital structure throughout the true-up period, and this recommendation is subject to change. Please ask Ms. Malky any questions you may have as to how staff reached this determination. And the final issue I will be presenting before you today involves the appropriate cost of debt to use in setting prospective rates for Missouri American Water Company. Similar to staff's position regarding capital structure, staff's recommendation is to use the actual cost of debt as of June 30th, 2024, of Missouri American Water Company's parent company, American Water. That percentage is 4.22%. Similar to the capital structure issue, staff will continue to monitor Missouri American Water Company and American Water's cost of debt through the true-up period, and this recommendation is subject to change. If you have any questions regarding staff's analysis on this issue, Ms. Malke is available today to answer those questions. To summarize, staff recommends that the commission authorize 9.5% as a reasonable return on equity for Missouri American Water Company, and to use the capital structure and cost of debt of Missouri American Water Company's parent company, American Waterworks Company, Incorporated. Staff's recommendation on these matters are the most reasonable to use in ensuring a healthy return for the company and to ensure fair rates to the public. Thank you for your time today, and I'm happy to try and answer any questions you may have at this time.
All right. Are there any questions from the commissioners? All right. Hearing none, thank you.
Thank you, Judge, and Chair Hahn, if I may, the question you asked the company earlier, Ms. Malke may be able to help you out with that.
At this time, I would ask if any of the interveners intend to present an opening statement on today's topics? Okay. All right. Then, oh, go ahead.
May it please the commission. John Kaufman on behalf of Consumers Council of Missouri and AARP. We don't have a witness on these issues, but we do think that they're important, and we do intend to brief them and to examine them. We view this case by Missouri American Water Company as being overly aggressive compared to other cases, and it's certainly their right to ask for whatever relief they think they deserve. But there are many issues in this case where we believe that they have gone beyond what is reasonable and beyond what is comparable for your typical regulated utility. The return on equity is certainly one of those issues. 10.75 is, I think, outside the norm, certainly for our region, and would ask that you certainly look at staff and public counsel's alternative returns there. I would also ask that you look at the rate of return in conjunction with some of the other mechanisms that the water company is proposing as to mitigating their risk, the RSM, the production cost tracker, and so forth. These mechanisms significantly reduce business risk if they're adopted, and in our minds, that there should be some counterbalance between the rate of return and what business risk the utility has under whatever regulatory structures it has. We believe that the WSIRA, the WSIRA, significantly reduces business risk and provides stability of revenues. And we would point out that whenever the utility's risk is mitigated, it has the effect of transferring that risk to the ratepayers. And so that is the balance that we hope that you see. Risk doesn't necessarily go away. It's just transferred and has a cost to it. And would point out again that there are many customers, perhaps half of the customers in this water company that struggle currently with their rates, and would point out that every dollar more that this rate increase is than what is just basically necessary for safe and adequate service is going to create a hardship. And so we ask that you take that into account. As to the capital structure, we believe that you should look primarily at American Waterworks Company. That is the company that's traded on the stock exchange, and there are a variety of ways that with the internal affiliates that we're afraid that it can be gamed, and so we don't want a capital structure necessarily set based on their internal corporate policies with regard to their affiliates. Sure, they compete for capital, but that's not the kind of competition that drives costs down, and so we're skeptical, and we hope that you look at it closely. That's all I have.
All right. Chair Hahn?
Morning, Mr. Kaufman.
Yes.
I noticed in your comments, your ROE was suggested at 9.25, which is similar to OPC.
Right.
OPC's was caveated with an RSM calculation. So if an RSM is adopted by the commission, they would prefer a lower ROE. On behalf of the Consumers Council, would you prefer an ROE that is, would you prefer either a higher ROE or an RSM?
That's a good question. I think that, generally speaking, we would prefer not to go down the path of the RSM. In my experience, one of the problems is that sometimes there will be an ROE reduction to recognize some mechanism, but then it only happens in one case, and then it just becomes baked in, it becomes the new normal, and we go forward. So on that experience, I think we'd rather just not have so many mechanisms that mitigate risk, and because that has the overall effect of reducing what we see as the incentive for cost cutting. So the more you can just keep the rates at a basic revenue requirement, the more likely we think that it provides a good cost saving incentive going forward. So I hope that
Thank you. Appreciate
answers
it.
the question.
Any questions from the other commissioners? All right, hearing none, thank you. All right, Mr. Kleiser, would you like to make an opening statement?
I would, although I was going to point out the initial filed list of issues, which had the list of opening statements included in it, the OPC was going to go last. I'm more than okay to make mine now, but I generally was going to allow anybody else who wanted to come up first.
Right, but,
But if nobody else wants to, I'm ready to
yeah,
go.
I don't believe anyone representing the other parties expressed a desire to make an opening statement, at least this morning. Thanks.
Super. My witness is in the middle of handing out my presentation. I'm going to let that die down, then I'll get started. All right, so if it would please the commission, John Kleiser on behalf of the Missouri Office of the Public Counsel. We've already heard, both staff and the company, come forward and present their cases kind of regarding what this is. However, before we really get into the nuts and bolts of the sort of rate of return, I want to start by just talking about this case in terms of large numbers, because it's important for the commission to kind of get a grasp of how this issue interplays with the rest of the case. So on that note, let's just start by looking at where this case is at. Missouri American Water's current authorized revenues, this is according to staff's accounting schedule, is $466 million. The company's requested increase as of true update would be to move that to $641 million. Now that represents an increase of about $175 million over existing revenues, or about a 38% increase. And to put that into comparison, what you see here is a table that's taken from an investor relations presentation provided by Missouri American Water on their website. And you can see the sort of increases that were approved in the as effective January 1, 2024. And you can see right off the bat that the $175 million that we're talking about here completely dwarfs the other approved increases across other states, nearly double that even of New Jersey. So we are talking about a substantially large amount of money. And it's also important to remember that that's not the only increases that customers are going to see as a result of this. As has been mentioned, the utility currently has what is called the Water and Sewer Infrastructure Replacement Act, referred to as WSIRA by its acronym. They have been routinely hitting the caps for that system just about they've been hitting the caps for it regularly, which means that you can expect that that 175 is going to blossom even more. The other thing is the rate of return that's set in this case is the rate of return used for the Wasira case. What that means is that if you have a higher rate of return here, you actually have a higher cost included in the Wasira. And because the Wasira has a cap attached to it, it means that they'll be able to put in less pipes during the Wasira projects for the same dollar amount. If you give them a higher RR now, they'll hit the cap faster, and you'll actually accelerate them having to come back in for a rate case. Again, this is from that same presentation, and just to highlight, the Missouri American Water Wasira increases in just Missouri amounted to another nearly $50 million. And again, that's not plant spend, that's the revenue increases associated with those. So there's a huge amount of money at stake here, and you also need to recognize that this case is going to be a massive increase almost no matter what happens. Staff's case, and I don't begrudge them for this, but I'm just going to say it what it is, their case is currently recommending a $557 million increase as of their true-up position. That's what I was told according to staff. Again, that represents a $91 million increase over current rates, or about 19%. Now, the OPC does have a few disallowances, but I'm not gonna sugarcoat it. We don't have very many here, and we don't think that we can bring this entire rate increase below 15%, which, to be clear, that's usually what most of the electric and gas companies are aiming for, is that 15, high end of 20%. That's effectively becoming the low end for this case. So, like I said, huge amount of money at stake here. So how does this tie into ROR? Why am I bringing this up now? Well, to understand that, you need to understand how this difference breaks down. So there's an $85 million difference between where the staff is at and their recommendation and where the company is at. Of that $85 million, $52 million is this issue alone. That's over 60%. Over 60% of the difference between where the staff is at and where the company at is this one issue. The next largest issue is discrete adjustments. That's about $23 million. Corporate support services, which is the second issue you're going to hear today, and it actually incorporates two different issues. I'll touch on that later. That's about $8 million. And then there's about a handful of smaller issues beyond. So I really implore you to pay careful attention to this issue because it is, in many respects, the single largest issue at stake in this case. Okay, so let's go rate of return. And again, I know we've already kind of gotten a few of these things. I'm just going to do a very quick primer on a couple of terms just to make sure everybody's on the same page. Return on equity. This is what the company is awarded as a monetary amount that they then pass on to their ratepayers. They usually do that through dividends. They could also theoretically retain earnings. This is what we consider to be the profit a company earns on its investments. Then you have the cost of debt. This, fairly simply, is just the interest being charged on the loans or other debt instruments that the company enters into in order to finance its operations. Finally, you have the capital structure, which is usually the ratio of equity to debt that the company is using to support its position. Now, traditionally, most companies are using just common equity and debt, so those two ratios usually should add up to 100%. Sometimes you have a little bit of preferred stock. I think in this case, there's like a 0.0001% preferred stock in staff's case. It's such a small amount that we don't really consider it. But with those in mind, let's look at the numbers. And again, I know you've already heard the numbers out there, but this is a good way to get a quick view of where all three of the parties who have witnesses are at. And right off the bat, we can look at the return on equity. Again, the numbers have already been laid out. 10.75 is the company's recommendation, 9.5 is the commission staff, and 9.25 is the OPC. Now, I will echo what the attorney for staff has already said. So staff's recommendation was based on a range of 9.25 to 9.75. So the OPC's recommendation is technically within staff's range. OPC's recommendation was based on a range of 9 to 9.5. So staff's recommendation is technically within the OPC's range. I don't think either of the witness for staff or OPC can therefore disagree with what the other has recommended in terms of a just and reasonable ROR. I mean, we would prefer the mid-ground of either of our ranges, obviously, but the truth of the matter is both of us are within each other's ranges. As far as the percent of common equity goes, the OPC is actually a little bit higher than staff, and the basic reason for this is, I understand, staff took sort of a point-in-time analysis of where the corporate parent company was at, while OPC looked at more of an average basis. So we ended up getting a little bit higher. And the company, of course, is asking for the 50.39 that they ascribe to Missouri American Water itself. The cost of debt issue, which again I'll get into a little bit here, is about a 25 basis point difference. You will note, I believe earlier, that the cost of debt for OPC was labeled at 4.13. That is accurate with regard to the direct testimony. The 4.23 that you see here is a true-up position. Might be a little bit unfair because I think maybe staff might have also updated theirs in true-up, but I just want to get that out there to make parties aware that we have trued up our number on that issue. But what I really want to draw people's attention to is where those total rate of returns shake out, because in a sort of ironic twist, the fact that the OPC has a higher equity layer than the staff, our rate of return actually ends up being almost a top of staff. And in fact, once you factor in the tax component of it, we're within 1 basis point of each other. So while we technically have 25 basis points less on ROE, our slightly higher equity layer means that we're almost lockstep with where staff is at least that's our position on this. I also want to just take a moment to kind of remind people, because I don't want the commission to get the mistaken impression that either staff or OPC is trying to suggest that the company shouldn't be making a profit here. We have included a very healthy amount of money in our respective cases to account for the company's return on their investment and their profit on that investment. Both staff and OPC, based on a $3.2 billion net rate base, which is what the company says it has, would generate $175 million in pure profit for the company. The company's increase over where the staff and OPC are at would produce $225 million in pure profit. Again, that's taking out the debt component of it. This is just the profit the company earns. So, as I was saying before, this case in its entirety largely turns on just how the commission, how much of that $50 million in profit difference this commission is willing to give the company. That's what's really driving what the party's difference. I would write this now. So let's walk through really quickly what the 3 components are. Again, they've already been touched on a little bit, so I will try and make this relatively quick. Return on equity. This is, of course, like I said before, it's what the company earns in profit. When the commission sets a return on equity, usually what you want to be thinking about is risk, right? Because equity gets paid off after debt in the case of like a bankruptcy. Equity holders have a higher risk than debt holders. So really what the commission needs to be thinking of is how much do we need to incentivize, or how much do we need to provide equity holders to account for their risk in holding equity. So when you think of that, you need to start thinking, okay, how risky is the company in its totality, right? And the thing about water companies in general is that they are generally considered much lower risk than their other associates. Of the 3 major utilities, so water, gas, electric, water utilities regularly trade at a premium. They're regularly considered lower risk, safer investments. And it's really easy when you think about why that would be. You think of an electric company, right? They have to make big, huge lump investments, like building a generation. They're irregular, so they have to come in and get investments, get CCNs on that. Water companies, their investments are regularly. It's just a constant renewal of their distribution system. So they're going to be constantly coming in and getting, you know, a regular CapEx spend. And this is recognized by outside observers. This quote from Guggenheim Securities explains how water companies are, again, considered lower risk than electric or gas utilities because you have that consistent, predictable CapEx spend. And that's a problem because in this case, you're seeing the exact opposite of what you should be seeing. The company is asking for a 10.75% ROE. Their witness, Ms. Boakley, also filed testimony in the Ameren, Missouri electric case that was, I believe, just settled. I'm not sure if they've actually filed a settlement, but in the process of being settled at any rate. In that case, she was recommending a 10.25% ROE. So right off the bat, you need to be asking yourself, is Ameren, Missouri less risky than Missouri American Water? I mean, think about it. Think about what Ameren, Missouri has had to deal with. They've had to fight litigation on Rush Island. They've had to deal with the bat situation at High Prairie. Why would they have a lower ROE than the Missouri American Water Company, who's basically gotten the $1.1 billion investment put in this case without anybody raising real concern about it? The other thing is to just start looking at, you know, what is happening in the rest of the country. So the Regulatory Research Association basically puts out papers. They're offered by S&P Global, and they just look and they see, okay, what have all the other utility operators or all the other commissioners done, right? For 2024, they found out of 16 cases, the average ROE awarded for water companies was 9.52%. And that was based on a range of 9.01 to 9.84. I have that S&P Global report, and I intend to introduce it later in this hearing so you all can see it for yourselves. This is substantially less than 9.72% that they gave for gas or the 9.84 they gave for electric, which again makes sense. We expect for water to have a lower ROE than for gas or electric because it's a less risky investment. I'd also like to just sort of touch on the fact that, it was mentioned how our witness, Mr. Murray, didn't use his own cost of equity analysis, which he came out to be 7.25%. It's really important for the commission to recognize that there has been a divorce between cost of equity and the allowed ROEs for a considerable period of time. And that divorce is recognized by actual analysts in the field. Wells Fargo uses a 7.25% estimated fair price for Missouri American Water parent company stock. That's not Wells Fargo being paid to come here and present information. That's just what they do on their end for their investors. They're using a 7.25% cost of equity, consistent with what Mr. Murray says. So again, we are not outlandish. We are following what the actual equity investor analysts are saying. With all that in mind, why are we talking about 10.75 at all? And again, this was already brought up, done very well by Mr. Pringle on behalf of staff. The commission has used in the past a zone of reasonableness test. They have used this in the past to say, hey, if it's 100 basis points above or below what the national average is, we're not even going to consider it. It's just not even worth thinking about. And in this case, Missouri American Water is more than 100 basis points beyond that 9.5 that is the national average. So in the past, the commission would have thrown that out right out the gate. The reason that they've come in and asked for 10.5, and this is my personal opinion, it all has to do with anchoring, right? They know, or they should know, they're not going to get that. They shouldn't get that. It's completely outlandish. But by asking for a 10.75, they can set a midpoint in your all minds, somewhere between the 9.5 that's consistent with the national average and where they want it to be. So they're aiming for somewhere in the middle there. I truly do not believe that it's reasonable that you could ever suggest a 10.75 given where national averages are right now. But I want to move on. So, the cost of debt. This issue has been explained before, but they haven't really gotten into the details of what's happening here, so very briefly I'm going to explain this. To understand the cost of debt and actually the cost of capital issue, you have to have a good understanding of how American Water Company in general is set up. So, American Water Company or American Water Works Company is the parent company. They're the ones who owns all the subsidiaries. They have an affiliate subsidiary called American Water Works Capital Corporation. Whenever the entire entity wants to raise money through capital, American Water Works Capital Company goes out and sells debt to third-party investors in the name of the entire company. Then it takes the money it generates and transfers it to the parents and subsidiaries through affiliate loans. Now, what's happening right now is they are choosing to give the lower cost debt loans to the parent company and the higher cost debt loans to the subsidiaries. This is a choice that they are making because the capital is being raised in the name of the entire entity. It's not being raised on behalf of one subpart. And all the ROPC is arguing, and I believe all the staff is arguing, is that's not fair. So we're using an average to account for the fact that that would be what is fair. This is just a short kind of recap of what I just said, but that's the entirety of the cost of debt issue in a nutshell. It's literally just they are artificially choosing who gets the debt. They're giving the lower cost to their parent. They shouldn't, or rather, the commission should recognize the average cost of debt because that's what's equitable and fair. The capital structure issue is largely based on the same problem. Again, if you think back to that structure that I just went through, what's happening is Missouri American Water is raising debt at, let's say, 4.1 or something. then it's taking the debt that it's raising and it's reinvesting that in its subsidiaries. So it is controlling the amount of equity that its subsidiaries have. And this is the real key here, because you heard earlier the counsel for Missouri American Water try to tell you we are independently managed. That's simply not the case at all. In fact, if you just look at who the company brought to present information to you today, they didn't bring a Missouri American Water Company witness. They brought the American Water Works Service Company witness who works for all of these subsidiaries, who routinely presents information for all of these subsidiaries. There is no one at Missouri American Water Works that's making decisions on how to capitalize their system. It's all being done at the parent level, and it's all being done purposefully to ensure a higher equity ratio that translates into a higher artificial return for its ratepayers. If you want more information on this, again, strongly encourage you to talk to Mr. Murray about it. He can provide a lot more detail than I can. The last thing I just want to say on this is, if you look at what regulatory analysts or investor analysts think when it comes to water utilities, they routinely say that the safer, low-risk profile water utilities can justify them having a much higher leverage amount than other utilities. It is expected that other utilities will have, that water utilities will have a higher than normal leverage when compared to electric and gas. The exact opposite is what's happening here, and that is a concern. So what do you do about it? Well, you look at the parent company. The capital structure of American Water parent company is being financially and reasonably managed for the purposes of achieving desired end for its shareholders. That is what a reasonable capital structure would actually look like. And again, this is from that same presentation that was given to their investors. First of all, I just want to note how the company itself touts their investment rating is based on, quote, low-risk business profile, as well as a strong regulatory environment. So the company is already acknowledging that its low-risk profile is allowing them to maintain a very high amount of leverage. How high? Well, the company itself touts that as of December 31st, 2024, which just happens to be the true update for this case, they have a 57% debt to equity ratio. That is exactly, give or take, a 0.1 or point something, whatever staff is recommending in this case. So you can see, the company is touting, hey, our low risk profile is allowing us to maintain higher debt. And all the OPC and staff, I believe, are asking for is for that reality to be reflected in a manner that allows for Missouri customers to benefit from the low risk that this state has generated for Missouri American Water. So, moving in, my closing thoughts on this. As I said earlier, both the OPC and staff positions ultimately reach about the same result. Both the OPC and staff's ROEs are within the range of reasonableness of the other witnesses' position. So I'm not about to stand here and say it has to be OPC or it has to be staff. Honestly, either one is just and reasonable at this rate. And they are both going to result in this company getting $175 million in profit. The only question really now before this commission is how much more profit you think you need to give the company. Because the difference between 15, 19, 30, or 40% increase, it's going to all turn on that one question. And we are here to ask you to use a reasonable rate of return as prescribed by either staff or OPC to give the company $175 million in profit, but to mitigate the extra increases on customers. They don't need it. Customers don't need to bear it. Again, very last thing I'll just say, as I've said before, I strongly encourage you to ask any questions of Mr. Murray. I will point out that of all the witnesses here to present today, I believe he is the only one who is an actual chartered financial analyst. His wealth of experience in this field is fantastic, and he has spent an enormous amount of time trying to understand the inner workings both of Missouri American Water specifically and Missouri utilities in general. So he is an incredibly valuable asset. But with that, I will pause and ask if there are any questions.
Mr. Kleiser, this is Commissioner Mitchell. I have a question for you.
Yes, sir.
I just want to make sure that I understood what you said, that the parent company on behalf of all of the affiliate companies or subsidiary companies issues the debt or secures the debt on behalf of all of the subsidiary companies, and then allocates that debt to different subsidiaries at different costs or different different cost of capital.
So, I'm sorry, I didn't mean to cut you off, sir.
Oh, do I understand that correctly?
First of all, I want to make sure that you please ask that to the witnesses, just to make sure that I didn't say something wrong. I am relaying information that's provided to me by my witnesses, but I have been known to err. So in the event that I misspoke, I beg your indulgence. I will again reiterate, as I understand it, looking over to my witness, and hopefully he can nod or correct me if he thinks differently, but I strongly encourage you to directly ask the witnesses that. So my understanding of it is American Waterworks Capital Corporation, this is not the parent company, but a separate subsidiary, American Waterworks Capital Corporation, is responsible for issuing the debt financing that funds the entire American Waterworks company body. My understanding is that the capital is raised on the behalf of the entire American Waterworks capital body, meaning that effectively it's not raised on behalf of an individual subsidiary or parent company, but on behalf of the whole. And then it is, once it's raised by the capital company, it is distributed to the parents and the subsidiary through affiliate loans. And the company itself determines how that money flows out. It's my understanding that the company treats the loans being raised, they basically flow through the cost of debt in accordance with the debt instruments that are being used to raise it, but there are multiple of different debt instruments being used to raise it. So some have a higher cost of debt, some have a lower cost of debt. The company is choosing how those debt instruments are effectively transferred internally, and thereby assigning the cost of debt between the parent and subsidiaries. Did that make sense? And if not, I will try it again.
It did. And remind me, who is your witness that would be best to follow up with?
Yes, the OPC's witness is Mr. David Murray.
Thank you.
All right. Thank you, Mr. Kleiser. All right, is the company ready to bring on their first witness?
Yes, Your Honor. Missouri American Water would call Nicholas Furia.
All right. Mr. Furia, would you raise your right hand, please? Do you swear or affirm that the testimony you give in this hearing shall be the truth, the whole truth, and nothing but the truth?
I do.
All right. Thank you.
Thank you, Your Honor. Good morning, Mr. Furia. Would you please state your full name for the court reporter?
Nicholas Furia,
And by whom are you employed and in what capacity?
American Waterworks Service Company as the Vice President and Treasurer.
And you are testifying here today on behalf of Missouri American Water, is that correct?
That is correct.
Have you caused to be prepared for purposes of this proceeding certain direct and rebuttal and surrebuttal testimony in written question and answer form?
I have.
Is it your understanding that that testimony's been marked as Exhibits 8 for your direct, 9P for the public rebuttal, 9C for confidential, and 9HC for highly confidential?
Yes,
Do you have any changes to that testimony at this time?
I do not.
If I asked you the questions contained in Exhibits 8, 9P, 9C, and 9HC today, would your answers be the same?
Yes, they would.
Are those answers true and correct to the best of your information, knowledge, and belief?
They are.
At this time, Missouri American Water would offer Exhibits 8, 9P, 9C, and 9HC, and tender the witness for cross-examination.
All right, are there any objections to the admission of those documents, Exhibits 8, 9P, 9C, and 9HC? All right, hearing none, those exhibits are admitted. And Mr. Pringle, do you have questions for the witness?
No questions, Judge. Thank you.
All right. Mr. Kleiser?
Yeah, no questions, Your Honor. Thank you.
Any questions on behalf of the Consumers Council or the or AARP?
No questions, Your Honor.
City of Riverside?
No questions, Your Honor.
Liberty? MECG, MIEC?
No questions for MECG.
Okay. Water Supply District? Or Triumph Foods?
No questions, thank you.
All right. Any questions from the commissioners? All right, hearing none. I do have a few questions myself. Mr. Furia, do you know how many American Water rate cases were litigated in 2024?
I know there were several, but I'm not sure of the exact number.
Ballpark, do you know what equity percentage was approved in those cases?
I don't have the exact numbers, and I certainly don't have it in front of me here today, but I think that they were reasonably in line with what we're asking for in this case.
And I don't have your testimony in front of me right now, but what would you say is the definition of double leverage?
I think folks have used that terminology to suggest that a holding company is loaning funds to a subsidiary company in order to enhance its returns.
Okay. And how about equity infusion? How would you define that?
That's simply an equity investment by a shareholder.
Is all the equity portion of your capital structure equity that is held at Missouri American, or is all the equity portion of your capital structure equity that is held at Missouri American, or is a portion of it infused from American Water Works?
So a portion of it would be retained earnings, which is, earnings that weren't dividend out that the company has earned. And then a portion would be common equity that the parent company has bought into the entity. That represents its ownership stake in the company.
Okay. If the commission wanted to trace the infusion of equity dollars into Missouri American back to American Water Works to verify if those dollars were from debt issuances at American Water Works or dollars from the issuance of common stock issued at American Water Works, how would the commission do that?
It wouldn't be able to, Your Honor. The details of that are not tracked in any of the systems that we have, and the cost to do so would be overly burdensome. Would effectively mean we would have to track every dollar that comes in and goes out of American Water.
I see. Does Missouri American issue its own individual common stock separate from American Water Works?
It does not.
Does not. And you may have already answered this for me, but does American Water and Missouri American have an in-house accounting mechanism or bookkeeping method that can decipher whether or not the equity infusions to Missouri American from American Water are from debt issuances or common stock issuances?
Not to my knowledge, no.
Okay. Is there any company witness that
I
could answer
should
that?
clarify, I don't believe one exists, and I don't know that there would be another witness that would say different.
Okay. All right. That's all the questions I have. Chair Hahn has some questions.
Yes, thank you. Good morning.
Good morning.
Discussing ROE, it does appear that the company's position is significantly higher than both staff and OPC's positions on this particular subject. I asked the Consumers Council about weighing the optionality of an ROE that is higher according to Consumers Council's standards, which would be probably in the 9.5 range compared to an RSM. What's the company's position on weighing an ROE that is slightly higher versus implementation of an RSM that would offset risk?
I think I would love to provide an answer for you, but I think that's probably a better question for a different witness, possibly witness LeGrand.
Okay. Thank you.
Are there any other questions from the commissioners?
Just a clarification, please. OPC mentioned that there was an Missouri American Water witness that basically provided testimony or can provide information for all of American Water Works. Are you that witness?
If I could provide testimony for all of American Water
Well,
Works?
you could answer some
As it
questions.
would relate to capital structure,
Yeah.
yes. Yes.
Okay. And you came in from where?
New Jersey.
Okay. Thank you.
You're welcome.
Thank you, Judge.
All right.
I'm going to go. Just an additional question.
Sure.
When I look at Missouri American's request on ROE from 10.25 to 11.25, in any of American Water Works jurisdictions that have had rate cases in the last 2 years, can you name any specific example where an ROE has been awarded in that range?
Not one that I'm aware of, no.
What has been the typical range that has been awarded in other,
I don't have all of that data in front of me, and it's not something I have committed to memory, so I apologize. But I think it's in between the mid-9 to mid-10 range would be my guess, based off of recollection.
so at the mid-9 range, that would be basically the standard that OPC pointed out was the average ROE for water utilities across the U.S. last year. So that would be roughly in line?
Yes.
Okay. Thank you.
Mr. Pringle, do you have any follow-up questions?
One moment, Judge.
Judge, if I wait, Mr. Pringle's thinking, what is the current ROE prior to this rate case coming forward?
I don't know if I want to lodge an objection about, so the difficulty there is that the prior ROE was technically part of a black box. There was, pursuant to the stipulation setting the last case, a number included for the total ROR for WSERA purposes, which is necessary to comply with statute. But every party was entitled to present what they believed the individual ROE was. And I apologize, I allow the witness to answer that question, but I wanted to make sure it's clear that it's a stipulated term and that it's not an agreed to number. Sorry, thank you.
Thank you. I'll withdraw my question.
Yes,
Well-
Chair Hahn.
Also, prior to Mr. Pringle asking a question, capital structure. So Missouri American's requesting what the actual Missouri American capital structure is. and staff is requesting what the American Water Works Corporation capital structure is. In other states that American Water Works operates, how often is the capital structure of the parent company used in lieu of the operating or subsidiary company?
I'm only aware of 2 jurisdictions that do not use the actual standalone capital structure for the operating company. Of the 2, I believe 1 is pending. I don't know that that rate case is actually, we have the final order for that one. That would be stipulating the consolidated capital structure.
Okay. Can you repeat that? Because I want to make sure I'm understanding what you're saying. It is more often than not that the subsidiary company capital structure is used as compared to the parent company?
Correct. The standalone actual capital structure of the operating company is most often used.
Okay, thank you.
All right, Mr. Pringle?
Just one question, Judge. Mr. Furia, when it comes to the capital structure and the percentage of equity, are you aware of any other American Water jurisdictions that have even close to a 56%?
Am I aware of any operating company that has close to 56%? Yes.
And do you know which ones those are?
Believe New Jersey and Pennsylvania.
Thank you, sir. No further questions.
Thank you.
Mr. Kleiser?
Mr. Furia, you were asked a question sort of concerning the equity ratios that have been kind of put forward in other states. Do you recall filing testimony for the Virginia American Water Corporation or American Water Company's case?
Yes.
And is it correct that you requested a rate-making comedy equity rate? Is it correct that for that case you requested a rate-making common equity ratio of 45.67%?
Not entirely the way you've characterized it. The Virginia statute requires the actual standalone capital structure for the operating entity be used at the point in time. And at that point in time, that was the capital structure. That was the equity layer.
No further questions.
All right, I will generally ask, do any of the interveners have any recross for this witness? All right, and they are indicating no here in the hearing room, and I do not hear any online. So, Ms. Close, do you have redirect?
Just very briefly, Your Honor. Mr. Furia, you were asked about the equity ratios in other states and whether you knew if any of them were close to 56%. Do you know if Indiana was awarded 56% in its most recent rate making?
Yes, yes. Thank you for refreshing my memory on that. That is correct.
No further redirect, Your Honor, but I would point out that I think Commissioner Mitchell had a question during opening statements. I just want to point out that if he would like to ask that question about the cost of debt that gets realized by Missouri American Water, that Mr. Furia, on behalf of the company, is happy to answer that question as well.
Yeah, thank you. That question was, I'm understanding correctly that Missouri American Capital secures the debt for all of the subsidiaries. And I'm curious how the cost of that debt is then assigned to the subsidiary companies.
The FSA, the Financial Services Agreement that Missouri American and the other participating subsidiaries in the American Water Capital Corp financing program stipulate that we assign that cost of debt at the same terms that AWCC has issued in the capital markets and/or so the lower of that cost or market rates. And that's how it gets allocated. If there is any difference between American Water Works rates and a entity's rates, it's because they did not participate in the same manner in all issuances that American Water has outstanding.
Thank you.
All right. Are there any other follow-up questions for this witness before he's excused?
Your Honor, if I could just follow up on briefly on that line. Mr. Feria, is there a portion?
Actually, I'm going to object. The redirect is based on cross-examination.
I'll sustain that objection.
All right, thank you, Your Honor.
All right, Mr. Feria, thank you for your testimony.
Thank you.
Judge, before we go on, I guess I want to comment, if it's all right, on that last ruling or ask about that, because certainly my understanding has been over the years that redirect is appropriate for questions from the bench in addition to cross-examination.
I believe you are correct on that, so I will reverse that ruling, and if you don't mind, Mr. Feria, if you'll retake the stand.
Well, Judge, I would like to point out as well, before the company could do any kind of redirect, the parties have a chance to conduct cross-examination based on Commissioner Mitchell's question.
Right. Do you, Mr. Pringle, have any questions?
I do not have any based on that.
All right.
No.
Mr. Kleiser, the answer is no. Okay. Ms. Close.
Thank you, Your Honor. Mr. Feria, I just wanted to ask you if there's a portion of the long-term debt in Missouri American Water's capital structure that is standalone issuances by Missouri American Water.
Yes, there is. They have some legacy first mortgage bonds and some SRF, state revolving fund loans that they have outstanding.
Thank you. Nothing further.
All right. Anything further? All right. Thank you, Mr. Feria.
Thank you.
All right, the company may call their next witness.
Thank you. Missouri American Water calls Ann Bulkley.
All right, Ms. Bulkley, would you raise your right hand, please? Do you swear or affirm that the testimony you give today in this hearing shall be the truth, the whole truth, and nothing but the truth?
I do.
All right, thank you. Go ahead.
Thank you. Good morning, Ms. Bulkley.
Good morning.
Would you please state your full name for the record?
Yes, it's Ann Bulkley,
By whom are you employed and in what capacity?
by the Brattle Group as a principal.
And are you here testifying today on behalf of Missouri American Water?
Yes, I am.
Have you caused to be prepared for purposes of this proceeding certain direct and rebuttal and surrebuttal testimony in written question and answer form?
Yes.
Is it your understanding that the testimony has been marked as Exhibits 2 for your direct, 3P for public rebuttal, 3C for confidential rebuttal, and 3HC for highly confidential rebuttal?
Yes.
Do you have any changes to that testimony at this time?
I had one change in my rebuttal, surrebuttal testimony. On page 7 at line 7, I would like to correct, it should be Ms. Malky, not Mr. Malky at that page. I apologize for the error.
Thank you. Did you have any further changes?
No.
If I asked you the questions contained in Exhibits 2, 3P, 3C, and 3HC today, would your answers be the same?
Yes.
Are those answers true and correct to the best of your information, knowledge, and belief?
Yes.
Excuse me. Your Honor, I would offer Exhibits 2, 3P, 3C, and 3HC and tender the witness for cross-examination.
All right. Are there any objections to the admission of those documents? Hearing none, Exhibits 2, 3P, 3C, and 3HC are admitted into evidence. And Mr. Pringle, I'll turn the witness over to you.
Thank you, Judge. Good morning, Ms. Balkley.
Good morning.
Do you have your direct testimony in front of you?
I do.
Could you turn to page 3, please? And let me know when you're there.
I'm there.
And I am looking at lines 10 through 19. Do you see that?
I do.
All right, so just be clear, when calculating your return on equity, you did use a proxy group that included electric and natural gas utilities, correct?
That's correct.
And then, in your expert opinion, did you use those proxies due to equivalency and risk between electric, natural gas, and water sewer utilities?
Well, to be clear, the proxy group had to have water operations as well, right? For the
Yes,
electrics. Yes. So, and then I did use those as proxies. That's correct.
All right. And in your expert opinion, that is because there is similarity in risk?
Overall, yes. So it would have been transmission and distribution related.
Yes,
just
thank
to
you,
be
ma'am.
just to clarify.
And then, however, you do acknowledge, though, and I think you were kind of getting to that with the second part of your answer, that electric and natural gas utilities may face different risk profiles compared to water and sewer utilities?
Can you point to that in my testimony for me?
Oh, no, this is just a general question. Do you acknowledge that?
Well, I think there are no absolute proxies, but we aim to come up with a proxy group that is of reasonable size and generally comparable risk. And so the proxy companies that I relied on, for the electric companies, they needed to have water operations, and it was transmission and distribution only. And then the gas companies are distribution. So from that perspective, I considered them to be generally comparable. There is no perfect proxy, so there are obviously some differences in the risks, and my analysis also went through those risk factors. Yes.
So for the purposes of your proxy group, you do equate electric distribution, natural gas distribution, and water distribution?
It's not entirely true, as there's one electric company that's in the group that has water operations. So I wouldn't say that that's an entirely true statement. I did consider the distribution functions associated with the natural gas operations to be generally comparable to the water companies. And it's largely in order to try to get a large enough sample to not have one company unduly influence the results of the analysis. So.
And how many electric utilities did you include in your proxy group?
One that's part of the Value Line Universe of Electric Companies, yes.
And then also, when it comes to your analysis, do you rely upon the S&P 500?
I do.
And are you aware of any, any water or sewer utility that has been authorized an ROE of 10.75?
In the most recent year, no, but I think it would be important to take into consideration the weighted return. We've talked a lot this morning about, as well as the ROEs, and the equity ratios have been largely above 50% across the country.
And permission to approach?
Yes.
marked Staff Exhibit 228. And Ms. Bulkley, what I've handed you has been marked as Staff Exhibit 228. This is from the S&P Global Market Intelligence and then has to do with average ROEs and median ROEs granted across the country for water and sewer industries.
Yes, this would be a portion of that report, actually. This is not the complete report.
Well, yeah, this is the portion that I'll be asking you questions on. And looking at the average ROE for 2024, what is that number?
To be 9.56%.
And what is the median ROE for 2024?
9.6%.
And then what about for 2023, the average ROE?
9.64%.
And the median ROE for that same year?
9.57%. I would note the equity ratios on this as well as 51.69 and 52.53%.
Yeah, thank you for that,
as an
Ms.
average.
Bulkley.
Sure. And the RORs are important as well.
And then my final question for you today, do you agree that a higher equity ratio in the capital structure generally leads to higher costs for ratepayers?
Say that again for me?
Do you agree that a higher equity ratio in the capital structure generally leads to higher costs for ratepayers?
I think this is a tough statement to make in generalities.
Well, may it?
I'm sorry?
Could it cause a general increase in cost to ratepayers?
Possibly. I mean, it also depends on what the ability is to attract capital and at what terms. So I don't think that you can say necessarily that an increase in the equity ratio is an absolute increase in cost to customers. Certainly higher leverage comes with its own cost to customers in terms of higher debt costs and potentially concerns about attraction of capital at different points in the marketplace. So there is a trade-off between
And
equity and
based on
debt.
that answer, it sounds like also that you would say it would not, there's no way to actually say it would not lead to an increase in cost for ratepayers.
I can't say definitively that it would increase the costs to ratepayers.
Yeah, well, that, I have no further questions at this time, but staff would move to enter into the record Staff Exhibit 228.
Are there any objections?
No.
Thank you, Judge, and thank you for your time, Ms. Bulkley.
Sure.
All right. Exhibit 228 is admitted. All right, Mr. Kleiser, any questions on behalf of the Office of the Public Counsel?
No, thank you, Your Honor.
Any cross-examination by the other interveners in the case? Yes, Mr. Opitz.
Good morning, Ms. Bulkey. You were here for your counsel's opening statement on this issue, is that right?
I was, yes.
And do you recall that she had a comment about the national average ROE and that OPC was so many basis points below that average?
Yes, I do recall that.
What is that average for the national ROE average?
I think we've already talked about that in this cross-examination. So the average on this page is 9.6, as I indicated, with an equity ratio of 51.69.
And what is your recommended ROE average?
It is.
Your recommended ROE in this case, sorry.
Sure. My recommended ROE in this case, as I indicated, is it is 10.75%, but again, turning to page 42 of my rebuttal testimony, I think it's important to put in context what we're talking about with respect to the weighted returns. And when you look at the weighted return on that page on figure 10, you'd see that the company proposal, my proposal, including the company's equity ratio, is 5.42%. When you look at that in the context of the overall returns for the other American Water the regulated subsidiaries of American Water, it is well within the range of those weighted returns. And so the difference there is, and the staff in the OPC are down at 4.14% and 4.16%, well below the range for the other American Water subsidiaries. So I
Still,
think that's important.
Ms. Bulkey, still your recommendation. How many basis points above the national average is your recommendation?
On the ROE specifically, be slightly over 100.
And your recommended ROE would be the highest in the country that you'd be aware of this year?
Not taking into consideration the overall capitalization, which I think is a flaw. I don't think you can do that. I think when setting the ROE.
So
and
it
the
would
equity
be, is
ratio,
what you're saying?
the ROE by itself would be higher than other authorized ROEs, but as I indicated, the equity ratios are quite a bit higher. And so on balance.
I think you've answered my question. So following up on I guess, some hypothetical questions from staff counsel about the ROE leading to higher customer rates. Will your recommended ROE in this case lead to higher rates paid by customers?
I don't think that was actually the staff's question. It was with respect to the
Well, that's my
equity
question to you
ratio.
now. Will your recommended ROE in this case lead to higher rates for customers?
The calculation may lead to a higher rate. However, the access to capital may differ. And on an overall
So-
weighted basis, if I may finish my response, I think it would be well in line with the returns and the contribution to equity for the remainder of the American water system.
That's all the questions I have.
Mr. Kaufman, do you have questions?
Yes, a couple, thank you. Good morning, Ms. Mulkey.
Good morning.
John Kaufman on behalf of Consumers Council and AARP. I wanted to ask you a question about the interaction between your recommended ROE and other issues in the case. And in your rebuttal testimony, am I understanding correctly that you don't think that this commission should take into account whether or not it has an RSM or other mechanism in this case when deciding ROE?
Oh, that's not my testimony. I actually evaluated the testimony. If you look in my direct testimony, I evaluated the risk profile of the proxy group companies and concluded that the proxy group companies largely have revenue stabilization mechanisms. And in my rebuttal and surrebuttal testimony, I discuss other commissions that have made similar determinations that I have concluded in this testimony, based on the fact that the majority of the proxy group companies already have a revenue stabilization mechanism, that the effect of that revenue stabilization is already factored into the proxy group market data that we're using to establish the return estimates. And so because you've already factored that in, there is no need to make any additional adjustments to the ROE. It's already been established in the market data that we're using to estimate the cost of equity. And therefore, it does not need to be separately considered. And that actually has been discussed by many other regulatory commissions, and they've concluded the same thing.
So if this commission decides to grant the RSM mechanism that's proposed, will that make Missouri American Water Company a less risky company would it have less business risk as a utility?
It would have less upside and less downside.
Less upside and downside of what?
Of revenue, but it does not make it less risky relative to the proxy group, which is how we're determining the cost of equity.
Would it be more or less, would it have more or less business risk? That is, would Missouri American Water Company have more or less business risk than if it was granted the RSM or if it, compared to if it was not granted the RSM?
It would
this
have
case?
more stability than if it were not granted the RSM, but that's actually not the determining factor in considering the ROE. We're doing, the ROE is being set using a benchmarking group, and so it's very important to be evaluating the return on equity as compared to that group, to the extent that that group already has an RSM and already does have a more stabilized revenue. That's affected their market data. It affects their stock price, for example. which is used in the constant growth DCF. So it's already been included there. So the analysis of any one individual change to Missouri American's business risk in isolation would be a mistake in the consideration of the ROE, because what we're doing here is setting that using market data for a proxy group. We cannot then simply just look at Missouri American on its own without relationship to that group. That would be an error.
Ms. Bunkley, on page 131 to 132 of your rebuttal testimony, you claim, or you conclude, that the company has a moderately higher regulatory risk than the proxy group, given its lack of full fuel recovery and limitations on capital cost recovery. Let me ask you about the first one, full fuel cost recovery. And am I correct in assuming that that's because you're comparing this water company to a natural gas company, a fuel or like a purchase gas adjustment for a gas company?
Can you please point me to where you are in my testimony specifically, please?
Page 132, and it's also footnotes 219 and 220.
So I see the footnotes. Now, can I have your question again?
Yes, so in saying that that this company has more risk, you're comparing it to a natural gas company with a purchase gas adjustment.
Well, I'm comparing the
footnote
production
219.
costs. Yes, the production costs of the company to the purchase gas costs of the gas companies. Yep.
So wouldn't a purchase cost tracker have several different kinds of expenses, not just the commodity cost that a gas would have in a purchase gas adjustment?
Ask your question again?
The production cost tracker proposed in this case would cover more than just fuel cost, right?
And so does a purchase gas cost. It would cover all of the costs related to the acquisition of supply.
But isn't a purchase gas, a PGA or a purchase gas adjustment primarily the cost of the commodity of natural gas?
It would include other elements related to the purchase of the commodity. It would include the hedging costs associated with it. It would include various other costs associated with gas, not just the gas cost alone.
Okay. Well, let me ask you about the second part of your statement there, that you think that this company has higher regulatory risk, I guess, than the proxy group based on limitations on capital cost recovery. What are those limitations that you're referring to on capital cost recovery for this water utility?
I think that's discussed in the beginning of my testimony in direct, not in rebuttal. So let's go there. If you look to pages 54 and 55 of my direct testimony, in that particular section, I discuss the limitations associated with the WSIRA.
And what do you see as the significant limitations on that mechanism?
That it cannot exceed 15% of the total base revenue requirement approved by the commission.
Well, in that regard, did you see the slideshow presentation that the Office of Public Counsel just gave this
I
morning?
did not commit it to memory, if you'd like to.
Do you recall the slide where it showed the various infrastructure surcharges amongst American water affiliates?
I don't recall that. If you'd like to submit it, that'd be great.
May I approach?
This relates to American Water's other operating companies, not the proxy group. I'm not sure I'm following your comparison. As I just mentioned, all of the analysis that we're doing in this case is really with respect to the proxy group of companies. That's the market data that we're using to set the ROE. So there is no market data for Illinois American Water.
Well,
I'm
based
not
on
sure
the
how this
annual
relates.
Sorry, go ahead. Based on the annual revenue increases shown there, wouldn't you say that the Wasira in Missouri is much more generous than the other cost, the infrastructure surcharges for the affiliates, the other American water affiliates?
Well, I'll start by saying I didn't put this document together, so I'm not exactly sure that I can represent that anything in this document is accurate. I'm going to start there. But then I'm going to go back to my original response that none of this analysis is actually being, the market data that we're using is for the proxy group, not for the individual operating companies of American Water. So I'm not really sure, this is actually not at all part of my analysis, nor should it be, because what I should be doing in my analysis is comparing to the proxy group that I started with that is reasonably comparable, not the other affiliates of American Water for which I can get no market information.
Thank you. That's all I have.
Okay. Unfortunately, we are at a point where we need to break for the agenda meeting, and so if it's okay with, well, let's just reconvene at 12 noon. All right? 12 noon. So we're going off the record.
Good morning, everyone. It is 11 a.m. and Commissioner Mitchell, can you hear us?
Yes, I can hear you just fine.
All right, good morning. And we have Commissioners Kolkmeyer and Commissioner Coleman here in person, so all the commissioners are present, so we'll begin the agenda meeting for today, Wednesday, March 5th. I would ask those who are participating on the call to please mute your phone unless you need to speak. But before we get started with today's business, I would like to turn it over to Lloyd Wilson to introduce a new team member in Dana Cole.
Good morning, Commissioners. I am very proud to introduce to you Dana Cole. Dana joins us from the Office of Administration, where she was a purchasing supervisor, procurement supervisor, I think. She is here as a senior accountant, and she is going to replace Kim Sandbody, who, despite my hardest efforts to try to convince her otherwise, is going to retire at the end of this month. And so we strategically hired Dana to work alongside Kim through about a 6-week period, so she can learn those skills and help us out with our assessment and our accounting work. Dana lives in Holt Summit. She has an 18-year-old who's a senior in high school. She also has a 9-year-old. And so outside of work, that's what she does, is chases kids in sports and activities. So help me welcome Dana Cole.
Thank you. Welcome, Dana. Okay, today we do have 5 new orders and 1 other discussion item, but before we get to those, we do have minutes to approve from the February 27th, 2025 agenda. Commissioners, are there any changes or modifications to those minutes? Hearing none, all those in favor of approving those minutes, please say aye. Aye. Those opposed? By a vote of 5-0, those minutes are approved. First, 4-0. 4-0. Change is hard. Okay. First tariff in order today is in file number EF-2025-0135 in the matter of the application of Union Electric, DBA Ameren, Missouri, for an order authorizing the issue and sale of additional long-term indebtedness. On January 10th, Ameren filed an application requesting authority to issue and sell up to $500 million in aggregate principal amount of additional long-term indebtedness. Ameren stated in its application the purpose of this issuance is to refinance short-term debt and fund capital expenditures. Staff made a filing recommending the Commission approve the application subject to several conditions, including a condition that the Commission reserves the right to consider rate-making treatment of the financing transaction and its impact on cost of capital in future rate cases. Staff stated that Ameren's plan to replace existing short-term debt with long-term debt is expected to be not detrimental to ratepayers. Staff also verified that Ameren's projected capital expenditure plan supports the need for additional long-term debt. Ameren filed a response and stated it does not object to staff's recommended conditions. Thus, the order before us approves Ameren's application for authority to issue and sell the new indebtedness, subject to the conditions recommended by staff. With that, I recommend we approve the order version number 1. Commissioner Coleman.
I support the order.
Commissioner Kolkmeyer.
I support the order.
Commissioner Mitchell.
I support the order.
Thank you. All those in favor of approving this order, please say aye.
Aye.
Those opposed? By a vote of 4-0, that order is approved. Second tariff in order today is in file number GA-2025-0181 in the matter of the application of Spire, Missouri for a certificate of convenience and necessity to construct, install, own, operate, maintain, and otherwise control and manage a natural gas distribution system in Cedar County, Missouri as an expansion of its existing certificated area. On December 10th, Spire filed an application requesting permission and approval for a CCN to extend its existing certificated area to provide gas service in Cedar County. Spire also requested a waiver of the 60-day notice requirement. According to Spire's application, Spire was approached by a large customer requesting gas service for a new manufacturing facility. Extending service to this large customer also creates the potential for Spire to provide gas service to 6 additional residential customers who currently do not have gas service as an option. Staff made a filing recommending the Commission approve Spire's request, subject to a few recommended conditions. Staff stated it investigated Spire's request and finds that there is a need for the service. The Spire is financially able to provide the service, it's feasible, and that ultimately the proposal is in the public interest. Spire made a filing stating it agrees with staff's recommendation and accepts staff's recommended conditions. Therefore, the order before us grants Spire's request for a CCN, subject to staff's recommended conditions, and waives the Commission's 60-day notice requirement. With that, I recommend we approve the order, version number 1. Commissioner Coleman.
I support the order.
Commissioner Kolkmeyer.
I support the order.
Commissioner Mitchell.
I support the order.
All those in favor of approving this order, please say aye.
Aye.
Those opposed? By a vote of 4-0, that order is approved. The third tariff in order today is in file number GR-2025-0107. In the matter of Spire, Missouri, DBA Spire's request for authority to implement a general rate increase for natural gas service provided in the company's Missouri service areas. The order before us directs Spire, in the context of its rate case, to review its disconnections, reconnections, and customer notice policies. In this case, the Commission is simply wanting additional information. I recognize that disconnecting and reconnecting gas service presents health and safety issues, so I suspect Spire may have additional policies and procedures regarding service disconnections and reconnections, and can bring those to the Commission's attention in this case, as we've received some inquiries in our call center. So with that, I recommend we approve the order, version number 2. Commissioner Coleman.
Thank you, Madam Chair. I appreciate your comments regarding this because of the significant number of complaints that have been coming into our Consumer Services Department regarding disconnections at Spire and other concerns. So I'm looking forward to hearing from Spire as to them addressing these concerns. Thank you. I support the order.
Thank you, Commissioner Coleman. Commissioner Kolkmeyer.
I support the order.
Commissioner Mitchell.
I'm in support of the order.
All those in favor of approving this order, please say aye.
Aye.
Those opposed? By a vote of 4-0, that order is approved. Fourth tariff in order today is in file number EC-2025-0136, Meadows versus Grainbelt Express LLC. On October 15th, Ms. Meadows filed a complaint with the Commission against Grainbelt. Grainbelt filed a timely answer to the complaint and asserted that the complaint should be dismissed for failure to state a claim. Grainbelt argued that the complaint did not identify any law, rule, regulation, or Commission order that Grainbelt violated. Grainbelt also asserted that the complaint was a collateral attack on a Commission order. Staff made a filing and stated its investigation did not find that Grainbelt had violated any Commission rule, law, or tariff. Grainbelt then renewed its motion to dismiss that OPC responded to. OPC stated that it is in the public interest for the Commission to hear a complaint when the complainant explains, in practical terms, the basis for the complaint. The Commission then held a procedural conference to ask questions of the parties about Grainbelt's motion to dismiss. At that procedural conference, staff noted that while their report did not find that Grainbelt had committed any violations of the Commission's report and order or any other statute or Commission rule, it did believe that the complainant articulated a potential violation in alleging that Grainbelt has not followed 2 points of the Commission's report and order. Thus, the order before us denies that motion to dismiss, Grainbelt's motion to dismiss, and orders the parties to file a proposed procedural schedule in this case. With that, I recommend we approve the order, version number 1. Commissioner Coleman.
I support the order.
Commissioner Kolkmeyer.
I'm in support.
And Commissioner Mitchell.
I support the order.
All those in favor of approving this order, please say aye.
Aye.
Those opposed? By a vote of 4-0, that order is approved. The fifth tariff in order today is in file number ER-2024-0261, in the matter of the request of Empire District Electric Company, DBA Liberty, for authority to file tariffs increasing rates for electric service provided to customers in its Missouri service area. This order follows case discussion we had last week. On February 26th, Liberty withdrew its prior tariff sheets and resubmitted tariff sheets. These tariff sheets have a proposed effective date of March 28th. As discussed last week, the Commission intends to suspend these tariff sheets with additional time so that parties may have the appropriate time to review the case. The delay in the case totaled 89 days, so the order before us adds 89 days to the original suspension date and suspends these tariff sheets until January 2nd of 2026. The order also directs the parties to file an updated procedural schedule no later than March 26th. I think this does allow the case to move forward and ensures that parties will have enough time. With that, I recommend we approve the order version number 2. Commissioner Coleman.
I support the order.
Commissioner Kolkmeyer. Commissioner Mitchell.
I support the order.
All those in favor of approving this order, please say aye.
Aye.
Those opposed? By a vote of 4-0, that order is approved. That concludes the tariffs and new orders, so we're on to other discussion, and we do have a sunshine request for the release of information. So Judge Pridgeon, will you help walk us through this request?
Absolutely. Chair Hahn, Commissioners, good morning. I put this memo on to see how the Commission would like to proceed on Peter Joris's sunshine request. He's requested about 5 years' worth of incident reports from Evergy, and those incident reports are required to be filed by Chapter 3 of the Commission's rules, and they detail what happens if somebody has come into contact with an electrical line and been injured. According to the rule, these reports are confidential and to be treated as such under Chapter 386-480. And that means that this information cannot be released unless the Commission votes to do so. I contacted Roger Steiner, counsel from Evergy. He indicates that Evergy objects to the release of that information. And because of that, I would recommend the Commission vote to not release the information. And I believe that's all I have unless the Commission has questions.
Does any commissioner have a question?
Their objection is primarily based on ongoing or potential litigation. Is that fair to say?
Yes, sir, I believe that's true. I mean, Mr. Steiner said that in-house counsel assists with these reports, and they're certainly assembled with the eye of looking towards possible litigation. Yes, sir.
Thank you.
Additional questions? Great question. If we just don't release the information in response to Evergy, it's my understanding we actually don't have to take a vote. Is that correct?
That's correct. If there's no vote taken, then the records cannot be released. So it's up to you if you want to vote or if you just want to leave it.
I would entertain a motion to release the information. But I'm assuming that if there is no motion, then we would not release the information. Hearing no motion, the Commission would take no action to release the information. Okay, last item on the agenda today is for scheduling. So today we will continue our evidentiary hearing in case WR-2024-0320 in the matter of Missouri American Water Company's request for authority to implement a general rate increase for water and sewer service in this room with Judge Sire. This rate case will continue through, I think Tuesday is on the procedural schedule. Wednesday, March 19th, we'll have agenda at 11 a.m. Wednesday, March 26th, we'll have agenda at 11 a.m. And then Monday, March 17th through Friday, March 28th, we have an evidentiary hearing scheduled in case ER-2024-0319 in the matter of Ameren, Missouri's tariffs to adjust its revenues for electric service here in room 310 at 9 a.m. with Judge Clark. Commissioners, are there any changes or modifications to the schedule? Hearing none, any additional business coming before the commission this morning? Also hearing none. With that, we're adjourned, and it looks like we'll be back here at noon for the rate case. Thank you, everyone.
Thank you, Madam Chair.
Thank you.
Larry Plouffe, come up here, please. And Diana Carter.
Watch out. Commissioner Coleman likes the microphone.
All right, let's go back on the record. Ms. Bulkley is still on the stand, and if I recall correctly, I have not yet asked if there was any cross-examination for the city of Riverside. Okay. And then for Triumph or Public Water Supply District?
No cross by Triumph, thank you.
All right. Okay. Are there questions from the commissioners? All right. I am seeing and hearing none. Ms. Bulkley, I do have a few questions myself. If you could refer to your rebuttal testimony. On page 107, there is a figure 22.
Yes, I'm there.
Okay. And on that figure, you seem to indicate that most of Mr. Murray's cost of equity estimates are outside the zone of reasonableness. Would you agree that most of your recommended ROE range of 10.25% to 11.25% is also outside the zone of reasonableness?
Well, this zone of reasonableness is not what I would have established. So this is Mr. Murray's zone of reasonableness?
Huh? Okay.
But, so the point of this chart was just to say that the analysis that he's done essentially all falls below what he thinks is a reasonable range, and then he just comes up with a number that is his ROE that isn't really based on any of the results of his analyses. So the first column here is all of the cost of equity analyses that he's done that relies on, in some form, market data. But then he recommends a number that doesn't relate to the market data that he's developed.
Okay. Further in your testimony on page 131,
I'm there.
roughly around line 10, you use the term regulatory risk at the end of that sentence. What do you mean by regulatory risk?
So this is the characterization from Mr. Abbott and Mr. Murray, that they suggest that the RSM will reduce the company's risk. Probably should note back to their testimony where I have attempted to characterize what they've stated there. Generally speaking, their proposals were to suggest that with an RSM, the company would have less risk. And so maybe I haven't characterized that. It's not quoted, so maybe I've used the term regulatory risk to mean that. But that's kind of the point of this sentence, was to try to characterize what they were implying in their testimony, that the RSM would result in lower risk for the company. And as I mentioned earlier today, if there are many commissions that have looked at this as well over time, have looked at RSM mechanisms and how they would affect the ROE. One of the commission orders that I reference in my testimony is from the Maryland Commission, from a Baltimore Gas and Electric case that's probably 15 years old. And 15 years ago, they said, we used to think about RSMs as affecting the ROE, but because all of the proxy companies now have some form of RSM, we no longer think that it affects the ROE. And so there are other regulatory commissions in my testimony that I also reference that have come to similar conclusions, that because the proxy group, that was sort of the conversation we were having earlier today, because the proxy group companies all have some form of RSM, that it is already factored into the ROE.
Speaking of the proxy groups, do the companies in the proxy group that you studied have a mechanism similar to the WSIRA?
Some of them do,
Some of them
yes. So, yeah, so if you go to I've gone through this in my direct testimony. Let me just find the exhibit for you. This is Schedule AEB 9. So AEB 9 goes through the mechanisms that I looked at for each of the operating companies that is owned by the proxy group companies and whether or not they have a mechanism. And so the WSIRA, I would have compared to this column called Infrastructure Cost Recovery Mechanisms. And at the end of that schedule, AEB 9, page 2, 78% of the proxy group had something like the WSIRA.
Okay.
And
all right, thank you. All right. Chair Hahn has a question.
Out of curiosity, how many states do have an RSM for water utilities that's currently utilized? By any company in that state?
I can look through this chart. I have it for the proxy group. I don't necessarily have it for all states.
Yeah, I'm trying to understand the broader context because we are talking about ROE nationwide and you're talking about a proxy group. So I'm trying to understand the broader context of if you assumed RSM for all of those in the proxy group, but the national representative is different than what's in your proxy group. I'm trying to understand that better.
Yeah, so that's a great question. So there are we've looked at two different data sets here. In the conversation that we've had today, we've looked at overall authorized ROEs across the U.S., and we've looked at the data that we've been modeling for the proxy group companies. So the proxy group company data, I feel like, would reflect that, given that it's in their price determinations. And so in looking at this particular chart, 58% of the companies had some form of revenue stabilization for the proxy group. More broadly, I would say that RSM, I don't have the number for you for every state. I don't think I could say what percentage of the states, but overall, I would say RSM has become more commonly accepted across many regulatory jurisdictions. I mean, I've testified in probably 40 regulatory jurisdictions, and revenue stabilization has been part of many cases across those 40 jurisdictions, I would say. But I can't tell you specifically which states or how many are water-only RSM.
I guess for me, I'm trying to better understand your assumptions in the proxy group and compare that across all jurisdictions, because when I think about the ROE that you have developed from your proxy group, it does seem significantly outside of national average as presented by S&P and OPC. So I'm trying to understand how this happens.
Yeah, so I think there's a range. I mean, I do think the average is a representation of the central tendency in a range, but I wouldn't say that it's completely outside. So, and I do think it's important to consider the combination of the two, the equity ratio and the return.
And I did hear you mention that before, but to me, I keep hearing about the equity debt ratio and how that's more important when developing the ROE, but then ask the same questions about RSM, and it's somewhat discounted compared to the debt capital structure conversation when we're talking about ROE, but they both, everything factors in, but you keep coming back to the capital structure conversation, but there are also other factors. And so I'm just struggling with that.
Sure. So I do think there are other factors, and I have tried to include those in my analysis. So in looking at the proxy group, the analysis is largely based on the proxy group. That's where all of the ranges come from. And then when you look at that proxy group, I have looked at whether there's a WSERA type mechanism or a revenue stabilization mechanism. And I also have looked at what those equity ratios are. So I think in my rebuttal testimony, I think I'm looking at all of those things in the same way, right? What is the effect of greater or less leverage in the return calculation? That's our equity ratio, right? And then taking into consideration whether or not those proxy companies already have included some form of capital tracker, which would be picked up in the market data that we're using, the price data and the expectations of equity investors in terms of the ability to recover cost in between rate cases. And to some extent, the credit rating agencies, which all mention these mechanisms as being important tools, particularly with large capital programs, right? So they're sort of well-known tools that are being used in the industry today, particularly with the capital investment that we're seeing in all of the regulated companies. So I do think that they're all taken into consideration in the analysis of the proxy group. There is probably less, when you look at this subset of the RRA data that was presented to me earlier, it's missing those pieces. You can't tell from this what has a revenue stabilization mechanism or not, but you can at least look to see that when you're talking about returns, they are talking about them with respect to the overall return, the ROR, which takes into consideration the capitalization as well. So, but the piece that's missing from this particular analysis is what are the mechanisms, right?
Yeah, understood. Thank you.
Sure.
Okay. Any recross on behalf of the staff?
No recross, Judge. Thank you.
All right. Public counsel?
No, thank you, Your Honor.
Mr. Kaufman?
Yes, thank you. I just want to follow up on questions from Chair Hahn regarding the RSM. Would you agree with me that around the country, revenue stabilization mechanism has been applied to a variety of different types of mechanisms?
I'm not sure what you mean by applied to a variety of mechanisms. They're revenue stabilization. So I don't know what you mean by the mechanisms
Are
they're
you
applied to.
aware that there are formula rates in the state of Alabama, and they call that revenue stabilization mechanism?
Yes.
Is that included in your definition of RSM today in your testimony?
My analysis would include straight fixed variable, revenue stabilization. Let me just go to the analysis really quickly and show you what I've included.
Okay. When you say RSM, do you mean just a revenue decoupling mechanism? Or do you mean something broader than that?
Revenue stabilization and decoupling. So it's taking into consideration partial decoupling, full revenue, full decoupling, and straight fixed variable rate design, which is shown in Schedule AB9.
Well, straight fixed variable rate design is a rate design, right?
Well, straight fixed variable rate design recovers the fixed portion of the costs in a fixed charge and the variable portion in the variable charge so that it does stabilize.
So you include straight fixed variable rate design under your umbrella of RSM mechanisms?
In this schedule, yes, that's correct. And I note for each case where that is. So there is one in the analysis that I have conducted here. There is one jurisdiction for, out of the 23 jurisdictions I have looked at, there is one straight fixed variable rate design that would be considered part of the revenue stabilization.
And what state is that?
It is one one company within the state of Ohio. So that, it's not all companies in Ohio. It would be one operating company for NiSource out of all of the companies looked at.
But am I correct in assuming that you're not including formula rates as an RSM mechanism in your?
That's correct.
Okay. But given the fact that that label is applied to a variety of things that are not revenue decoupling, would you agree with me that it'd be difficult to get a definitive list of what states have RSM and what don't, and really be able to compare apples to apples?
Well,
because that term is so generic and applied to so many different things.
I think you would just define what they are, and I think you would look to each of the mechanisms. I mean, there are a lot of mechanisms for capital recovery too that all have different names in 50 states, right? They're named something different, but we look at each of them to figure out what it is they're actually, what the objective is of that mechanism. And then we characterize it based on the objective of the mechanism, not based on its title, right? So to the extent that the title isn't revenue stabilization, if it functions that way, we would characterize it that way.
And to be clear, for the record, for purposes of this case, your testimony, when it refers to RSM, essentially refers to mechanisms that, in some sense, decouple revenue from the rates.
In some sense, yes, in a variety of different operating. So they intend to stabilize the recovery of the fixed costs.
Right. So not necessarily every mechanism that is called an RSM mechanism around the country, but something that is revenue decoupling related is what is the definition you're using here today.
Well, so I've used very specific categories in the exhibit, right? And so those are the ones that I've looked at.
Make sure that I have, what is, and that's an exhibit to your direct testimony.
Right, and it's exhibit AAB 9.
9, okay, thank you. That's
Sure.
all I have. Thank you.
Thank you. Are there any other cross-examination questions by the other interveners? All right. All right. Ms. Close, do you have redirect?
Just briefly, Your Honor. Ms. Bulkley, you were asked before we went on our break about the presentation that had been made in the opening statements, and I think your response to the line of questioning on that presentation was that you didn't prepare the data, or that you couldn't tell if it was accurate. Do you recall that line of questioning?
I do, yes.
There's another slide that attributes some data to your name specifically. Can you speak to the accuracy of that data?
Yes, I can. So the presentation referred to my testimony that I provided in the Ameren case that was filed before this commission, and it indicated, the slide indicates that I made a recommendation of 10.25% for Ameren in that case, and the context that was placed around that slide when the presentation was given was that I attributed different risk to the two companies, and neither of those is accurate. I provided a range based on the analysis that I performed in that case, and the company selected their ROE. It's also reasonable and important to note that the equity ratio that they proposed in that case was 52%, so higher than the equity ratio that's being proposed in this case. And I continue to try to impress that it's important to look at the two together, that the leverage matters and it creates different risk that needs to be reflected in the ROE. And so I would say that the characterization of the testimony is incorrect, and then it is important to understand the context in which that 10.25% was requested by that company.
Thank you, Your Honor. Nothing further.
All right. Okay. Thank you for your testimony.
Thank you.
And according to the hearing schedule that I'm looking at, that would bring us to staff's witness, Kelly Malky.
Yes, Judge. Staff calls Ms. Malky to the stand. Also, due to the questioning about Ms. Bulkley's Ameren testimony, I would move for the commission to take administrative notice of her testimony in the Ameren rate case, ER 2024-0319.
Not my case. But I will let the judge in that case know about that. All right. Ms. Malky, would you raise your right hand, please? Do you swear or affirm that the testimony you give today in this hearing shall be the truth, the whole truth, and nothing but the truth?
I do.
All right, thank you.
May I proceed, Judge?
Sure.
Good morning, Ms. Well, good afternoon, Ms. Malky.
Good afternoon.
Please state and spell your name for the record.
Kelly Malky, Kellimalki.
Thank you, Ms. Malky. By whom are you employed and in what capacity?
I am employed by the Missouri Public Service Commission as a financial analyst.
And are you the same Kelly Malky who caused to file in these proceedings what has been pre-marked as Staff Exhibit 208, which is your public and confidential direct rebuttal testimony, as well as Staff Exhibit 220, the public and confidential copies of your cross-rebuttal and sur-rebuttal testimony?
I am.
At this time, do you have any corrections to make to either of those exhibits?
I do.
What are those corrections?
I have corrections to KMR1, columns D through L, KMR3, columns C, D, G, H, and I, columns KMR4, columns E, and rows 96 through 251 of column T, as well as table 4 on page 30 due to a transcription error.
And how were you aware of these corrections?
Ms. Bulkley in her testimony made me aware.
And you said these are transcription corrections?
Yes.
Did this have any substantive change to your testimony?
No.
Thank you, Ms. Malky.
Thank you.
And if I were to ask you the same questions within exhibits 208 and 220, would your answers be the same or substantively similar?
They would be.
And are your answers in exhibits 208 and 220 true and correct to the best of your knowledge and belief?
They are.
Thank you, Ms. Malky. And Judge Sire, we can file a corrected copy of Ms. Malky's direct rebuttal testimony or an errata sheet. I'd go whichever preference you would prefer for me to go through with entering it on the record.
If you could submit a corrected copy.
All right. Then at this time, staff moves to enter on the record what will be Exhibit 208, the corrected direct rebuttal testimony of Kelly Malky, public and confidential, and Exhibit 220, the cross-rebuttal and sur-rebuttal testimony of Kelly Malky, public and confidential.
Are there any objections to the admission of 208 and 220, both public and confidential versions?
Your Honor, I guess I have an objection to the timing on these corrections, only in the sense that petitioner has not had an opportunity to review them. I mean, we've been told now on the record the location of them, and I think staff has endeavored to get us copies, but there just has not been time to review those or see whether a response is needed to them. And so I think petitioner would need to reserve the opportunity to so respond.
Okay. Then at this time, I will hold off on ruling on the admission of those two exhibits. And
I do think it's only 208 had the corrections. There were no corrections to 220.
Gotcha. Is that fair to say, Ms. Close?
Yes.
Okay. Then I will admit Exhibit 220, and will reserve my ruling on Exhibit 208.
Thank you, Judge. At this time, staff tenders Ms. Malky for cross-examination.
All right. And will that be you, Ms. Close?
Yes, we don't have any cross-examination questions.
Mr. Kleiser?
All right. Yes, I have a couple. So good afternoon. Before I go anywhere else, I want to make sure I'm pronouncing your name correctly. It's Malky? Am I saying
Malky, yes.
Super, thank you. I just really briefly want to kind of touch on the different methodologies that are used, because I find this a fascinating subject and we don't really kind of get into the details on that. So correct me if I'm wrong here, but when it comes to ROR, witnesses usually are using one of three, maybe all three of these three methods I'm about to name, right? You have the discounted cash flow, or DCF, the capital asset pricing model, or CAPM or CAPM, and then you used a bond yield plus risk premium. Is that
Yes.
accurate?
Yes.
Now, that third one, am I correct in, I believe that you used all three, but you put more weight on the third one. Is that accurate?
Yes.
Yes. And just so we have a clear understanding of how that works, at a high level, a bond yield plus risk premium basically starts with you looking at what the interest rate would be on a bond comparable to the company that you're examining, and then adding on the risk premium that you would expect an equity investor would need to feel comfortable investing. Is that fairly accurate, or do you need to correct that?
It's fairly accurate.
Okay. Now, to your knowledge, like, did any of the other RR witnesses in this case really rely on that same methodology?
Not to my knowledge.
And that was kind of the impression that I got as well. So is it then safe to say that staff, and really the OPC for that matter, used different methodologies but got to a range that was about 25 basis points apart from the high and low ends?
Yeah.
Thank you. The only other thing I kind of want to touch on very briefly, there's obviously been a lot of discussion about proxy groups so far today. And I'm correct that staff took an issue with the proxy group that was employed by Missouri American Water in this case. Is that right?
Yes.
And specifically, I believe that in your direct rebuttal on page 35, you kind of outlined what your concerns are. Is that accurate?
Yes.
And again, based on what I'm reading here and based on what I'm seeing, it would appear that the proxy group that was employed by Ms. Bulkley, I hope I'm pronouncing her name correctly, was incorporated a large number of electric and gas utilities as well as actual water utilities. Is that accurate?
That is.
And would you characterize that as being at least one of the primary concerns you have with the way the proxy group was formed?
Yes.
You would agree with me that gas and electric utilities generally trade at a higher premium than electric? No, other way around. Sorry. Gas and electric companies trade at a lower premium than water companies.
To my knowledge.
Right. So, you know, we would expect, obviously, for them to have a higher ROE or higher return on equity than corresponding water groups.
Yes, that's typically what I've seen.
And so, just to completely draw this to a close, the inclusion of gas or water electricities in a proxy group is more likely to skew the overall return on equity upwards. Is that your conclusion?
Yes.
And then this might be a bit of a long shot. Did you review the direct and rebuttal testimony of Mr. David Murray?
Yes.
You happen to have a copy of it in front of you?
I do believe so. I do. Let me get to it. Okay.
Oh.
John, did you say Dave's direct?
Direct rebuttal, remember, because we got the... I'm going to hand this out. I'm not asking it to be marked as an exhibit because it's a page from an already pre-marked exhibit, if you follow what I'm saying there. So I'm just handing it out so that everybody has a copy in front of them. Nobody has to go rifling through things. All right, so what I never actually handed one to you, but you should have in front of you a copy of page 63 of Mr. Murray's direct rebuttal testimony, which I should have handed a copy out to everyone. Do you have that in front of you?
Yes.
Okay. So at the top of that page, there's a graph that Mr. Murray has included where he has sort of compared the water utilities and non-water utilities of Ms. Bulkley's disaggregated proxy group on the price to earnings ratio. Would you agree with me?
Mm-hmm.
And again, this just reaffirms what we've been discussing here momentarily, the idea that non-water utilities are going to be trading at a much lower price to earnings ratio than the water utilities, which would again correspond to a higher expected cost of equity or return on equity component.
Your Honor, I just want to interject an objection. All of these questions are extremely leading and/or supplementing testimony by virtue of counsel testifying.
Well, I mean,
It's closed cross-examination.
right. So,
It's cross-examination that isn't really being characterized as cross-examination. It's friendly cross.
I'll overrule the objection.
I forgot what my question was. I'm going to try and paraphrase it and simply, and then I think I'm going to be done afterwards. But you would
Okay.
agree with me that this graph is effectively demonstrating what we had discussed earlier regarding the fact that water utilities are traded at a higher premium. They have a higher price to earnings ratio than non-water utilities.
I would say that is what this graph shows.
And that's all I'm going to ask for right now. All right. I have no further questions. Thank you.
Mr. Kaufman, any questions?
No, thank you.
Mr. Bednar? All right. And Mr. Opitz? All right. Any questions from the other interveners? All right. Questions from Chair Hahn?
Yeah, just one.
Okay.
So in a case that we had, I think, last year with Confluence Reverse or CSWR, the commission imputed a hypothetical capital structure.
Yes.
Are you familiar with that case?
I am not in-depthly familiar, but I do have knowledge of the case and an
Okay.
understanding of it.
Great. Can you just help me understand why, is this case significantly different where there's capital structures here, none of which are imputed? Can you help me understand or differentiate staff's recommendation in that case compared to this case?
So in that case, the parent company has a very, very large equity ratio, and the subsidiary themselves, which was the case in question, their capital ratios were proving to be very volatile over time just because of how they do business. Their business practice is to acquire small distressed water companies and incorporate it into them, so it caused a lot more volatility. So a hypothetical was deemed to be the best option for them at that time.
That is really helpful. Can you also then maybe tell me when it may not be appropriate to use the parent company's capital structure?
So typically we wouldn't use it if it was like a basically financially standalone company. Like if they were independent, we definitely would not use the parent company at all. But it's each case is a case-by-case basis. We judge it off of kind of multiple factors to see what would be best for that company.
Okay, thank you so much.
Thank you.
All right. Are there any other commissioner questions? All right. Ms. Malky, I do have some questions myself.
Okay.
And I'm going to direct your attention to page 29 of your direct and rebuttal testimony.
Okay. Let me skip there.
Are you there?
I am.
Okay. At the bottom of that page, there's a sentence that starts, staff notes that it is not always appropriate to use the parent company's cost of common equity if the parent company's risk profile is significantly different from that of its regulated subsidiaries. In that statement, are you referring to the equity portion of the capital structure or the cost of equity when you state the parent company's cost of common equity?
The cost.
Okay. Can you explain when it would not be appropriate to use the parent company's capital structure for rate-making purposes?
When it would not be
Not.
appropriate? So typically, staff uses guidance, as I had in my, I put it in my my cross-rebuttal, rebuttal testimony. Staff, in order to determine whether to use the parent company or the subsidiaries, uses the guidance put out by SERFA that was included in the Cost of Capital Practitioner's Guide. In this guidance, it's on page 4 of my cross-rebuttal, rebuttal testimony, if you'd like to take a look. It basically lays out 4 reasons on whether or not to use the parent company or the subsidiary. So it's whether the subsidiary utility obtains all of its capital from its parent or issues its own debt and preferred stock, whether the parent guarantees any of the securities issued by the subsidiary, whether the subsidiary's capital structure is independent of its parent, and whether the parent or consolidated enterprise is diversified into non-utility operations. And again, this is directly from the Cost of Capital Practitioner's Guide prepared for SERFA by David C. Purcell.
Okay. Let me shift gears just a little bit, and
Okay.
let me ask you this question. If the and the topic is the RSM.
Mm-hmm.
So if the commission were to approve an RSM for the company, are there any adjustments that staff would propose to either the capital structure or the ROR?
That is outside of my area of expertise, but if you would like to talk with Staff Witness Abbott, I believe he can help you more than I would be able to with that.
Okay. All right. And then I have one final question.
Okay.
The cost of long-term debt, will staff update the cost of long-term debt for the true-up in this case?
We do plan to.
Okay. Do you have any indication of what that number will be?
I believe, if I remember correctly, it is not too far off from what staff has already recommended. I believe the numbers with true-up stayed fairly consistent.
Okay.
With minor changes.
Okay. All right, thank you. Any recross on behalf of the company?
No, Your Honor.
OPC?
Yes, if I could. Obviously, you were asked several questions about these 4 factors, and I just want to, again, complete that circle. Let's just run through them really quick and see where they land on each of these, because I want to make sure this is very clear. So the first one you mentioned, and again, I'm reading from page 4 of your rebuttal, whether the subsidiary utility obtains all of its capital from its parent or issues its own debt and preferred stock. Again, I don't want to have the risk of friendly cross here, but just to make clear, outside of the legacy mortgages that was kind of discussed currently, Missouri American Water is covering all of its capital through its parent company. Is that right?
To my understanding.
Correct. And the second one is whether the parent guarantees any of the securities issued by the subsidiary. Now, this is a bit of a tricky one in this situation because is it correct that all of the debt being issued is being issued on behalf of the parent company, well, not the parent company, but the entity as a whole, effectively?
So staff did actually ask this as a part of a DR request. I believe it was DR 37.1. And the response indicated when staff asked if the funds were guaranteed by AWCC, they indicated a support agreement exists between AWCC and AWCC, but AWWC does not guarantee the funds.
Well, this is a very easier one to say it then. Missouri American Water isn't issuing any of its own debt itself, correct?
For the most part.
So if there's nothing there to be issued, there's no way that you can have a security guarantee effectively.
Your Honor, I'm gonna renew my objection that counsel seems to be testifying and restating things in a way that the witness hasn't even stated them.
May I respond? Okay, again, this is cross-examination. It's designed to be yes or no questions. I mean, this is how cross-examination works. As to the idea of friendly cross, every party has an opportunity to build their case. Whether they're using that through a witness that agrees with their position or not is not a justifiable reason for an objection.
All right. Would you like to respond, Ms. Close?
I would just respond that I believe what is occurring during the leading questions is a mischaracterization of testimony. That's the fundamental crux of my objection.
And if I may weigh in, I would say, you know, the witness is not OPC's witness, and if it's mischaracterizing their testimony, they're on the stand to weigh in on whether it's mischaracterizing it or not.
Right. And for the sake of the record, that was Mr. Opitz.
And from staff's perspective, Judge, I don't believe there is mischaracterization of the witness's testimony.
Understood. All right. I'll overrule the objection, and you can continue, Mr. Kleiser.
The third issue was whether the subsidiary's capital structure is independent of its parents. I don't know that I can actually ask this one in a yes or no question, to be completely honest, so I'm going to leave it alone. And the fourth one is whether the parent or consolidated enterprise is diversitized into non-utility operations. You would agree with me that Missouri American Water's parent, American Water Works Company, is not diversified into other operations outside of regulated utility service.
Not to my knowledge.
All right, thank you. That was the extent of my recross.
All right.
Actually, sorry, one last question. So, and I want to make sure for the record, that is why staff reaches on the totality of those considerations, you reach the conclusion that the parent company's capital structure should be considered in this case. Is that
That
accurate?
is a big factor in it, yes.
All right, thank you. No further questions.
Thank you. Is there any recross by any of the other parties? All right. Ms. Close, do you have redirect?
No, Your Honor.
This is staff's witness, Judge.
Oh, I'm sorry. Mr. Pringle, do you have redirect?
One moment. No redirect, Judge, but I would kind of like to revisit, though, because this is Ms. Malky's only time taking the stand in these proceedings, and typically we do enter the testimony on before they are dismissed from the proceedings. I know you said you wanted to reserve your ruling, but the company had no cross-examination questions on these corrections, so I would believe now is the proper time to enter the corrected testimony on the record.
Right.
Your Honor, the company has not had a chance to review the corrections, and that's why we don't have any cross-examination prepared for them.
So with that, Mr. Pringle, I will still reserve my ruling on that.
And then just try to make sure Ms. Malky is available for recall if needed.
Yeah, that's fine.
All right.
Okay. You can step down. Thank you.
Thank you.
You
I made a
missing
slight
witness, don't
tactical.
you?
I made a slight tactical error. I thought there might be redirect, and I told him he could go run and get his water cup refilled. He should be back in only a couple of minutes, I hope. My apologies. I think he's just filling up his water. Really expected there to be a slightly longer delay.
All right, let's go off the record.
the Office of Public Counsel would call David Murray.
All right. Mr. Murray, welcome back to the hearing.
Thank you. I'm sorry. I needed some water.
You've got your right hand raised. Do you swear or affirm that the testimony you give today in this hearing shall be the truth, the whole truth, and nothing but the truth?
I do.
All right, thank you.
Mr. Murray, can you state and spell your name for the record?
My name is David Murray, last name spelled M-U-R-R-A-Y.
And by whom are you employed?
The Office of the Public Counsel for the State of Missouri.
And have you prepared or caused to be prepared testimony that's been pre-marked as 300 and 301, referring to the direct rebuttal testimony and cross rebuttal testimony, respectively?
Yes.
And are the answers contained in those pre-filed testimony? Well, let's start with, do you have any corrections to make?
Now, I apologize. I do have a correction to schedule DMD7. And recognize this when I was looking at true-up numbers. When I provided an average capital structure, 5-quarter capital structure for Missouri American for the quarterly periods 12/31/2022 through 12/31/2023, the average figures were pulled from the wrong numbers. It may be easier to go ahead and so I can go through this as far as submitting it. I apologize, it wasn't until I looked at the true-up numbers. But the average common equity balance, instead of $1,003,840,000.2, I think this is going to be easier for us to submit it. But anyway, should have been 1.299 billion. 985,000.2. The average long-term debt balance should have been 1.189 billion 424 instead of the 943,892.8, and the short-term debt balance should have been 71,825,800 instead of 31,337,800, and that affected each of those percentages of the capital structure ratios. The average common equity ratio with short-term debt should be 50.76% instead of 50.74. The average long-term debt should be 46.44% instead of the 47.66. The average short-term debt ratio should be 2.8% instead of 1.6%. And when excluding short-term debt, the average common equity ratio should be 52.22% instead of 51.58%, and the average long-term debt ratio should be 47.78% instead of 48.42%. Again, I apologize. I didn't catch that until I just looked at some true-up figures just recently.
Just to clarify, that was Schedule DM-D-7.
Yes.
And that would mean that it's the Schedule 7 of your direct testimony, correct?
That is correct.
Your Honor, given the amount of numerical changes that was just listed, the OPC will file an updated version of this particular schedule just as soon as I am able. I apologize. I did not realize the extent of the changes prior to that. Barring those changes made to that schedule, are there any other changes that you wish to make to your testimony?
There is not.
And again, barring those changes, is the rest of your testimony true and correct to the best of your knowledge and belief?
It is.
And if I were to ask you the same questions posed in your testimony today, your answers would be the same or substantially similar?
Yes.
All right. In that case, I would move for the admission of OPC Exhibits 300, the direct rebuttal testimony of David Murray, and 301, the cross rebuttal testimony of David Murray. I would also note, Judge, in the past, the Commission has ruled differently on whether they want things marked public, confidential, or highly confidential. Both versions of that include public, confidential, and highly confidential versions. I am listing them just by their numbers, 300 and 301. If you would like me to do something differently, please let me know.
No, that's fine. And and I lost track of what the schedule number was, but
Schedule DM-D-7, which would be Schedule 7 attached to the direct rebuttal testimony. I will file an updated version of that as soon as possible.
Okay. So is there any objection to admission of Exhibits 300 and 301?
Your Honor, may I just ask a clarifying question? Is the changes that you alluded to are solely in the average column, in that the math to the left of that average column would yield the changes you just read off?
It's not the math. I actually pulled, whenever I prepared the schedule, I looked at capital structures as well as the 5-quarter 2022 to 2023. I looked at previous capital structures. It was already in my Excel file. I hid those. I just did a hide function, and I didn't realize that my averaging function did not draw from the correct cells.
Okay. Thank you. No objection, Your Honor.
All right. Then I will admit Exhibit 300 and Exhibit 301.
Just for the sake of the record, when we file the updated schedule, is that to be considered a modification of the existing Exhibit 300, or do you want me to give that its own exhibit number? I'm sorry to cause you problems. I want to make sure I get this right.
I would prefer to replace the original.
That is how I will operate unless somebody wants to object. With that in mind, then, I will tend to the witness for cross-examination.
All right. Mr. Kaufman, do you have cross-examination?
No questions, Your Honor.
All right. Mr. Bednar?
No questions, Your Honor.
Any on behalf of Liberty? On behalf of MECG?
No, thank you, Your Honor.
All right. Public Water Supply District? And Triumph Foods?
No, thank you, Your Honor.
All right. Mr. Pringle, any on behalf of staff?
Yes, Judge, thank you. Good afternoon, Mr. Murray.
Good afternoon, Mr. Pringle.
And were you present when Mr. Furia was on the stand for Missouri American Water Company?
I was present, yes.
Did you hear him, did you hear his definition of double leverage?
Yes.
Did you hear his definition of equity infusion?
Yes.
Did you hear him state that the company simply can't trace these infusions?
I recall that line of questioning, yes.
Do you agree with that?
It's, as far as tracing it dollar for dollar, good luck. I mean, yeah, I think that that's a very difficult thing to do, and I wouldn't expect anybody to be able to trace that. And I think that's one of the problems here, as far as, what's the proper capital structure and what's the proper cost of debt. Because, there's some subjectivity to it. But the biggest thing, it was in the 2022 rate case, and American Water was more leveraged. It actually got to a common equity ratio of slightly below 40%. And, and all of its subsidiaries, including Missouri American, continue to have, at least maintaining their common equity ratio, or in some states actually increasing their common equity ratios, while American Water was becoming more and more leveraged when we had extremely low cost of debt through 2020. And so, anyway, for about 10 years, and this goes back a ways, because American Water was taken private for a while by RWE, but whenever they went public again, there was about a 10-year period where they didn't issue any sizable common equity whatsoever. So there's only one way that those equity contributions, as Mr. Fury said, infusions, contributions, whatever you want to characterize it. There was really only one main source of funds, and that was the AWCC debt being loaned to American Water.
Thank you, Mr. Murray. No further questions, Judge.
All right. Ms. Close?
No questions, Your Honor.
Are there any questions from the commissioners?
Just one from Commissioner Mitchell. So why would the cost of debt issued from AWCC to the subsidiaries, why would those costs vary to each subsidiary? Or why wouldn't they just be the same as what AWCC is issuing the debt for?
Well, and that's, yeah, my understanding of the way the way American Water operates its treasury is as a company such as Missouri American is making capital expenditures, they need capital infusions, and I think there's, I have a schedule attached to my testimony, but that shows that, that Missouri American say it needs $300 million of equity and $300 million of debt in the past year. And so they'll just infuse, that equity and that debt. And so whatever debt they had recently issued, American Water Capital Corporation, that is, they definitely try to, get something that's in close proximity as far as, and they assign the same terms as the underlying debt instrument. But but I consider that whether it's, I'm not, as far as the American Water, cost of debt, I do think that there is, obviously an effort to, to lend the lower cost of debt that AWCC issues to American Water for purposes of its infusion of common equity into its subsidiaries. So that's why when you include that debt that's not assigned to the subsidiaries, it brings the overall AWCC portfolio cost debt down to what I have is 4.13%. But that is the reason why it's different. And I don't know what all the other subsidiaries' cost of debt are. I mean, I tried to look at that, but the Missouri American didn't want to provide financial statements for the other subsidiaries. But the reason why is probably just purely due to timing of the need for capital for each of those subsidiaries, and then they assign and they execute affiliate notes when that capital is transferred.
Thanks. And do you know if American Water places or acquires debt outside of AWCC?
American Water does not. The subsidiaries do. Most of your subsidiaries are going to try to take advantage of the state revolving fund. Thank you. Thanks for completing that. And that's true in other states as well.
Okay, thank you.
All right. Okay, Ms. Murray, I do have some questions myself. In your direct / rebuttal testimony, you provide two methods to adjust the rate of return if the commission were to approve an RSM. The first method is to adjust the equity ratio in the capital structure, and the second is to adjust the allowed ROE. Is that fair to say?
Page 74, and I'm just trying to make sure I'm on the same page with you. Page 74 and 75 of my direct rebuttal testimony.
I believe so.
Yes. I discuss two methods, and then I ultimately, suggest that I believe the best approach is to recognize the additional debt capacity that lower business risk, would allow.
Okay. For the first method, you provide the commission a step-by-step guideline to adjust the equity ratio, which your calculation results in an 11-point basis reduction to rate of return. Is that correct?
I don't believe did I quantify that? Let me just take as far as in basis points.
While he's in the process of doing this, is this page 74 and 75 of his direct rebuttal, correct?
Yes.
Yeah, I just wanted to note that there was some marked confidential information there, and just reminding the witness to please ensure that we are not breaching confidentiality in answering questions.
Yeah, I'm not seeing where I quantified it in basis points. On the bottom of page 75, which is not confidential, I indicated that if the lower business risk was, recognized by specifically S&P, discussing some of their different benchmark tables, that I would recommend the revenue requirement be lowered by 4.6 million. I believe the 11% that you're referring to is my discussion of what is a credit metric referred to as the funds from operations to debt ratio that rating agencies evaluate when assigning credit ratings.
If the commission were to decide an adjustment to ROE is justified, could that same step-by-step guideline be used by the commission?
It's, this is where I'm going to give my discipline kind of I'm going to, I don't know, give us a little bit of a bad reputation. It's somewhat subjective. I mean, as far as, how much to adjust in ROE. I mean, what I was trying to do was rely on a third party, and I know I'm explaining a little bit more as to why, I didn't necessarily want to go the ROE route, but I knew that there was a third party, the rating agency, that said if you have low business risk, we allow you to have more debt in your capital structure and maintain the same credit rating. But you could, I mean, the way I have done it in the past, when I've looked at mechanisms that, hypothetically, because Missouri American is not publicly rated as far as by the credit rating agencies, but if you just want to assume that could possibly result in a one-notch improvement in the credit rating, say goes from A minus to A, you could look at bond yield, and that's the cost of bonds, that's cost of debt, but that could be used as a proxy for an adjustment to the cost of equity. I've done that before, but I because of the information that Missouri American apparently had gone out and received from the rating agencies for a private monitored rating, I thought, this makes sense. Let's use this.
Excuse me. Earlier during Ms. Malky's testimony, I had a question to her about a statement in her testimony where it says that staff notes that it's not always appropriate to use the parent company's cost of common equity if the parent company's risk profile is significantly different from that of its regulated subsidiaries. Do you agree with that statement?
Well, and I'll use an example that this commission is going to deal with or may deal with. Algonquin Power and Utility Company is a troubled parent company that has financial strain and additional risks that are affecting its, in my opinion, affecting its cost of capital, even its cost of debt. And in that situation, because it has nothing to do with the regulated utility business risk, I would think it would be entirely unfair and unacceptable to suggest that the parent company's capital structure or the parent company's cost of capital should be used, because its business risk is not based on the regulated utilities. American Water is predominantly a pure play regulated utility, and this water and sewer, or water wastewater, I guess more appropriately. But in a situation where the parent company is more or less a pure play, what we refer to it as, concentrated in the operations of the subsidiary, the business risk should not be that much different, other than it being a bigger, owning more water and sewer utilities and it being having more assets.
To your knowledge, has the commission authorized a standalone capital structure in any previous rate cases?
Yes, the commission is very clear, even though I have not agreed and made different recommendations, but Spire, Missouri, Ameren, Missouri, Evergy, well, I don't know if you had did you make but the companies that are similar to Spire, Missouri, which the commission did adopt the subsidiary capital structure, the other companies that are similar to Spire, Missouri are Ameren, Missouri, Evergy Metro, Evergy Missouri West. They issue their own long-term debt. They have they're assigned a credit rating. There's no some are less integrated than others, but they essentially have the same corporate structure. So yes, in that situation, the commission has said we're adopting Spire, Missouri's subsidiary capital structure.
And was the rationale by the commission similar in all those cases?
Well, I backed up because I couldn't remember if Ameren, Missouri, we've settled a lot of their cases recently, so it's been a while, and the cases that were litigated were probably over 10, 15 years ago, and Ameren didn't issue holding company debt at the time. So, we didn't have, at least in my my opinion was that it didn't need to push back much because they weren't using the leverage at the holding company to boost their returns. But, and the same thing with Great Plains Energy. These companies are going through changes in strategies and financing approaches as they merge. Evergy is a great example. Before Great Plains Energy and Westar merged, Great Plains Energy owned Kansas City Power and Light and KCPL, Greater Missouri Operations. But Great Plains Energy didn't issue any holding company debt. And so the capital structure of the subsidiary and the holding and the consolidated were fairly similar. So it's ever change. I mean, it's a changing situation. Spire does have quite a bit of holding company debt.
I'm going to refer you to your direct and rebuttal testimony on page 5.
I'm there.
All right. In your final answer on that page, you make reference to a report from the Regulatory Research Association. You've got it footnoted down there. And this report, though, it contains water rate case decisions through the third quarter of 2024, correct?
Yes.
All right. Do you happen to have that report with you today?
I do not have it with me, but I could easily get it for you. I'm sorry, I don't have it with me.
Is that well, let me ask you this. Has that report been updated to include water
Fourth
rate?
quarter?
Yes.
It
for the
has.
fourth
And
quarter.
my attorney, Mr. Kleiser,
I will offer that on redirect, per the commission's request, I can move to introduce what I believe to be the most current version of that report.
Okay. Yes, that was going to be my next question. And that is all the questions I have.
thank you, Judge.
Any recross from staff?
No, Judge, thank you.
From public counsel? Oh, I'm sorry. Mr. Kaufman, any recross?
No questions.
Okay. Mr. Bednar?
No question.
Mr. Opitz is shaking his head. And any redirect, Mr. Kleiser? Oh, I'm sorry. I left.
It's all right. We do not have any more recross.
Okay.
Yes, and starting backwards, I'm hoping that this answers the question that you just posed. So I will, I guess, move to mark. This should be 315, I think. First of our non.
Yes, that would be correct.
Mr. Murray, do you have a copy of what in front of you has been not pre-marked, but has now been marked as OPC Exhibit 315?
I do.
And is this document familiar to you?
It is.
Can you please explain to me what this document is?
This is a Regulatory Research Associates, which is now an offering of S&P Global Capital IQ, but it provides a quarterly update of average authorized returns for water utility companies in the United States for 2024.
And so pursuant to the bench questions that were just posed to you, is it accurate to say that this is the more updated version of the report referenced in footnote 5 of page 5 of your direct rebuttal testimony.
It is. This is dated February 13th, 2025. That was dated November 21st, 2024.
All right, I will go ahead and move to omit OPC Exhibit 315.
Any objections? 315 is omitted.
Now, Your Honor, you didn't have any additional questions as it related to this. You were just looking for an updated version, so I'm going to refrain from asking additional questions as to it as well. Just put it in there for the sake of your request.
All right.
Mr. Murray, do you recall being asked a question regarding when the commission had approved a standalone capital structure?
Yes.
And sort of you listed off obviously several utilities in answering that question. Do you recall what the staff's position is in the cases that you were referencing where the commission did adopt a standalone capital structure? What the staff's recommendation was?
I think, if I remember, the staff, once the commission provided its decision in the Spire, Missouri case in 2017, if I recall correctly, the staff, I think I was working for the staff for a while after that. I think I came over to public counsel in 2019. But, yeah, I think the general policy for staff was that if the commission had made a decision, unless we had, other evidence to provide, that would, maybe sway them the other way, that, that they follow the commission's, I guess, rationale, which is what the staff has been doing, and I understand that.
Let me ask a different question. There was discussion earlier regarding the 4 factors that staff relies on. How would you interpret those 4 factors in the cases in which the commission has ordered a standalone capital structure?
I mean, yeah, some of them obviously issuing their own long-term debt is one of the primary factors for Spire, Missouri, and for those other companies that have the same corporate structure. The guarantee of the debt, I said I have a dispute on that because actually it's the regulated utility subsidiaries are the ones that provide the credit quality that make it possible for holding companies to issue capital. So I kind of question whether or not that's interpreted correctly. But as far as the guarantee, yeah, I mean, if you just say that they don't guarantee, yes, they don't guarantee, the parent company does not guarantee the subsidiary's debt. That's true. What does it mean? But anyway, but those factors are not in play here. This case is more like Liberty Utilities. I just talked about Algonquin. And the reason why I want to bring that up is because Liberty Utilities it's a finance subsidiary for all of its regulated United States subsidiaries, regulated utilities, and it does the same thing. And in those cases, the commission has adopted the LUCO capital structure, not the subsidiary's capital structure.
Just to follow up on that, for the sake of the record, what is LUCO?
Oh, sorry. I'm sorry. Liberty Utilities Company.
Okay, and just as another reminder, I believe a Liberty Utilities case is currently pending, so please be mindful about discussing a pending case. Moving up further on, you were asked a quick question, I think, regarding the business risk and sort of the differences in the business risk between the Missouri American Water and its parent company, American Water Works Company. Do you recall that?
Yes.
And just to clarify and make sure that I heard you correctly, how does the difference in business risk affect your recommendation with regard to the capital structure in this case?
That's what prompts me to consider and consider it appropriate to recommend a more leveraged capital structure akin to the way American Water is capitalizing its investment in its subsidiaries. The rating agencies allow relaxed credit metric thresholds for water utilities because they recognize them as having quote-unquote low volatility financial performance. And so American Water is able to take advantage of that and have a very leveraged capital structure. Like I said, they expressly target that they are fine with going up to 40% or as down as low as 40% common equity, and yet they still maintain an A credit rating. And there's one reason for that, and that's because water utilities are compared to lower volatility credit metric tables. Rating agencies say that this is a very low business risk industry. You can take on more debt. And so, but American Water is just a compilation. It's a portfolio of all their water utilities. That's all there is to it.
You were asked a question by Commissioner Mitchell regarding the assignment of
of the debt, the mechanism by which the parent company sort of funds the operation. Do you recall that line of questioning?
Yes.
And I think you answered the question, but I want to make sure the record is very clear on this. Can you please very briefly explain how exactly the debt is assigned? How do they make the decision where debt costs are flown?
Well, I can't tell you exactly how the company decides, the Treasury decides how they assign it. I can just tell you that more of the shorter tenor debt is assigned to American Water, which has it's in my testimony, a weighted average maturity of 7 years. And the longer tenor debt, at least for Missouri American, because that's the only subsidiary I've been able to look at, because that's the only information I've been provided, has a 15-year weighted average maturity. So other than knowing that the longer tenor debt is assigned to Missouri American and shorter tenor debt is assigned to American Water, I don't know other than whenever they need capital, whatever debt they've recently issued is at AWCC is likely to be the terms assigned to that affiliate note. But I don't know their exact process. I don't know the inner workings. I don't work there.
Fair enough. You were asked a series of questions from counsel for the commission staff. You were asked at one point, do you recall those line of questioning? Let me start there.
Yes.
And one of the questions there had concerned, the definition of double leveraging. Do you recall that?
Yes.
For the sake of the record and my brief, can you give me a working definition of what double leverage means?
I mean, at the very basic level, double leverage is simply a holding company issuing debt and a subsidiary issuing debt. Now, a more refined definition that some people get hung up on, and I don't think you need to get hung up on, because it really just matters as to what, how much leverage the consolidated enterprise, knows it can incur and still maintain an investment-grade credit rating, regardless of whether or not those funds are used to buy the equity in the subsidiary. I mean, one of the things that's happened here recently is Missouri American has not been, distributing a dividend up to American Water. Well, how does American Water fund its dividend then? It issues more holding company debt capital. And so that's just an internal financial strategy decision. It does not mean that Missouri American could not have the debt capital issued at their level if they were like Spire, Missouri, and Amber, Missouri. But anyway, but the double leverage. Some people get very strict and limited in saying that double leverage is only when you issue debt specifically to buy equity in the subsidiary. There are many ways you can move things around.
So just to confirm, in your professional opinion, do you believe double leveraging is occurring in this the specific situation of Missouri American Water?
Yes, but it's all affiliate notes.
All right, I have no further redirect. Thank you very much.
All right. Thank you, Mr. Murray.
Thank you.
Judge, quick poll. Can I confirm that 300 and 301 was received into the record?
That is correct.
Thank you.
And Judge, I'd like to just request a brief recess. Staff needs to do some musical chairs and get the right people in here for the next issue.
All right. 10 minutes enough?
And before we do go off the record too, would you like for me to file the corrected testimony so we had that description of the corrected version or errata?
Yes,
Get
I
that
would.
on.
Yes.
Evis. All right.
Yes.
Your
so-
Honor,
Before we go off the record as well, this is Tim Opitz, MECG. I don't have any cross or opening statement for the remaining issues listed today. May I be excused
Yes.
until tomorrow?
Yes.
Thank you.
Yes, Mr. Bednar. All right. So let's break until roughly 1:30, and we'll reconvene then. Off the record. Go back on the record. All right, we are about to start on the issue of support services, but we have a new staff counsel. Could you go ahead and enter your appearance?
Yes, thank you, Judge. It's Tracy Johnson for Staff Counsel, and the court reporter has my card.
All right, thank you. And will there be opening statements for this topic, this issue?
Yes,
I will.
please.
Go ahead,
All
Mr.
right.
Clauser.
I think everybody's nodding. Okay. All right, is that going to be you, Mr. Cooper?
It will be me, Judge, and if it's okay with you, I'll give it from council table, as I think it will be much more many than the many openings we had earlier today.
All right. Then go ahead, Mr. Cooper.
Thank you, Your Honor. This issue concerns the cost MAWC pays to the American Water Works Service Company, or Service Company as it's commonly called, for services received by Missouri American. The services provided by the service company include customer service, water quality testing, environmental compliance, human resources, communications, information technology, finance, accounting, regulatory, legal, engineering, supply chain, and risk management, among others. Included as a part of this broad range of services are a variety of financial and accounting services that include payroll, human resource, data management, utility plant accounting, cash management, general accounting and reporting, accounts payable, and tax accounting. Our first witness today will be Mr. Patrick Barenbrook, who has in his testimony presented the results of a study that evaluated the necessity of services provided by the service company to Missouri American Water Company and the reasonableness of the associated charges. This study concludes that the service company's services are essential to Missouri American's ability to deliver water service to its customers, that the services are customarily provided by other utility service companies to their operating utility affiliates, and for each cost comparison performed, the service company's charges were shown to be reasonable. Staff has recommended removal of some performance compensation costs, costs associated with business development, and some external affairs and public policy job positions. OPC also questions performance compensation, as well as recommending removal of payroll costs related to business development, external affairs, and investor relations. We were talking here around the council tables before we went on the record that some of these issues show up sort of within other classifications during the hearing. And the best example of that is performance compensation, which is actually a listed issue within the labor and labor-related issues, which are coming up next on the list. So that will be at a different point. The individuals in external affairs positions that have been removed, we believe should remain in because they interact with local municipal officials within the company's service territory on issues such as customer service, boil advisories and orders, as well as infrastructure construction and replacement. Business development activities also benefit customers of Missouri American in both the short and long term by mitigating the cost to be recovered per customer and enhancing purchasing power. Lastly, investor relations positions help attract and maintain investors that provide needed capital for investments in utility infrastructure, which is obviously a critical part of the company's operations. Missouri American Service Company expenses, as have been proposed by the company, should be included in Missouri American's cost of service. Thank you.
All right. Ms. Johnson, would you like to present an opening statement?
Thank you, Judge. I will take my opportunity at the podium, if that's all right. So good morning, or afternoon, excuse me, Chair Hahn and Commissioners, Judge Sire. So I'm Tracy Johnson, as I said earlier, and I'm standing before you on behalf of staff, specifically on the issue that Mr. Cooper outlined. Support services is what we're calling it. If you're trying to follow along, like I was, this issue is number 20. It's on page 6 of the amended list of issues. It's in page 18 of staff's statement of positions, And more information can be found in staff witness Ashley Sarver's direct rebuttal testimony on pages 7 to 10. So with that, may it please the commission. I'll start in the same place that we'll finish. So staff doesn't believe that allowing the inclusion of support services is a bad thing. Staff takes issue with Mr. Cooper's argument of the reasonableness of those costs. Staff supports a reasonable evaluation and inclusion of support services where the services of a third party who provides them should be treated the same way as if it was in one of the company's direct accounts. It should be based on the type of expense and how it relates to the provision of safe, reliable, and affordable services to ratepayers. This is staff's approach. Staff disallowed the same expenses through the support services category as they did in the Missouri American direct accounts. I know that we're all familiar with the subsidiary relationship. We've talked about it a lot, so I just want to summarize it for everyone's understanding, maybe just my own. So Missouri American's relationship with American Waterworks Company is that they are a subsidiary of American Waterworks Company. American Waterworks Service Company Incorporated is another subsidiary of American Waterworks Company. American Waterworks Service Company Incorporated is the service company that we're talking about that provides these support services at issue in issue number 20. I won't list out the services that are provided. Mr. Cooper covered those pretty well, so we'll skip that. What I do want to point out is that the service company provides its services to Missouri American at cost and issues monthly invoices in one of two ways. They either do it directly at 100% because all of the services were utilized by Missouri American, or as a percentage allocation across all of American Water's regulated subsidiaries. Like I said, staff does not take issue with the expenses that are charged to Missouri American. Rather, the concern is over the reasonableness of the amounts allocated to Missouri American by the service company. Staff recommends adjustments to the costs allocated to Missouri American. For reference, the OPC recommends larger adjustments and greater disallowances for support service costs than staff recommends to be cut from Missouri American's cost of service. So what's the number, right? There's a $12 million difference between staff's recommendation and Missouri American's position on this issue. I'm going to give approximates because if you round it incorrectly, you're going to end up with a number that's different than 12. So for the sake of our $12 million difference, approximately $6 million of that is outlined in incentive compensation, $4 million in labor expenses, and then all other services cover about $2 million. As Mr. Cooper outlined, this is a summary sort of issue, and there are a lot of other witnesses, staff witnesses especially, who can speak to some of these issues. But I want to outline that Ashley Sarver is the staff witness who's going to take the stand in a second, and she is the one who can answer the general questions in this category, but she's also the one, if you'll remember earlier, Chair Hahn, that was indicated for reconciliation questions. So she'll take the stand today, and then Amanda McMillan was the other one indicated to you, and she'll be up tomorrow for reconciliation type questions. So please be prepared for Ms. Sarver to defer specific details of adjustments to her staff colleagues. Okay, so I'll end where we started, which is what I said I would do. So staff isn't opposed to support services expenses being included. Staff simply suggests a series of adjustments to temper the excess requested by Missouri American and produce a reasonable outcome on the issue of support services. Thank you for your attentiveness, and I can do my best to answer your questions.
Are there any questions from the commissioners? All right. Would any of the intervening parties like to give an opening statement? Okay. Mr. Kleiser.
this is a relatively small issue, so in lieu of a bigger PowerPoint presentation, I just put together this small handout. I'll go over it really quick. Again, if it would please the commission, John Kleiser, I'll be here all week. The issue in front of you right now, it's titled Support Services. As you kind of heard, issue is a little bit mixed up with the other labor and relations issues. I heard you just give a breakdown of 12 million from 6, 4, and 2. I'm pretty sure that we are on the 2 million part, that last part, because the 6 million incentive comp and the other 4 million in labor, I think, is coming up next. Don't quote me on that. The numbers got a little bit confused there, so apologies. The other thing is, again, there are a lot of support services being offered. I know that Mr. Cooper, on behalf of Missouri American Water, read off a list. I'll hit you with another one. You know, we got accounting and financing, administration, business development, communications, compliance, education and training, engineering, health and safety, human resources, information systems. And the court reporter is going to throw something at me, so I better slow down. The point here is that there are a lot of support services at play, but not a lot of support services at issue. What's really at issue comes down to just about 3. 2 that were kind of disallowed by the staff, and another one on top of those other 2 that was disallowed by the OPC. And those 3 at issue are business development, external affairs and policy, and your investor relations. And the short version for what the OPC's position is basically, hey, these aren't positions that are benefiting ratepayers. They're out there to benefit shareholders. We're okay with the company doing them, but the company's shareholders should pay for it because that's who earns the benefit. And the easiest, fastest, simplest way to understand it is just to look at the actual job descriptions. When we go forward in the actual hearing, I'm going to present the company's response to data requests sent by the staff that has the actual job descriptions. I've pulled out the key ones and put them in here, so this is a bit of a preface. But again, what is business development? It's basically, it's the company going out and acquiring new systems. It's that simple. This is how they go out, they acquire new systems, they push water contracts. This benefits shareholders because you get additional CapEx. We're okay with them doing it. It's not benefiting their existing ratepayers. It's not improving or ensuring safe and adequate service. What is external affairs and public policy? Well, in short terms, it's their internal lobbying division. And again, we're not saying the company shouldn't have one. I think that their lobbying division does an excellent job, frankly, and I think that shareholders have gotten massive returns on the company's lobbying groups. But again, it's not necessary for customers to be paying for that. The shareholders are the ones benefiting from that lobbying group. They should be the ones to pay for it. The final one, and this is the one that we drew a difference with the commission staff on, is investor relations. And again, if you read the actual job description, you're going to see, you know, the primary description put out there is mostly kind of talking about the company's ESG report. That's the environment, social, and governance report. But again, it's you can predict. It's the people who kind of talk to the investors, who put together those reports that say how well the company is doing and all that. Again, these are investor relations. They're meant to benefit investors, not individual ratepayers. So the investors, i.e. shareholders, should be paying for it. That is the short version. Really, it's just as simple as looking at these jobs and asking ourselves, you know, is this something necessary to provide safe and adequate service? And if not, if it's still benefiting shareholders, they can do it. They just should be the ones paying for it. So I have nothing else, and I see, I think, at least one question.
Chair Hahn.
Thank you. I just probably have several questions, but help me out. So staff agreed with you that the business development positions, which include, it looks like 2 particular positions.
Let me clarify. I grabbed the job descriptions that show up in here. I think that they're more than just 2 positions, and it's something you definitely want to ask staff. But the actual job descriptions, and you'll see the DR response I'm going to give you, don't have like a huge list. I just grabbed the ones that related to it in that DR response. Am I confusing you? It's more than just 2 provisions. So it's these titles, but it's more people than this? I think so, and if I'm wrong, I expect that the company or staff witnesses will correct me on that.
Okay. I'm assuming the same is true for
yes.
External affairs?
Yeah, we're not talking about just 5 people.
And, okay. So both OPC and staff agree that these particular positions should be excluded?
So the staff disallowed positions related to the business development and the
external affairs and public policy. And I will say that from staff's perspective, and again, they're free to come up here and correct me if I get this wrong, they went by and sort of went on a very, person-by-person basis. But I think ultimately they excluded the vast majority from both of those two positions. They did not exclude the investor relations, that's just OPC.
Okay,
I apologize in advance if I miscommunicate that, but that was my understanding of the issue.
that's okay. I'll ask them, but on investor relations, how, and maybe I could just ask your witness, but how do we treat this in other, how have we treated this in other cases?
I do not know the answer to that off the top of my head. I apologize.
Would your witness know?
It would be worth asking her. I'm not entirely sure, though.
Because I'm sure that all these companies I know they all have investor relations, so I want to understand that better.
The principal problem is I'm not sure if my witness, who is Angela Schaubman, has taken up this issue before in other cases. So I would invite you to ask Ms. Schaubman, but I'm not entirely sure if this is her forte.
Okay. Because I do have other questions about the investor relations descriptions and how it compares to other investor relations descriptions, because this is highly focused on ESG, which
So the short answer I will give you is that I was pulling from the data responses, and I intend to put the entire data response in there. To the extent that there was something in there regarding investor relations I missed, that may be the case, and maybe there's more in there that I overlooked. But once I put the entire thing in, you should be able to see for yourself if there is something else there that shouldn't be, or another way that it could be handled. That makes sense.
Thank you. Thank you.
Are there any other questions? I'm guessing no other questions.
No other questions? Mr. Cooper, call your first witness.
Thank you, Your Honor. We would call Mr. Patrick Barrenbrook.
Would you raise your right hand, please? Thank you. Do you swear or affirm that the testimony you give today in this hearing shall be the truth, the whole truth, and nothing but the truth?
I do.
All right, thank you. Go ahead, Mr. Cooper.
Thank you. Mr. Barrenbrook, would you go ahead and state your name for the record?
Patrick Barrenbrook.
And by whom are you employed and in what capacity?
I work for myself, president of Barrenbrook and Company, LLC.
And are you appearing today on behalf of Missouri American Water Company?
Yes.
Have you caused to be prepared for the purposes of this proceeding certain direct testimony in question and answer form?
I have.
Is it your understanding that that testimony has been marked as Exhibit 1 for identification?
Yes.
Do you have any changes that you would like to make to that testimony at this time?
I have one change on page 16 of my direct testimony. Line 12. The number two positions, should be 4 positions. It's simply it's just a reference change correction. It doesn't impact any of the underlying data or cost comparisons.
If I were to ask you the questions which are contained in Exhibit 1 today as have now been amended, would your answers be the same?
Yes.
Are those answers true and correct to the best of your information, knowledge, and belief?
Yes.
Your Honor, I would offer Exhibit 1 at this time into evidence and tender the witness for cross-examination.
Are there any objections to the admission of Exhibit 1? All right, Exhibit 1 is admitted. Ms. Johnson, you have questions?
Apologies, Judge, no cross, thank you.
No cross, Your Honor, thank you.
Thank you. That's Mr. Kleiser. And I'm going to agree with Mr. Kleiser that most of the attorneys for the other parties are no longer here. But, all right. All right. But just in case, is there any cross-examination by the other parties? All right, hearing none. Commissioner questions? Go ahead, Chair Hahn.
Hi. Tell me about your investor relation, your view of OPC's position on the investor relations disallowance. In American Water's other jurisdictions, how is investor relations treated in rate cases? Is it typically recovered or not recovered?
Your Honor, that's not a topic I typically cover in the rate cases. Generally, it's covered by a company witness.
Okay.
But I'm glad you asked me about that, because in my report, I show if that function, external relations, investor relations, is performed by the service company of other utility holding companies. And if you are interested, it's in a schedule in my testimony. It's schedule PLB2, page 14 of 44.
Thank you.
And if you care to take a look at that, it's a matrix that I built that shows, going down the left-hand side, the functions that are provided by service companies to their operating company affiliates. And then across the top are the holding companies that have service companies that provide services to the operating utilities, operating subsidiaries of these holding companies. And what I do is I filled in the matrix to indicate which of these functions are performed by the service companies in question in this comparison group. And you can see that external affairs is corporate / external affairs is a service being provided by the service companies of all the utilities in this group. For investor relations, the vast majority of service companies provide that service to their operating utilities. There are a few that don't, but I thought you might be interested in that.
Thank you.
Okay.
Commissioner Coleman.
Thank you, Judge. What's the source document that you used and relied upon in Exhibit 1? Relative to the American Water Works Service, if I got that whole name straight, I can't keep it. American Water Works Service Company.
Yeah, yes.
Excuse me, if I may, I believe you're referring, Commissioner, to the witnesses schedule PLB2, Exhibit 1, which I believe starts on page 11 of 44.
Let me pull it up here on mine. But in the meantime, is that something you can offer any insight into?
I'm sorry, Your Honor, are you talking about the exhibit I was just?
Yes, sir.
Okay, good. The source of that is the FERC Form 60.
That was Exhibit 1, right, that you were referring to?
Let me
No?
no, not Exhibit 1 is a
Okay.
different exhibit.
Okay, then the one you were just referring to.
It's Exhibit 2.
Okay.
The source of that is the FERC Form 60. It's an annual report that utilities who are subject to FERC regulation that have service companies have to file with the FERC every year. And it's primarily a financial report, but there is some operational, organizational type information on cost allocations, and that's where I get the information from.
Okay.
I rely on the FERC Form 60 a great deal. It has some very useful information I use for my comparisons.
We're real familiar with FERC. Thank you.
Okay.
Thank you, Judge.
Commissioner Kolkmeyer.
Yes, thank you, Judge. Good afternoon, sir.
Afternoon.
Thanks for your testimony today. How many employees does the company have in investor relations?
Your Honor, I don't know that number. What I deal with are primarily the dollars. The dollars that are recorded on the books of Missouri American Water Company, the charges, and the head count, I'm not sure how that breaks down. I never have to ask about that in conjunction with my work.
Okay. Is it all right to ask the dollars? The dollar figure?
Let me check where I have that.
Is that public record
Yeah, I
or
think
confidential?
I have it in here in my report. It's on page 21 of 44.
Okay.
And what I've done is I break the charges from the service company down to the functions that they're related to. And that's based on the departments that are performing the work. And if, let me just describe what the dollar amounts are for you.
Okay.
External affairs was, and again, these are the charges from the service company to Missouri American, is around $3,000 for 2023. Business development was listed as $431,000, approximately. External affairs, I'm sorry, the amount I gave you was from corporate. External affairs from both corporate and regional offices is around $115,000. Business development is approximately $435,000. So those are the amounts that of the total service company charges that break down into those categories.
Okay, thank you, sir.
Okay.
Thank you, Judge.
All right. I've got a few questions, kind of in that same neighborhood from your pre-filed testimony. If we go to Exhibit 1, which is the description of the service company services that begins on page 11 of 44 of your schedule PLB 2. There at the bottom, which would be on page 13 of 44, oops, yes, page 13 of 44, it cites the source as American Water Works Service Company Cost Allocation Manual. Was there, and that's correct?
Yes.
Okay. Did you supplement that?
No, I didn't. I used the description from the company. I thought this was of insufficient detail, and that's why I just used their description.
Okay. And I don't believe I have any further questions. All right. Does staff have any recross? Mr. Kleiser?
Good morning.
Good morning. Afternoon.
Afternoon. I'm sorry. It's a voice of habit. I want to make sure I pronounce your name correctly. It's Brainbush? How do I say that?
Well, it's Barren Brook.
Barren Brook.
Think of a bear in a brook.
Gotcha.
I'm originally from northeast Wisconsin, where there are a lot of Germans and Poles and Czechs immigrated to, so everybody has a crazy name.
Barronbrook.
Barronbrook,
All right, thank you so much.
Okay.
So you kind of started off in response to the question posed to you by Chair Hahn regarding the exhibit, this page 14, where you had this table.
Yes.
And I want to make sure, I think there might be a breakdown in communication, so I want to make sure that this is clear. This table is showing that these utilities provide that service, correct?
Yes.
But this table doesn't show that who pays, whether it's ratepayers or shareholders, who pay for each of these utilities.
No, it does not show that.
Right. And let's take lobbying as an example. I would assume, agree with me that a shareholder would be okay with the utility company lobbying to benefit itself, right?
I'm not the witness to ask that. I
Go
typically don't handle those specific type issues. I deal with service company charges in toto and perform cost comparisons that help the regulators and other parties to the case put into perspective the charges from affiliates to the operating company. But I typically don't drill down into specific details associated with the charges. That's usually a company witness.
All right, that's perfectly fair.
Okay.
I won't have any further questions then. Thank you very much for your time, sir.
Okay.
Is there any recross by the other parties? Redirect by the company?
No, thank you, Your
All
Honor.
right. All right, Mr. Barronbrook, thank you for your testimony. Mr. Cooper, call your next witness.
We would call Manuel Cifuentes.
Would you raise your right hand, please? Thank you. Do you swear or affirm that the testimony you give in this hearing shall be the truth, the whole truth, and nothing but the truth?
Yes, I do.
All right, thank you. Go ahead, Mr. Cooper.
Thank you. Please state your name.
My name is Manuel Cifuentes Jr.
And by whom are you employed and in what capacity?
I'm employed by American Water Service Corporation. I am a senior principal regulatory analyst.
And you're appearing today on behalf of Missouri American?
That is correct.
Have you caused to be prepared for the purposes of this proceeding certain direct testimony and rebuttal, surrebuttal testimony in question and answer form?
Yes.
Is it your understanding that those two pieces of testimony have been marked as Exhibits 6 and 7 for identification?
Yes.
Do you have any changes that you would like to make to that testimony at this time?
Yes, I do. I have one correction to state on page 15, line 9.
Of which piece of testimony?
Of my rebuttal testimony.
Okay.
It should state MAWC versus TAWC, and that is all the corrections I have.
If I were to ask you the questions that are contained in Exhibit 6 and 7 today, would your answers as now amended be the same?
Yes.
And are those answers true and correct to the best of your information, knowledge, and belief?
Yes, that's correct.
Your Honor, I would offer Exhibit 6 and 7 into evidence and tender the witness for cross-examination.
Okay, are there any objections? Exhibits 6 and 7 are admitted. Ms. Johnson, any cross?
No cross from staff, thank you.
Mr. Kleiser?
No, thank you, Your Honor.
Any other party have questions on cross-examination? All right, hearing none, do the commissioners have any questions? Yes, Commissioner Coleman.
Just one. In your rebuttal and sub-rebuttal testimony, you mentioned that the state of Missouri has excluded lobbying expenses from this rate case. Is that the case in all of the states American Water is located in?
For Missouri American Water, I can state that is a correct answer, and for the other states, American Water does its best to make sure that there's no lobbying expenses included for rate recovery purposes.
All right, thank you, Judge.
Chair Hahn.
But is it right that it is in Missouri American's request before us now to include external affairs and public policy positions for rate recovery? And that's in effect what staff and OPC are asking to exclude?
Chair Hahn, American Water has included those positions pertaining to external affairs and business development, but all lobbying expenses have been excluded to the extent.
So how did you bifurcate, for example, the position for Director of Government and External Affairs for purposes of rate recovery? If you say that you're excluding lobbying, part of that position's purpose is in-house lobbying, so how did you go about bifurcating the amount that's external affairs versus government affairs?
Yes, Chair Hahn, in the preparation of the case, a detailed analysis was performed on a general ledger basis and looking at reviewing a lot of expenses and making sure that nothing pertaining to lobbying or, any sort of expenses that would, give the appearance that this is not, just and reasonable to be recovered through rates. So the base year amount was used as of 12/31/2023, and the analysts and the individuals that reviewed the schedule made sure on a detailed level to exclude any expenses that would, give the appearance that it should not be recovered.
So an analysis was done somewhere, and it does have some calculation about this amount that should be excluded, and that wasn't asked for rate. I'm trying to understand.
Yes, I believe in one of our discovery requests, or one that was provided to either OPC or staff, we provided sort of a detailed breakout of all expenses for the historic test year, or the 12/31/2023 test year. And within that, those general ledger expense accounts, items that would typically be associated with lobbying would be removed. So if, for instance, if we started out with, say, $20,000, and we noticed that this is pertaining to lobbying or a fee that should not be included, it was removed immediately. And if there's something missed, then obviously obviously the company would have adjusted that.
Okay, thank you, and I'll follow up with staff. Thank you.
Yes. Oh, I'm sorry. Commissioner Kolkmeyer.
Thank you, Judge. So was investor relations included in that as well? Was that questioned and removed?
In terms of the expenses pertaining to lobbying,
Yes.
lobbying expenses were removed, but in terms of, I guess for the position that you're stating for investor relations,
Yes.
the company has included that since it's, we deemed it as prudent and recoverable for this rate case.
Okay, so I'll ask you the same question I asked Barronbrook. How many employees does the company employ in investor relations?
I can say within my rebuttal testimony in my attachment schedule, I believe it's MCJ-1, there's a listing of employees that's identified as investor relations. There's a total of about maybe 38 employees within that attachment, but within that 38, there's a certain number of investor relations that I do not have on the top of my head, but it's attachment to my rebuttal schedule.
Okay, thank you. Thank you, Judge.
All right. Any recross by staff?
Just one second, Judge. No, Judge, nothing from staff, thank you.
Public counsel?
Nothing from public counsel, thank you.
Recross from any of the other parties? All right. Mr. Cooper, redirect.
Thank you, Your Honor. Let's start with that last subject. You had indicated that there would be approximately 38 employees related to investor relations, correct?
Correction, there was about 38 employees that were identified in total by staff, but within that 38, there's probably maybe 5 or so, but I don't have that specific number. It's within the schedule.
Well, we're just kind of, well, let me get at it this way. Whatever employees there are at the service company, their costs ultimately are allocated amongst all of the operating companies, correct?
Correct.
And let's go back to the lobbying a little bit. I think you made some statements that really before the company filed this case, that it went through costs and made its own attempt at removing those expenses associated with lobbying, correct?
Yes, that is correct.
And that could be a person's entire salary, it could be a portion of the person's salary depending upon their duties. Would that be accurate?
Yes, that would be correct.
Okay. And if you remember, and if not, we'll ask one of the staff witnesses either in this issue or the next one. But to your knowledge, did staff agree with that the company had removed lobbying expense from this case?
Yes, that is correct.
Okay. And then I think you also started to talk about some of the other positions that had been removed initially by staff, correct?
Yes.
And in your rebuttal testimony, you have an exhibit or a schedule, don't you, that represents a data request response from staff?
Yes, that is correct. DR 265 or Schedule MCJ-1.
Okay. And what is the significance of that schedule to this question?
The significance of that schedule, it shows that a line-by-line detail of the positions that's been included or agreed upon with staff, up to either including 100% of the salaries or up to a certain extent of the salaries.
And did that DR response from staff represent movement from its last testimony position?
Yes, it has.
Okay. In terms of investor relations, in your testimony, you do allege that you believe that it has benefits for Missouri American, correct?
Yes, it does.
And what are those benefits?
For investor relations, they comprise, say, for instance, SEC compliance. They also do sort of coordination with investors outside of American Water. They help, they mitigate or attract more investors to the company, which ultimately lowers the risk of the company, which also helps lower the rates. And in other ways, if it lowers the rates, it also benefits the customers because the customers benefit from that. If there's lower rates, if the utility has a higher, a higher profile.
Well, let's get at it this way. They're largely in charge of working with the folks that ultimately provide equity capital. Is that it?
Yes, they do.
Okay. That's all the questions I have, Your Honor.
All right.
I think we're finished with this witness, Your Honor, or are there more things going on at the bench, or?
We are finished with this witness. Thank
Okay.
you. Thank you, sir.
Thank you. Thank you, Commissioners. Thank you, Judge. Thank you, Judge.
And looking at the schedule, my understanding is that there are no further witnesses from the company on this issue.
That's correct.
Then let's go ahead with staff's first witness.
Thank you, Judge. We'll call Ashley Sarver.
Okay. Ms. Server, you have your right hand raised. Thank you. Do you swear or affirm that the testimony you give in this hearing shall be the truth, the whole truth, and nothing but the truth?
Yes.
Thank you. Go ahead.
Thank you, Judge. Good afternoon, Ashley. Can you state and spell your name for the record, please?
I'm Ashley, A-S-H-L-E-Y, Sarver, S-A-R-V-E-R.
And by whom and in what capacity are you employed?
Missouri Public Service Commission, Utility Regulatory Audit Supervisor.
And are you the same Ashley Sarver who caused to be filed certain testimony in this case, specifically marked as Staff's Exhibit 212 and 225?
Yes.
Do you have any changes or corrections to your filed testimony?
No.
If you were asked the same questions that's in that testimony today, would your answers be the same or substantially similar?
Yes.
And they're correct to the truest and best of your knowledge and ability?
Yes.
At this time, I'd move to admit Exhibits 212 and 225. Neither one of them have a confidential or highly confidential designation.
All right, are there any objections to the admission of Exhibit 212 and 225? All right, those two exhibits are admitted.
Thank you, Judge. We consider this witness tendered for cross.
All right. Mr. Cooper, do you have questions on cross-examination?
I do not.
Public counsel?
Yes, Your Honor. Start by marking two exhibits, which should be, I believe, 316 and 317.
Can I say something? I'm not the person for labor. If you have labor questions or incentive comp questions.
Well, I'm going to just try and get them through here. There's no real question on other than laying the foundation
Okay.
for the staff GR, so for them now. Absolutely. Good afternoon. I got it right that time.
Yes.
Staff issues a lot of DRs in these cases, right?
Correct.
Right. So I've handed out what should be copies of the staff issued DRs 0243 and 0243.1, or rather the company's response to those two DRs. Would you agree with me that that's what those are?
That's what it looks like.
And you would agree with me that, you know, as far as 0243 goes, the response mentions an attachment, and then the remainder of what I've handed you is the Excel file, or what purports to be the Excel file attached to the company's response.
This is, but I'm not the person that did the payroll part of it.
I'm going to still go ahead and move for the admittance. It's effectively a staff DR. If necessary, I can wait for another staff witness to take the stand for it, but hope there's not objection to a staff DR.
just so I have them straight, would the DR 0243 be Exhibit 316?
That's, yes.
Okay. And then 0243.1 would be 317. Correct?
Yes.
Okay. Is there any objection to those being admitted? All right. Mr. Cooper?
Maybe not. I guess I'm a little curious why Ms. Sarver is being used to put them in, since Mr. Cifuentes provided the underlying information.
You know, that's actually a good point. I thought that I would use the staff because it was a staff DR. I mean, if you want to have him retake the stand and confirm that those are his responses, I guess I'm not asking any additional questions other than laying the foundation for their admittance.
For their admission.
Yeah.
We're okay, Your Honor.
All right. Then Exhibits 316 and 317 are admitted.
And as I already said, I'm not asking about those. They will speak for themselves in the briefing. All right. It's Ms. Sarver, right?
That's correct.
Okay, I'm very bad with names, so. I want to have an understanding of how exactly staff performed the functions with regard to the business development and the external affairs department. So, it's my understanding, and I want you to correct me if I get this wrong, that staff went through sort of person by person with regard to the business development and either excluded or included costs related to each person's payroll. Is that accurate?
I'm sorry to tell you, but Sherry LeMay, the next person up, would be the person that does payroll.
Okay.
And then Angela Niemeyer is the incentive comp.
Is she coming up for this issue? And the reason we have this, like, the labor and relationships next.
Labor and relations, that's next. They'll be coming up.
Okay. Bit of an awkward situation. I'm sorry, Judge, give me 1 second here. I guess I'll just ask this. With regard to the question of lobbying expense that's been brought up, you would agree with me that there's lobbying expenses that are incurred that aren't directly related to payroll, but which are sort of incurred separately for the company?
Yes, generally, yes.
So it's possible for the company to exclude lobbying expenses that wouldn't necessarily mean excluding payroll costs associated with individuals working at the services company who is potentially performing lobbying functions.
Can you restate that question again?
You would agree with me that it's possible that the company might have excluded lobbying expenses but didn't exclude payroll expenses associated with individuals who might be performing lobbying functions working for the shared services company?
I think I'm going to have to defer that question to Sherry. Sorry.
No, it's okay. So I'm okay, basically, not asking any further questions on this issue with the clear understanding that as Sherry comes up for the, I think, labor and relations portion of it, I will be asking issues germane to this subject, if that makes sense. I think there was just maybe a bit of a skewed in the way that we kind of drafted the list of issues. But I'm clearly that I'm being redirected on these issues, so I would like to address these same kind of questions to the witness I'm being directed to, which is, as I'm going to take the stand in relationship to the next issue. If that's acceptable, then I have no further questions at this time.
Okay. It is, and I do have some questions myself, though.
Go right ahead.
All right. I'm going to direct your attention to your direct / rebuttal testimony.
Yes.
Beginning on page 7. What, and correct me if I'm wrong about this, but to me, pages 7 through 10 really are explanations of the allocation of the parent company, Missouri Water Works, or not the parent company, but the services company, allocation of its cost to its affiliates. Is that
More of
fair
the
to say?
background information, yes.
Okay. On page 10, I'll try to find maybe what line that's on, but on page 10, you state, staff is not proposing any changes to American Water Works Company's method for allocating the service company's expenses to Missouri American. However, other staff witnesses have recommended adjustments to some service company costs allocated to Missouri American, which are addressed in their direct/rebuttal testimony. Can you provide a list of the adjustment amounts of other staff witnesses and the USOA accounts the adjustments effect? Is that
Yes,
possible?
we can get that information for you.
Okay. I'm going to shift gears a little bit and ask you a few questions about reconciliation. And now, the reconciliation filed by staff shows a difference from Missouri American Support Services cost of $11.5 million. Do you know what adjustments staff made that make up that $11.5 million difference?
Is that the May 31st, 2025? It looks like it is.
Okay.
Yes, we can get that information to you. We have it. We can get that information to you if you would like it to be broke down even more.
All right. Do you have that reconciliation in front of you, the one that was filed on filed on February 11th?
Yes, I do.
Okay. It includes a heading, and I probably need to get that in front of me myself. So if you give me a second to try to get that accomplished. There's a heading, reconciliation, cross-rebuttal, sur-rebuttal. Or actually, this is in the reconciliation, cross-rebuttal, sur-rebuttal filing. There's the one that has December 31st, 2024 date, and then there's the May 31st, 2025 date. From what filings did staff pull the Missouri American amounts used in the reconciliation?
For Missouri American numbers,
Yes.
that came from their work papers. I'm trying to think. The true-up direct work papers had these numbers in there.
And where did the staff amounts come from?
The EMS run that we provided in EFIS on February 18th.
Okay. Are the staff amounts used in the reconciliation based on 12/31/23, the end of the test year, 6/30/24, the end of the update period, or 12/31/24, the end of the true-up period?
I'm just checking my dates. It looks like this one. As I know we didn't. This one, I believe, I like to check with Amanda McMillan too. I think it's supposed to be 6/30, 2024.
Okay.
So that'll be our update period.
Okay. I'd like to now kind of redirect you to what actually, let's see, what OPC actually filed as their reconciliation on February 14th. In that document, and it includes both staff and OPC amounts, if there are figures in that document that are the same between OPC and staff, is that because OPC's position statement filed on February 21st, where they generally agree with your positions?
We got these numbers from OPC.
Okay.
So yes.
Okay, were there any other filings where you pulled the OPC amounts?
They provided it to us, and we just entered their numbers.
Gotcha. All right, those are the only questions I have. Yes, Chair Hahn.
Hi, good afternoon, Ms. Sarber.
Yes.
Other companies have investor relations teams. How have investor relations been recovered in other cases? Have they ever been disallowed, as suggested here?
I didn't do this case with Missouri American, but I'm gonna give you a general view. I believe, from what I've done payroll, I've noticed we have not excluded, but.
Have you ever compared the job descriptions? Just when you've reviewed investor relations in the past, these data requests were by staff on job descriptions, and they do seem heavily tilted toward ESG. Is that common amongst other investor relations job descriptions from other utilities?
I don't know.
Okay, thank you.
All right. Sorry. Commissioner Kolkmeyer.
Thank you, Judge. I'm somewhat confused. I'm hoping you can help me. Mr. Cleflentes, he said that the lobbying was not included, and Mr. Kleiser says it is.
Sherry LeMay would be better on this, but I do, in their testimony, Missouri American did say that they did remove all lobbying expense.
Okay.
That's my understanding.
So do you consider lobbying the external affairs and public policy?
You have to ask Sherry LeMay.
Okay. So was business development left in your calculations?
In this case,
Yes.
for payroll or for expense?
Yes. D, all the above.
All the above. On I did remove some or I did remove the business expense. This does not relate to payroll, though.
Okay. What about investor relations?
We did not. I did not on the expense side.
Okay. And maybe you can answer this. How does other state PSCs treat these three items, categories that we're talking about right now? Do you know?
I know it's a case by case. I don't know. Like in my past of doing payroll, we just look on it case by case.
Okay. Thank you. Thank you, Judge.
All right. Mr. Cooper, do you have recross?
I do not.
I'm going to try
Public
very
counsel.
briefly here. So I've been pondering this, and I think I've got it maybe worked out a little bit here. So you worked on the business expense side, but not the payroll side. That's how there was is that accurate?
I did the business expense. I removed that from the support services, but not related to payroll.
And as you're using that term right now for the sake of the record, what exactly does the term business expense mean? So we're all on the same page.
Yes, they have some business in one of their work papers. They have business development expense, for example, like in vehicle and insurance vehicle, training, cell phones, and stuff like that. So then I remove the expenses in those.
I'm really struggling to understand. So I'm like at a high level. What exactly is a business expense that is different from payroll? Like, is it paper, like pens? Like what is, can you give me an example of what constitutes a business expense?
On this work paper, so to me, it is, if it pertains to business development, like employees, like if they would use books, software, then they labeled it underneath business development.
Okay, is it accurate to say that the things that you're removing as they relate to business expense are basically the allocation of all of the tools other than human resource, like other than actual human capital, like basically the rent space, computer programs, if a vehicle was used, for example, are those all the things that we're putting under the category of business expense?
Business development expense.
Okay, I think I'm getting this. All right, I'm trying. So, it is my understanding that you had developed a work paper that supports your recommendations, correct?
Correct.
And this goes directly to, Judge, you asked if there was a more definitive breakdown, I think. That was kind of one of the questions that was posed by the bench. Is it accurate to say that that work paper would give a more definitive breakdown of the exclusions that you made?
I made, but it's not going to cover all of support services.
Okay. All right, but as far as the, again, quote-unquote, business expenses, we could look to that work paper and that would show where you made deductions from the company's case for the exclusion of business expenses related to items that you felt should not be included.
That is correct. For the accounts, I even have the accounts in it. Yes.
Okay. You had mentioned in response to the judge's bench question about staff providing something. It's a bit unorthodox, I understand, but like, does staff want to weigh in on how exactly you would propose doing that?
It's my understanding that we would just submit the documentation that supports her work papers and the creation of that. So it's an Excel document that shows some of the changes that were made.
And has the bench formally requested that?
Not formally, no.
Okay.
No, she offered it.
Was the bench intending to?
Yes, I think we very much like that document.
Okay, then I will pause that line of reasoning there then and hope it gets settled. And just
Nope, I'm going to leave it there before I create an even larger mess. I have no further recross.
Any redirect?
Yes, please, just one. I hope it'll help in addition to the documentation that we'll provide. So I want to be really clear that the category is business development expense, the development of the expense, of the business, correct?
The one that I sponsored is the business development expense. Anything related to business development expense, which is a small portion of the support services. Support services has many accounts in there, which includes payroll, incentive comp.
So we are not talking about what sounds like a very broad category of business expenses generally.
No, not, it's just business development expense.
Okay, and in the category of business development expenses, what did you exclude?
Books, publications, software, insurance, training, transportation, just a few examples. That's probably most of them.
And what are these exclusions based on, like the underlying reasoning for those?
Because business development employees are being either removed or a portion of their salaries are being removed. So we wanted to on support services to make sure that we align with what they did with payroll and the other expenses pertaining to business development employees.
So truing up the two categories.
Yes.
That's all.
All right. And as far as that breakdown, that work paper,
Yes, we can provide that.
all right. Okay, thank you, Ms. Sarver. All right. And that's your only witness on this topic, correct, this issue?
Yes, that's correct.
All right. And according to the schedule, OPC's witness is set to testify?
Yes, we would call Angela Shaven.
All right, thank you.
Did I actually get it right?
That is correct.
Is it Shaven or Shaven? Shaven, okay. Would you raise your right hand, please? Do you swear or affirm that the testimony you give in this hearing today shall be the truth, the whole truth, and nothing but the truth?
I do.
All right, thank you.
All right. Can you state and spell your name for the court reporter?
Angela Shaben, ANGELASCHAB as in boy, EN.
And by who are you employed and in what capacity?
The Missouri Office of the Public Counsel as a utility regulatory auditor.
And did you prepare a cause to be prepared testimony which has been pre-filed OPC exhibits 302 for the direct rebuttal and 303 for the cross rebuttal?
Yes.
Do you have any changes you would like to make to that testimony at this time?
No.
And are the answers in those provided in that testimony true and correct to the best of your knowledge and belief?
Yes.
And if I asked you the same questions contained in that testimony today, would your answers today be the same or substantially similar?
Yeah. Yes.
All right, thank you. I would move for the admission of 302 and 303, which is respectively, the direct rebuttal testimony of Angela Shaven, public and confidential, and the cross rebuttal testimony.
Any objections? All right. 302, both public and confidential, and 303 are admitted.
I tender the witness for cross-examination.
All right. Staff? No cross-examination. The company?
No questions.
All right. Any questions from the commissioners?
Yes, thank you. Ms. Shaven.
Hello.
So I want to better understand OPC's position based upon the opening from Mr. Kleiser. We were handed several documents, really. But at the bottom of the opening document, I'll just kind of show you the picture. It has a chart and talks about investor relations, and it talks about the job descriptions.
Yes.
There's a paragraph at the very end that says, reason this primarily benefits shareholders, not customers, which is, there's a discussion over ESG, and it says, ESG schemes have historically been driven by a vocal minority of investors. The value of these initiatives are both highly controversial and appear to be rapidly falling out of favor in the current political environment. Is that OPC's rationale for the exclusion of investor relations, or is it also based on that it doesn't have customer benefit?
It's mostly that it does not have customer benefit. Like, I don't see how these positions are required to provide safe and adequate service at a reasonable rate.
And is the only difference, I just want to make sure I understand, the only difference between OPC's position and staff's position is this exclusion?
Yes, this drives.
This particular exclusion on investor relations, is that right?
That's true.
Okay. That's all I have.
Commissioner Kolkmeyer.
Yes, thank you, Judge. I was under the impression that, good afternoon, I'm sorry.
Hello,
Started right
Commissioner.
off firing. I was under the impression with Mr. Kleiser's testimony that these three items, which are business development, external affairs and public policy, and investor relations, are still included in here.
There's a staff adjustment related to the business
The business side of it.
and the external affairs and public policy. The major difference between us, our positions, is the investor relations part.
It's just that one item. Okay. I'm thinking whether I want to ask another question, but I think I'll quit there. Thank you, Judge.
Okay. All right. I've got a few questions myself. American Water Works Company, Missouri American's parent company, are they required to prepare and distribute company and fiduciary information to current and potential holders of its financial securities? If you can answer that question.
That's a great question. That sounds more like a Dave Murray question, though. I don't know.
That's fair enough. All right. I'm gonna direct you to your direct testimony on page 19.
Okay.
On line, I believe, beginning on line 15.
Does that start with additionally, these are costs?
Actually, the sentence I'm going to ask you about it states the external affairs / public policy costs incurred from the External Affairs Department could range from charitable foundation programs to lobbying and maintaining relationships with government officials. Were you able to review details of the charges to distinguish specific lobbying or charitable program costs?
I reviewed, I can't recall the number of the staff DR, but I did go through staff DRs that asked for these expenditures, and I reviewed those. There are DRs out there. I just, off the top of my head, cannot remember them.
And again, if you recall, what USOA, Uniform System of Accounts, are your adjustments to eliminate these American Water Works Service Company costs posted to?
That's a great question. I have an account in mind, but I don't know if I want to say it in case it's wrong. You know what I mean?
So you're not going to take the leap, huh?
Well, I mean, maybe 920, maybe.
All right, fair enough. Those are my only questions. So does staff have any recross?
Just a few short follow-ups, please. Hi, Ms. Shaban.
Hello.
Hey, I want to make some clarifications about the three categories and the difference between staff and OPC, because I think that we may have gone down a road where there's some confusion now, and I want to be clear.
Okay.
So in the categories, let's back up. The categories are business development, external affairs and public policy, and investor relations. Is that correct?
That is correct.
Okay, and which of those three categories is OPC suggesting that the cost be removed for entirely?
Investor relations, definitely, and also the other two. But as I was going through a lot of staff work papers to determine the difference in our adjustments and realized that a lot of the business development and the external and government affairs were already adjusted out. But the major, so the major difference is the investor relations, where staff has no major adjustments.
Okay, so for business development and external affairs and public policy, you mentioned in response to one of the commission questions that staff had adjustments to those. That doesn't involve the removal of the entire category though, right?
Not the entire category.
And is the OPC's position that these two categories, business development and external affairs and public policy, should be disallowed to a greater portion or than staff, or altogether?
A greater portion than staff. And, well, to the extent altogether.
Okay, so would you agree with me that there's a distinction here specifically in business development and external affairs and public policy between OPC's position and staff's position? That OPC is saying they should be disallowed entirely and staff is making adjustments to them while allowing some of those expenses to remain?
That, yes.
Okay, I think that's all for us.
All right, Mr. Cooper?
No questions, Your Honor.
All right. And Mr. Kleiser, any redirect?
I think staff counsel might have already done this, but just boots and suspenders, are going to make sure we're very clear on this. The company's position in this case is to maintain all three of these in costs. The staff's position is to make discrete adjustments to the business development and the external affairs, and the OPC's position is to remove the entirety of all three categories. Is that accurate?
Yes.
Okay, so hopefully that clears that up. And then the only other thing is, with regard to the question just posed to you by staff counsel, do you have a rough estimation of about what percentage of the business development and the external affairs was removed by staff through the discrete adjustments? There's an overall percentage of the cost included.
Well, I was going by the amounts that the company included in their case, so, which is on page 18 of my direct testimony. And when I looked at staff adjustments, like in business development, from what I could see from Ashley's work paper, it's very similar in my recommendation for the disallowance there.
So to be clear, you believe that staff, while it has made discrete adjustments on a sort of line-by-line basis, they have excluded the majority of it. Is that accurate?
Yes, from what I reviewed, their adjustments were similar to what I had listed in direct.
All right. I have no further redirect. Thank you.
All right. Thank you, Ms. Shaban.
Thank you.
You may step down. Let's go ahead and take a break and reconvene at 3:15. Going on. Let's go back on the record. We are now moving on to the issue of labor and related. And we have new staff counsel, if you would enter your appearances.
Mark Johnson on behalf of staff counsel.
Andrea Hansen on behalf of staff counsel.
And do the parties wish to present opening statements on this issue?
Yes, Your Honor.
All right.
Yes, Your Honor.
Mr. Cooper, I'm going to lead off with you then.
Thank you, Your Honor. I'm afraid, as we've all kind of talked about the last hour and a half or so, that some of the things we've talked about in the support services section is going to bounce back up here and perhaps make a little more sense. But I think a lot of this is still going to kind of wind its way back and forth amongst a variety of issues as we move forward. But labor and related specifically has 6 sub-issues as of the issues list. Subpart D, employee benefits, pensions, and OPEBs, that is a part of the stipulation and agreement that has been filed already. So hopefully that will not be a live issue. I don't view it as a live issue today. Additionally, payroll taxes and employee benefits, 6C and 6F, I would view as largely rollout issues, meaning once we decide what the appropriate payroll is, we're going to do some math. There's also some discrete adjustment piece that's built in there. But again, those are things that would be decided elsewhere. That leaves us with most prominently, well, 3 things: performance compensation, payroll, and the labor capitalization. MAWC takes the position that 100% of the performance compensation should be included in its cost of service. The company offers compensation that has allowed it to attract and retain customer-committed, dedicated, and highly qualified employees. The company's overall compensation philosophy is to provide employees with a total compensation package that is market-based and competitive with those of comparable organizations with jobs of similar responsibility. As part of its compensation philosophy, the company has chosen to place a portion of its compensation at risk, driving continued performance across the enterprise. Specifically, the company targets its total direct compensation, inclusive of base and at-risk compensation, for each role near the market median, the 50th percentile. By using a combination of fixed base and at-risk compensation, the company ensures competitive market-based compensation for all employees while continuing to motivate employees to achieve goals that will improve performance and efficiency for the benefit of customers. Our first witness on this issue will be Mr. Mustich, who has performed an analysis, and he has concluded that Missouri American Water's compensation philosophy and performance compensation plan design are in accord with utilities specifically and industry generally, and that the levels of total direct compensation are reasonable and consistent with market-based total compensation levels, both on a regional and a national level, albeit at levels slightly below the market median. Employee compensation in the company's view is a cost of providing utility service, not unlike any other prudently incurred cost of service recoverable in rates. Employee compensation must therefore be assessed, we think, through the same lens as other elements of the cost of service. That is, that because the total direct compensation expense is reasonably and prudently incurred, it should be recoverable like any number of other costs within this case. There is a sort of a side issue within the performance compensation subject, and that relates to a statute that's particular to the state of Missouri, Section 386, 315.1, which provides that in establishing public utility rates, the commission shall not reduce or otherwise change any wage, rate, benefit, working condition, or other term or condition of employment that is the subject of a collective bargaining agreement between the public utility and a labor organization. Staff has taken the position that there should be 100% allowance of the annual performance plan amounts paid to union employees because those are paid in accordance with the National Benefits Agreement. Missouri American agrees that at a minimum, this treatment of union APP is required by statute. As to payroll, one of the differences between Missouri American and staff concerns the level of employees to assume for purposes of payroll expense. MAWC's number of employees is based upon each department and functional areas plans to continue providing safe, clean, reliable, and affordable service to its customers. This includes new positions to support the company's increased capital investment program, SCADA operations, and cross-connection program. You'll hear, well, those numbers are 763 full-time employees, 28 temporary summer employees, and 10 interns. Lastly, the difference between staff and company as to capitalization rate concerns the method used to develop that rate or rates. Staff uses, as I understand it, 1 year of labor and labor-related costs and applies 1% to all categories of expense. Missouri American uses a 3-year average of labor and labor-related costs on a category-by-category basis. Using an average in this situation, we believe, provides a more accurate method to mitigate variability year over year, which smooths out uncertainty while setting costs to the appropriate level they're reasonably predicted to occur. That's all I have.
Do the commissioners have any questions? Thank you. Would staff like to make an opening?
Yes, thank you, Commissioner. Thank you, Judge. All right, may it please the Commission. Good afternoon. My name is Andrea Hansen. I'm a staff attorney for the Missouri Public Service Commission Staff Counsel's Office. And before I begin, I do want to warn you it is a lengthy opening statement, so please bear with me. I'm here on the issue of labor and labor-related, which contains, as Mr. Cooper alluded to, originally it contained 6 subparts, but it is also our understanding that the 6th, or one of the subparts, was eliminated in the STIP. So we are only going to be talking about 5 subparts today. So these 5 are incentive performance compensation, payroll expense, payroll taxes, operations and maintenance, or O&M for short, for labor and capitalization, 5, employee benefits relating to group insurance, 401ks, defined contribution plans, or DCPs, etc. I ask that you order the reasonable recommendations put forward by the Commission on these issues. Let's get to sub-issue 1. Sub-issue 1, again, is incentive performance compensation. 3 parties have taken positions on this issue. They are MAWC, Commission staff, and Office of the Public Counsel, or OPC for short. We are here to examine MAWC's request to include the entirety of its incentive compensation expenses in its revenue requirement. Incentive compensation, also referred to as performance compensation, is designed to reward employees for achieving specific performance metrics. However, it is imperative to scrutinize whether these incentives align with the interests of ratepayers and contribute to operational efficiencies. MAWC has 3 incentive compensation plans available to its employees. The first is the Annual Performance Plan, or APP, the Long-Term Performance Plan, LTPP, and the Employee Stock Purchase Plan, or ESPP for short. MAWC asserts that these plans drive operational efficiencies benefiting customers through improved services and cost management. However, upon a thorough examination, it becomes evident that the primary metrics influencing these incentive payouts are financial in nature, particularly the earnings per share, or EPS, growth of the parent company, American Water Works Company. This focus raises concerns about the direct correlation between incentive compensation and tangible benefits to MAWC's customers. Staff's position is that the incentive compensation based upon earnings metrics should be disallowed from cost of service. The Office of the Public Counsel agrees. Its witness, Ms. Angela Shaban, highlights that MAWC has not demonstrated a direct link between its incentive compensation plans and operational efficiencies. She notes that the company's assumption that EPS growth is driven by cost control or efficiency gains is unfounded. Instead, EPS growth can result from various factors unrelated to the company's operational performance in Missouri, such as broader corporate strategies or market conditions. Furthermore, the emphasis on EPS growth primarily benefits shareholders, not necessarily ratepayers. Incentive plans that prioritize financial metrics like EPS may encourage behaviors that enhance shareholder value without guaranteeing improvements in customer service or operational efficiency. This misalignment suggests that ratepayers should not bear the costs of incentive compensation plans that do not demonstrably serve their interests. In light of these considerations, and because the Commission has consistently disallowed incentive compensation based upon earnings metrics, most recently in GR 2021-0108, the staff of the Commission recommends disallowing 50% of MAWC's APP for non-union employees and the entirety of MAWC's LTPP and ESPP plans from MAWC's revenue requirement. This position ensures that ratepayers are not burdened with costs that do not directly correlate with measurable benefits to their service or the utility's operational efficiency. It is crucial for any compensation plan included in the revenue requirement to have clear, demonstrable ties to customer benefits and operational improvements. Absent such evidence, it would be unjust to require ratepayers to fund these incentive programs. Angela Niemeyer is Commission staff's witness on this issue, and Ms. Niemeyer is here today to answer any additional questions you may have on that. The next sub-issue is payroll expense. Two parties have taken positions on this issue, Commission staff and MAWC. Commission staff's position is that the appropriate amount of payroll expense to be included in MAWC's cost of service as of June 30th, 2024, is $46,720,634. Ms. Sherry LeMay is Commission staff's witness on this issue, and Ms. LeMay is here today to answer any additional questions on this issue. It is MAWC's position that the appropriate amount of payroll expense to include in MAWC's cost of service is an amount that includes the 763 full-time employees, 28 temporary summer employees, and 10 interns that represent the appropriate staffing level for MAWC's water and wastewater operations. Commission staff's position is the result of its analysis of data as of June 30th, 2024. In short, staff's position relies on what is known and measurable. MAWC's argument relies on its assertion that it should be compensated for vacant positions because it is actively filling its current vacancies. However, MAWC's efforts to fill its vacancies is not relevant to the analysis. It has been traditional practice in Missouri to rely on a historic test year and the principles of used and useful and known and measurable. So, as laudable as MAWC's efforts to maintain or to staff its company are, if a position is vacant during a relevant past testing period, and so I'm talking about the test year, the update period, and the true-up, if a position is vacant during that relevant past testing period, it is outside the scope of what is known and measurable. And if the commission were to compensate MAWC for these vacant positions, it would be compensating MAWC for something that is not known and measurable. In short, the commission would be compensating MAWC for something that is speculative. The next issue is payroll tax. Two parties have taken positions on this issue: commission staff and MAWC. Commission staff's position is that the appropriate amount of payroll tax expense to be included in MAWC's cost of service as of June 30, 2024, is $3,529,250. Payroll taxes are tied to salaries and wages. Thus, this issue, the issue of payroll tax, is tied to the MAWC vacancies at issue in the payroll expense issue. Staff is of the opinion that if the commission allows MAWC to be compensated for payroll taxes for vacant positions, the commission would be allowing MAWC to collect money for taxes that MAWC may not actually pay. Ms. Sherry LeMay is staff's witness on this issue, and Ms. LeMay is here today, again, to answer any questions that you have. In its position statement on this issue, MAWC states that pro forma payroll taxes were calculated on a position-by-position basis using current 2024 tax rates and pro forma wages for true-up period ending December 31, 2024, and the discrete adjustment applied to the period ending May 31, 2025. The next issue, the second to last issue, is O&M for labor and capitalization. Two parties have taken positions on this issue: commission staff and MAWC. On O&M for labor and capitalization, and the question of what is the appropriate amount of operations and maintenance for labor and capitalization to include in the cost of service, staff's position, or commission staff's position, is that the O&M percentage expense is 53.78% and capitalized at 46.22%. Staff determined this percentage usage, or using the capital and expense totals given by MAWC in response to a staff data request, which comprised the 12 months ending December 31, 2023. Alexis Branson is commission staff's witness on this issue, and Ms. Branson is here today to answer any additional questions. MAWC's position is that the O&M expense percentage should use a 3-year average of labor and labor-related costs as proposed by MAWC. Employee benefits such as group insurance, 401ks, etc., is going to be our last issue. Two parties filed testimony regarding this issue: commission staff and MAWC. Commission staff's position is that the amount of employee benefits to be included in MAWC's cost of service as of June 30, 2024 is $8,256,148 for group insurance, $1,353,677 for 401k, $1,582,968 for MAWC's Defined Contribution Plan, or DCP, $32,659 for Retiree Medical Trust Contributions, or VEBA, and $880,838 for other benefits. Ms. Sherry LeMay is staff's witness on this issue, and Ms. LeMay is here today to answer any additional questions you have on this issue. MAWC believes the 401k benefit expense should be calculated multiplying the employee's base pay by the company's applicable matching percentage factor. An expense in the amount of $1,289,816 should be included in MAWC's cost of service for 401k, and this is according to MAWC. Regarding the issue of DCPs, MAWC explains that under the DCP, DCP, Missouri American contributes in amount equal to 5.25% of an employee's base pay into a retirement account. MAWC believes an expense in the amount of $1,360,396 should be included in MAWC's cost of service for DCPs. MAWC has set up a trust referred to as the Voluntary Employee Benefits Association, or VEBA, which I referred to earlier, to fund this benefit in the amount of $600 per eligible employee. MAWC believes an expense in the amount of $148,646 should be included in MAWC's cost of service for VEBA. Lastly, MAWC believes that its cost of service should include $121,307 for the cost of the ASPP. So to recap, you will now be hearing witness questioning on the issue of labor and labor-related. This issue contains 5 subparts: incentive and performance compensation, payroll expense, payroll taxes, O&M for labor and capitalization, and employee benefits relating to group insurance, 401ks, defined contribution plans, etc. I thank you for your time, and I ask that you order the reasonable recommendations put forward by commission staff. Thank you.
All right. Do you have any questions, commissioners? All right, thank you. All right, Mr. Kaufman is indicating he is not going to give an opening statement on this topic. So, Mr. Kleiser, for the public counsel.
Good news, I promise I'm going to be a lot shorter. So, again, John Kleiser, you know who I am, Office of Public Counsel. This issue right now, well, first of all, you're going to hear the follow-over from the last issue we just discussed, because evidently part of that support services kind of bleeds into this one. But as far as the rest of the issues that are up, right now the OPC's only position is on the incentive compensation. So that's the only thing I'm going to talk about. And for what it's worth, I think that staff counsel did just a wonderful job of really summarizing it, so I'm just going to try and keep myself at a really high level. There's 2 incentive compensation programs out there. You have the APP, and that's the thing that you have in front of you. That's the handout. I'm going to go over that in a second. And the other one is called the LTPP. The LTPP is really kind of mostly focused, I think, at higher level individuals within the Missouri American Water business. So really kind of more your board executives kind of situation. And it really is based almost 100% off of financial success. It uses a combination of earnings per share, relative total shareholder return, and return on equity to establish returns. That kind of incentive compensation program has routinely been denied by the commission because it's really only there to benefit shareholders. You know, if you're giving people a bonus because they're able to earn a better return for their shareholders, that's fine, but shareholders are the ones who should be paying for that, not ratepayers. So what's the APP? Well, it breaks down in this handy table, and this is taken, I believe, I want to say from the testimony of Mr. Carlson on behalf of Missouri American Water. I believe it's in his testimony, but it sort of breaks you down on how the APP is weighted. And you see that the first 50% of it is, again, based on earnings per share. So it's that same exact logic again. We are awarding Missouri American Water employees for being able to produce better returns for their shareholders, which, I want to clarify, the OPC has no problem with this performance program. Our problem is who pays for it. If shareholders are getting the benefit, shareholders should be the one to pay for it. Now, the other 50%, it kind of breaks down a little bit, and you might be looking at some of these things and saying, John, don't you want to encourage, avoiding OSHA violations? Don't you want to encourage avoiding drinking water violations? And honestly, the simple answer to you is that we feel that all of these things are included in here are things that they should just be doing regardless. We believe it's part of their mandate to provide safe and adequate service, and that we don't need to be offering an incentive compensation program to benefit employees from for avoiding like an OSHA violation. It's just something that should naturally be occurring. It reminds me, I don't know, there's this old joke, right? You have a guy is walking, he's traveling, he's walking through a market, and he sees a man selling a rock for an exorbitant price. And he goes up to him and he says, why is this rock so expensive? And the seller says, oh, this is rock. It was enchanted by a wizard. It keeps away tigers. It'll protect you from being attacked by tigers. And the guy goes, how on earth can you tell that's the case? And the man says, well, look around. Do you see any tigers? Right? It's kind of like that. You have these programs that say, well, we're going to try to avoid OSHA violations. Well, the only evidence that the company has is basically to just point to the number of OSHA violations. But you have to ask yourself, if you took away this incentive compensation program, do you really think they would suddenly have a spike in OSHA violations? I personally don't. And that's really kind of the basis for our argument. We don't need to be providing incentive compensation programs to encourage this behavior. It should be built into the company's basic nature of operations. And to really just close on that point, I'm going to quote to you the Illinois American Water case, docket P20220210. Again, this was the Illinois Commission, stated, incentive compensation programs related to financial goals primarily benefit shareholders, and those costs should not be recovered by the utility ratepayers. And then they go on to say, Illinois American Water Company argues that its performance pay programs provide customer benefits through reduced expenses and greater efficiencies. However, Illinois American Water Company has not shown that these customer benefits were caused by the performance metrics related to the financial goals rather than the company's operational goals. And that's really at the heart of this. The benefits that would supposedly come from this should be drawn from the company's operational goals, not from these actual metrics. So providing them is unnecessary, and customers shouldn't be paying for them. All right, that concludes my thoughts, and I'll take any questions.
Mr. Kleiser, just so I can understand OPC's position, your OPC's position is to disallow all of cost associated with the annual performance plan?
Correct. And I do want to make sure this is very clear, because it reminds me of another point that was brought up. At no point are we saying that they shouldn't have the plan. We are just saying that customers should not be the ones paying for it. They should be recovered from shareholders. And the reason I want to stress that is because one of the other issues that was mentioned was this regard to union workers, right? There is a law out there. And what the law says is that this commission cannot interfere with the agreements reached between the union and the company. We are not asking you to do that. We're not asking you to change the terms of the agreement between the union and the company. All that we're asking you to do is say that shareholders bear the responsibility of paying that incentive compensation program. Nothing in the law says who has to pay for it. It just says you all can't change it. And we're not asking you to change it. We're just asking you to determine that shareholders should bear the cost of paying for an incentive compensation program designed to benefit shareholders. I know that was more than you asked. I apologize, but that reminded me of that point.
That's okay. And then also, I'm assuming that OPC would share the same positions then, and I'm just clarifying that long-term performance plan and the employee stock purchase plan should also be excluded?
Yes, and those two are even more so very clearly drawn exclusively on promoting earnings per share and total shareholder returns. Those are the exclusive metrics by which those are gained.
And I think you mentioned that those have historically been excluded by the commission. Similar stock compensation had been
It is my belief that the commission in the past has excluded incentive compensation programs where it found that those incentive compensation programs primarily benefited shareholders.
Okay.
I got to slow down. The court reporter is going to get really mad at me.
Thank you.
All right. Thank you, Mr. Kleiser. If the company will call their first witness.
Yes, Your Honor, we would call Robert Mustich.
Good afternoon. Would you raise, you do have your right hand raised, thank you. Do you swear or affirm that the testimony you give in this hearing shall be the truth, the whole truth, and nothing but the truth?
I do.
Thank you. Go ahead, Mr. Cooper.
Would you please state your name?
Robert Mustick.
And by whom are you employed and in what capacity?
Willis Towers Watson. I'm a managing director of our rewards practice for the East Region.
And are you appearing on behalf of Missouri American Water Company today?
Yes, I am.
Have you caused to be prepared for purposes of this proceeding certain direct testimony in public and confidential versions and certain rebuttal, surrebuttal, sur-rebuttal testimony, both in question and answer form?
Yes, I have.
Is it your understanding that that testimony has been marked as exhibits 20P, 20C, and 21 for identification?
Yes, I do.
Do you have any changes that you need to make to that testimony at this time?
No, I don't.
If I ask you the questions which are contained in exhibits 20P, 20C, and 21 today, would your answers be the same?
Yes, they would.
Are those answers true and correct to the best of your information, knowledge, and belief?
Yes, they are.
Your Honor, I would offer exhibits 20P, 20C, and 21 into evidence and tender the witness for cross-examination.
Are there any objections to those exhibits coming into evidence? All right, exhibits 20, the public and confidential versions, and 21 are admitted into evidence. And staff, your witness.
I have no questions at this time.
No questions, Your Honor.
Mr. Coffin?
No questions.
Are there questions from the commissioners? Yes. Commissioner Coleman.
Thank you, Judge. Is it Mustick?
It's Mustick.
Mustick.
Yes.
Like
a K on the end. The H always makes it sound different.
Oh, that makes a difference.
Yeah.
Like a stick.
Yes.
Okay, thank you. So, who determines the performance compensation goals or criteria for the awards that are included in the compensation packages for Missouri American?
The company does, the parent company.
And parent company, make sure I get it right, that's the AWWS. Does that make sense?
Yes, American
Okay.
Water.
All right. I couldn't get the whole thing out, so I decided I better try to get the acronym, there are 18 million.
Yes.
Is there any requirement that performance compensation goals be based on the financial performance of Missouri American or even the parent company?
It's the parent, it's the overall team. Those goals are set, both financial and operational.
Okay. Thank you, Judge. Thank you.
Thank you.
Judge, if I may,
Yes, Commissioner Mitchell.
would you just at a high level, just walk us through the three programs, what the performance metrics are, and then how the payout works?
Yeah, so you have the annual performance plan, and that has a series of metrics. 50% is on earnings per share, and 50% are on operational metrics, which will include like customer service, environmental compliance, customer service safety. So there's what is considered a balanced scorecard, which the majority of peers have and industry in general has. When you look at annual incentive plans, you want to have a balance between being financially viable and then also having good, operational performance. So the annual performance plan is sort of balanced and set that way. Then there's the long-term incentive plan, which is for the senior executives, and there are two main components there. There's performance shares, which are tied to the stock of the company plus total shareholder return and earnings per share and return on equity. And those metrics determine whether those awards are awarded, and it's over a 3-year period. So while there are financial metrics tied to that portion of the plan, the real benefit also to customers is ensuring that executives are retained. Those plans they have 3-year vesting. If they leave before the 3 years, they don't get the full award. So it's also a retention component. And then there's also restricted stock, which is just stock that's tied to a 3-year vesting also, which is really focused on retention. And those plans are, again, mutually beneficial for shareholders, employees, and customers. Again, I heard, earlier about the plan sort of being, parsed out to shareholders or customers or employees. They're typically designed to be mutually beneficial because they're impacting all three. And this employee stock purchase plan, I didn't study that as part of this because I don't consider that a compensation program. It's more of a benefits type of program where the employee is able to purchase stock at a discounted rate. So it's not part of the compensation study that I've done for the company. It's not considered like part of total direct compensation, which would be base salary, the annual incentive, and the long-term incentive.
Okay, so the stock purchase is strictly an expense to the employee who might elect to purchase that stock?
Yes, that's my understanding of the program that American Water has.
Okay. And could you drill down a little bit to Missouri specifically? If, for example, if Missouri were to, those employees in the Missouri organization were to meet their goals and the company as a whole did not, then they wouldn't get compensated. Is that fair to say, or?
Correct, because it's part of the overall team in terms of the incentive programs. The company made those changes about 3 years ago, where it's more of a overall team incentive program or performance-based program.
Okay, so I just want to make sure I understand. If the parent company and all its subsidiaries meet their goals collectively, then the performance payouts occur.
Correct, and the way this program is set up also, which sometimes there's always like a misunderstanding. It's not like an add-on bonus program where if you don't have the annual and the long-term incentive plan, you're still paid competitively. You're actually not, because the programs, like the majority of the other companies that we compare to, it's an integrated program. You have to have both programs included for the compensation to be competitive. You couldn't say, well, base salary alone, they'll be competitive. If they don't receive that performance compensation, then they're actually below the competitive rate of pay. That's why it was what was mentioned earlier about the Illinois case. West Virginia recently, much more recent than the Illinois case, came out and said, overall compensation is reasonable, and it's tough to like arbitrarily take a portion of compensation and say, well, it goes to shareholders and a portion goes to customers, because it's mutually beneficial. I actually state that in my rebuttal testimony.
And can you help me understand how the financial performance of the company, and that being a part of some of the incentive programs, how do benefits from that flow to the consumer?
Well, I think with like any incentive plan, even like a not-for-profit incentive plan or incentive plan for charities, being a financially viable organization is important to customers. An organization that's efficiently run. The plans send very strong messages to employees to be productive and efficient in terms of doing their jobs. So there's not like a one-to-one necessarily correlation, but it's a real strong message that financial performance is also important. And that's why it's balanced, right? We have financial, and then we also have, the customer service. We've got, operational metrics. There's a balance across the metrics that are communicated to employees.
And can you discuss, if this isn't confidential, about what percentage of the total compensation is at risk in these programs?
It varies by, by position. So if you're at the, the union level, it might be, 3% of base pay, say, is the amount that goes toward the annual performance plan. If you're more, senior in the organization, it may be, 20 or 25%. I sort of detail that in my report without, going over like the individual positions for confidentiality, but there's a variance, across the positions. And we looked at that against what the market does, and it's the amount that's provided to Missouri American Water employees is, very consistent with other companies provide in the market.
Thank you. That helps me understand.
Thank you.
All right. Recross by staff?
Just very briefly, I think. Good afternoon, Mr. Mustick.
Hi.
I think you mentioned earlier that the earnings-based performance incentive was tied to the earnings per share of the parent company, American Water Works Company. Is that correct?
Correct.
Is there anything within Missouri American's performance plans that tie to earnings or efficiencies directly with Missouri American?
No, I mean, they all sort of roll up to the overall company, but it's not like a specific component of the incentive program.
So would it be correct to assume that employees could earn incentive pay based on essentially performance of other affiliates driving up share price of the parent company?
Well, I wouldn't say necessarily share price. I mean, it's earnings per share, so all the companies are tied to that. So it's sort of a team, especially when you have like shared resources across the different affiliates. They're all sort of sharing, resources rather than just, being in their own particular silo. That's why the plans tend to be broader. So there's collaboration, across the organization.
But would it be hypothetically possible for earnings per share driven by other affiliates to provide employees of Missouri American performance-based pay?
Well, it's part of the program, so it would.
So would that be a yes?
Yes.
Yes, thank you. No further questions.
Public counsel?
Yes. Good afternoon.
Good afternoon.
You were asked a question by Commissioner Mitchell about the consumer benefits that might flow from this earnings per share, and I want to kind of drill down on that. First of all, do you remember that line of questioning?
Yes, I do.
Okay. So we're sitting in a rate case right now, and as part of a rate case, you would agree with me that the the commission is going to set rates that will include an expected cost for the company to meet its continued operations, right?
Correct.
Right. And so, for example, they might have an expense item. Let's pick one at random. Let's say like chemicals, right? The commission is going to set rates based on what it thinks the cost of chemicals is going to be moving forward. Is that right?
I would assume, yeah.
Right. So if an employee, after rates are set, manages to find a way to reduce the cost of chemicals, that's going to produce a benefit for the company, because then they're going to have money in the rates. Let's say they put $1 million in rates to pay for chemicals. Now, if they've reduced the cost, it's $900,000. That $100,000 is something that's retained by the company. Is that correct?
I guess so, correct.
And that's what's going to boost that earnings per share, right? Or rather, it's going to boost their overall revenue, which should boost earnings per share.
But I would assume, yeah.
Right. And that $100,000, it doesn't flow back to customers because rates have already been set. Until the next rate case occurs, basically the company is just earning that money.
Okay.
Would you agree with me on that?
Yeah.
Yeah. Okay. That was it. No further questions.
Mr. Kaufman, any questions?
No questions.
All right. Mr. Cooper, redirect.
Couple things. Let's continue your conversation a little bit that you just had with Mr. Kleiser. In his example about chemical prices, does it also sort of highlight the fact that when you talk earnings per share, there's many ways to get to increase earnings per share, right?
Correct.
And I think in answer to Commissioner Mitchell's questions, you talked about efficiencies. Could you expand a little bit on that, on how that might impact earnings per share and be to the benefit of customers as well?
If, the customers, if the employees are being, more efficient or more productive, that's going to benefit the customers.
And that can have an impact on that earnings per share.
Correct. Cost containment.
You made the point earlier that the wages weren't necessarily competitive without the performance incentives, correct?
Correct.
And this is probably asking you for a bit of a summary of your testimony, but given that, thinking exactly how to ask this, but given that, if the company does not, well, if those performance incentives were put into base pay, would your study say that that base pay would continue to be reasonable and prudent for the company?
Well, the base pay would be higher as one component, so it would be probably above the competitive rate. But when you look at the total program, it would be competitive. So we're seeing some companies do that in order to get full. Because again, when you look at the total package, it's competitive. It's just a delivery that right now that's being disputed of how it's being provided to employees. But if it was all in base pay, the total package would be competitive, and management will lose an important tool. You lose important communication to employees in terms of what's important, which again is a balanced scorecard of financial, customer, safety, operational metrics.
That's all the questions I have, Your Honor.
All right. Thank you, Mr. Mustick. You may step down.
Thank you very much.
Your Honor, Mr. Mustick, if you'll recall, was one of the people with some travel issues. May he be excused?
Right. Yes, as far as I'm concerned, yes.
Okay, thank you.
And then you may call your next witness.
We would call Mr. Jody Carlson.
Good afternoon. Would you raise your right hand? Thank you. Do you swear or affirm that the testimony you give in this hearing shall be the truth, the whole truth, and nothing but the truth? All right. Thank you.
Please state your name.
Jody Carlson. That's JODYCARLSON.
By whom are you employed and in what capacity?
Missouri American Water. I'm the Vice President of Operations.
Have you caused to be prepared for purposes of this proceeding certain direct, make sure we don't have any confidentiality associated here. We do not. Certain direct testimony and certain rebuttal testimony in question and answer form?
I have.
Is it your understanding that that testimony has been marked as Exhibits 4 and 5 for identification?
It is.
Do you have any changes that you would like to make to that testimony at this time?
I have one small clarification from my direct testimony. It's in the rebuttal testimony on page 30, lines 3 through 5, where we made the statement, we've corrected it there, that need to be corrected to reflect that we will only verify the email was delivered, and not that it had been opened, but that's in my rebuttal testimony.
Well, let's back up a little bit. Do you have your testimony in front of you?
I do.
Okay.
Yes.
Turn to your direct testimony.
Yes.
And page 48 of that,
Yes.
and so the correction that, this is kind of circular, but that you referred to in your rebuttal testimony that would result from that is found on lines 16 and 17, correct?
That's correct, yes.
In both instances on those lines where the words "and opening" appear, those would be deleted, correct?
Correct, thank you.
If I were to ask you the questions contained in Exhibits 4 and 5 today, would your answers, as now amended, be the same?
They would.
Are those answers true and correct to the best of your information, knowledge, and belief?
They are.
Your Honor, I would offer Exhibits 4 and 5 into evidence and tender the witness for cross-examination.
Are there any objections to the admission of those exhibits? Exhibits 4 and 5 are admitted. Go ahead, Mr. Johnson.
Hopefully it'll be very brief. Good afternoon, Mr. Carlson.
Good afternoon.
I have just a few questions for you. We've gone over the performance plans for Missouri American. I believe they are the annual performance plan and the long-term performance plan. Is that correct?
Correct.
And it's Missouri American's position that the entirety of the costs associated with those plans should be included in Missouri American's cost of service. Is that correct?
Correct.
And each of those plans incorporate, I'll refer to it as earnings-based incentives within that plan. Is that correct?
That's correct, just as witness Mustich referenced.
Thank you. And I believe you state in your, I think it's rebuttal, surrebuttal, and surrebuttal testimony, I think on page 13, lines 15 through 17, that it's your belief, or maybe the company's belief, that when financial performance is achieved through efficiency, the interests of customers, employees, and investors are aligned. Did I state that correctly?
You did.
Now, do Missouri American's performance plans include any specific goals relating to increasing efficiencies?
They are broke out into the 50% on the performance side and then 50% on the financial side.
Okay. Well, the 50% on the performance side, I see customer-related, and I think that involves customer satisfaction. Is that correct?
Is that from my testimony you're
Yes, it
referring?
is. I apologize.
Okay.
I'll check the correct page. This would be on page 39 of your direct testimony.
Thank you, appreciate it.
Absolutely. So what I see is that in that performance portion that you referred to, we have customer-related, which I believe is customer satisfaction, correct?
That's 15%, yes.
And then you have safety-related, which would be OSHA recordable injury rates and days away restricted and transfer severity rate.
Correct, which is 15, yes.
And then lastly, there are environmental safety provisions relating really to notices of violation for drinking water compliance and water quality.
Correct, at 15, yeah.
And then finally, there's some, I'll say, employment initiative.
Correct.
Correct.
Thank you.
Do any of those pertain specifically to increasing efficiencies?
I would say that all of those, on the performance side, customer satisfaction, I mean, we could go through, a lot of those, but it really goes back to our employees that are working in the field, that are interacting with our customers. It could be someone in the field, it could be our call center, or it could be those that interact, and how they handle those individuals is tied directly to their performance and making those customer satisfaction results. Those recordables on our safety performance as well, making sure that we are doing the things in the field that need to be done to drive that safety. So they're all of these, I would say, yes.
And are those efficiencies different than the efficiency you were referring to when discussing financial performance?
Are you referring to the growth on the earnings per share?
Yes.
Yeah. I personally would say that a lot of the performance metrics that we iterate and drive towards impact the financial side of that equation, those 50% as well. So the performance metrics drive the financial for the business.
So the performance, I want to get this correct, the performance metrics that are outlined in the APP plan drive the financial aspects of the plan?
A lot of these performance items that we do, and then the key metrics that we measure across the business, whether that's going out and turning valves, whether the things that our folks in the fields continue to do to drive performance efficiencies.
Okay, so am I hearing correctly that at least the APP plan rewards employees for efficiencies, operational efficiencies within the 50% related to customer safety, environmental leadership?
That's part of their compensation package.
And then they are also rewarded for growth in earnings per share that could be created by the efficiencies they are already being rewarded for?
All part of their entire package, compensation package.
Okay. Would you agree with me that increased financial performance of the utility could be due to actions that may not align with the best interests of ratepayers?
I don't understand can you rephrase that again?
Sure. 50% of the APP, and I believe the majority of the LTPP, tie performance payments to growth in earnings per share.
Correct.
Correct?
Yes.
Would you agree with me that there are actions that a utility could take that increase earnings per share that may not be in the best interests of its ratepayers?
No.
No? Okay, thank you. Hypothetically, could a utility increase its earnings by cutting staff or perhaps outsourcing critical services like customer service?
Hypothetically, I believe that these.
Mr. Carlson,
Yeah.
that was a yes or no question.
Hypothetically, yes.
Could postponing necessary upgrades or maintenance increase short-term earnings, at least?
Hypothetically, yes.
Could seeking aggressive cost recovery mechanisms like riders, surcharges, or trackers increase earnings for the utility?
We could probably go through a lot of things hypothetically.
All right, but you understand my point. Thank you. Mr. Carlson, in your opinion, could a performance or incentive plan be designed that includes specific goals or metrics for creating efficiencies? Pardon me, I'm sorry, I lost my place. Decreasing waste or boosting productivity? And if you need me to repeat that, I can.
If you would, that would be
Absolutely,
great, thanks.
I apologize. In your opinion, could an incentive or performance plan be designed that includes goals or metrics specifically relating to efficiencies, decreasing waste, or boosting productivity?
Or decreasing productivity?
Boosting productivity.
Boosting.
Apologies.
Sure, yes.
Okay. I have no further question. Well, I'm sorry. I do have one further question. My mistake. I'm going to go in a little bit different direction. In your rebuttal testimony, I think on page 3, lines 13 through 14, you state vacancies are the result of employees retiring or otherwise leaving the business, but these positions continue to be critical skilled positions that must be timely filled. Did I get that correct?
That's correct, yes.
I think on the same page on line 21, you state that Missouri American is actively filling its current vacancies. As you sit here today, do you know how many vacant positions Missouri American had as of the update period in this case?
As of the update period, I don't know exactly.
And do you happen to know how many vacancies there were as of the true-up period in this case?
I do not.
Do you know how many vacant positions there are today?
I do not.
Thank you, Mr. Carlson.
You're
That's all
welcome.
the questions I have.
Thank you.
Mr. Kleiser, do you have questions?
No, Your Honor, thank you.
Mr. Kaufman? No questions. All right, thank you. Do the commissioners have questions? All right. Mr. Carlson, I have just one question, and I don't know if you can answer this question, but you were here earlier, I believe, when Mr. Mustick testified that these performance goals were set at the American Water Works level, correct?
Yes, sir.
Do you know if those people that are setting these performance goals for the company as a whole are aware of the commission's historical treatment of financial related goals and customer benefit related goals being recovered as part of employee compensation?
I don't know if they know that or not.
Okay. All right, that's my only question. Is there any recross on that question? Mr. Johnson?
No questions, thank you.
All right. And then, Mr. Cooper, is there any redirect?
Yes, Your Honor. Mr. Carlson, you were asked some hypotheticals by staff counsel about ways to increase earnings per share short term, and I think one of the hypotheticals was cutting staff might possibly increase earnings per share short term. Do you remember that?
Yes.
What would be the consequences of those sort of actions on a long-term basis?
Our customer satisfaction would go down. Long-term repairs, investments would also be challenged. That would not be anything that we would want to do.
You were asked various questions about vacancies as they exist today, but you are involved somewhat on the hiring side, aren't you?
Yes.
Are you aware of how many offers that the company has out as of today?
As of yesterday, I know that there were 10.
Okay. And are there other positions actively being advertised?
Yes, as of yesterday, I know there was, I believe, 35 to 40 that were still posted.
You were asked at the end by the RLJ a question about whether you were aware of what the knowledge might be at the American Water level in terms of historic treatment of performance incentive plans. But let me kind of get back at this a little bit. You worked, prior to coming to work for Missouri American, you worked many years for other employers, correct?
Yes.
And when you worked for those other employers, were there performance plans in those positions?
I've been an engineer for over 30 years, worked at different places. Different locations had goals for us, but they were not tied to our entire package, pay for performance package. And it was notably different in the direction the companies that I worked for went. Having that part of our entire package drives employees where we want to focus at, and that's efficiencies and doing the best that we can.
So your experience would be that in terms of your ability to get work done, the performance of the company, it's been much improved in the environment where you have these performance incentives in place?
Absolutely, yes.
That's all the questions I have here.
All right. Thank you, Mr. Carlson.
Thank you.
And Mr. Cooper, you can call your next witness.
Excuse me. We would recall Mr. Cifuentes.
You can have a seat. You've already been sworn in, so Mr. Cooper, go ahead.
We would tender Mr. Fuentes for cross-examination.
All right. On behalf of the staff?
I do have one question for Mr. Cifuentes. Mr. Cifuentes, in your rebuttal testimony, or your rebuttal testimony, sir rebuttal testimony, on page 8, lines 4 through 9, you say, and I'm only going to read part of this passage, but it says, MAWC has two methods by which it can present the cost structure to accomplish its work. And when I say accomplish its work, I'm talking about staffing and payroll expense. So again, MAWC has two methods by which it can present the cost structure to accomplish its work. Number one, assume no vacancies and adjust overtime, temporary employee, and contractor expenses accordingly. Or two, assume a vacancy rate and include increased expenses for overtime, temporary employee, and contractor expenses to complete the work. The company chose the first methodology and presented its cost structure accordingly in its revenue request. Mr. Cifuentes, is this correct? Did MAWC choose the first method?
Yes, that is correct.
Correct? Okay. All right, so I'm going to repeat this, make sure that I wrap my head around it. So method number one says assume no vacancies and adjust overtime, temporary employee, and contractor expenses accordingly. Mr. Cifuentes, were there vacancies during this time?
At what time period could you specify?
When you formed this cost structure?
If you're referring to as in terms of the initial filing, the company started with a full head count of 704 employees, included 59 vacancies, and included 28 interns and 10 summer interns, not summer interns, but 10 other, 28 summer temporary employees.
So you're saying that there were vacancies at this time, is that correct?
We're including that there's empty positions that we're including into the revenue requirement for the labor and benefits.
But here you say that you're assuming that your first method assumes that there are no vacancies.
Yes, we're assuming that those positions will be filled.
That they will be filled, but they were not actually filled at that time, is that right?
That is correct.
That is correct?
As Jody Carlson has mentioned, that they're actively
Sir,
hiring
sorry,
for those
one moment.
positions.
So you're saying that they are not actually, that these positions are not actually staffed, that you were doing, or that you were assuming no vacancies on the presumption, or on the, I guess, the effort that you were actively filling current vacancies. So my question to you, and it's a yes or no question, is that assumption that there is no vacancies, is that based on known information?
Could you state the question again?
So you assume that there are no vacancies. Is that based on the information that you knew at that time?
We're assuming that there's 704 employees starting off, and then we're assuming that we're going to include a full head count to do the necessary work for the state of Missouri, as witness Jody.
Thank you. I appreciate what you said, but you also said that there were 59 vacancies at that time. Is that correct?
Yes, 59 vacancies that we're trying to hire for.
That you were trying to
59
hire
positions
for,
that we're
yes,
including.
that's correct. But your methodology, or the method you used, was to assume that there were no vacancies. So what I'm trying to say is that there is a disconnect between your assumption of no vacancies and the known information that you had, that there are 59 vacancies at that time. So my question to you is the assumption that there are no vacancies, is that based upon known information?
Yes, yes, we do know that there are positions that we're trying to hire for.
That was not my question. My question was,
Objection. I think he has answered the question, though.
I'll sustain the objection.
oh, okay. Thank you.
You're welcome.
All right, Mr. Kleiser, do you have questions on cross-examination?
No cross-examination questions. Thank you, Your Honor.
Okay. Do the commissioners have questions? All right. Hearing none, I have a few questions, and they're along the same lines. But I'm going to take you first to your direct/rebuttal testimony, page 9. Around line 19, you state MAWC's proposed labor and labor-related expenses begins with a starting point of 704 full-time positions as of March 31st, 2024, with 97 positions layered in for the pro forma period. What is the pro forma period, first of all?
The period would be that the 5/31/2025 period.
Okay. How many annual hours are included in your labor and labor-related expense calculation for each summer intern and the other interns?
For the annual hours, that would be included in the company schedule KS 13 and KS 9. The annual hours, I would have to review the schedule, but it's done on a prorated basis. I have to just verify that.
Okay. But that information can be found in the that schedule?
That is correct.
Okay. Do you know how many full-time positions were vacant as of December 31st, 2024?
That'll be approximately, as of December 31st, 2024, that'll be approximately around 58, 59. So during that time period, there were hires, and then there was also, with the normal course of business, people come and go within the business. So it might have went up, went down, but it stayed around maybe 58, 59.
Okay, so same as March 31st?
Yes.
Okay. And now I'll take you back to page 8 of your rebuttal, Sir rebuttal. And that same statement that Ms. Hanson was asking you about, why would it be necessary to increase overtime hours if the actual labor costs reflected a reduced workforce where overtime was already included to compensate for that reduced workforce?
I can say that the necessary hours are included because the work has to get performed to provide a safe, reliable service for the communities within Missouri, American Water. If we don't have those employees, then obviously we'll have to go through contractor services. If we're not going through contractor services, the current existing employees will have to, incur additional overtime.
All right, thank you. Does staff have any recross?
No, thank you.
OPC? Okay. And then, Mr. Cooper, any redirect for the company?
No question.
All right. Then, you're free to go. Appreciate your testimony.
Thank you, Judge. Thank you, Commissioners.
And if I'm reading the schedule correctly, there are no further Missouri American witnesses on this issue?
That's correct, Your Honor.
Then staff, call your first witness.
Thank you, Judge. Staff calls Alexis Branson.
All right. Ms. Branson, would you raise your right hand? Thank you. Do you swear or affirm that the testimony you give in this hearing shall be the truth, the whole truth, and nothing but the truth?
Yes.
All right, thank you. And you may sit down. Thank you. Ms. Klaus, will it be you? All right.
Alexandra Klaus on behalf of staff. Good afternoon, Alexis.
Good afternoon.
Can you please state and spell your name for the record?
My name is Alexis Branson, ALEXIS BRANSON.
By whom are you employed and in what capacity?
I'm employed by the Missouri Public Service Commission as a utility regulatory auditor.
Are you the same Alexis Branson who filed direct/rebuttal testimony that has been marked as Staff's Exhibit 204?
I am.
Do you have any changes or corrections to your testimony?
No.
Your testimony is true and correct to the best of your knowledge and belief?
Yes.
If I asked you those same questions today, would your answers be the same or substantially similar?
They would.
Judge, I move for the admission of Staff's Exhibit 204 and tender the witness for cross-examination.
All right, thank you. Is there any objection to the admission of Exhibit 204? All right, hearing none, Exhibit 204 is admitted. All right, Mr. Cooper.
No questions.
All right.
No questions, Your Honor. Thank you.
All right. Yes, Commissioner Kolkmeyer.
Yes, I have a quick question. Thank you, Judge. Good afternoon.
Good afternoon.
I'll make it quick because it's getting late in the day. But when you audit the books, are you auditing the actual payroll expenses, or are you auditing the projected full staffing numbers?
Actually, my responsibility was solely on the O&M capitalization factor. I did not personally touch payroll. That would be a question for Ms. Sherry LeMay.
Okay, thank you.
All right. And I have a quick question. Will staff be updating their labor-related capitalization percentages and expense amounts through December 31st, 2024 in true-up testimony?
We had not planned to. It was not one of the things that was labeled as something that was going to true up in Kimberlin's testimony.
Okay. All right. Is there any recross by any of the parties? All right. Any redirect?
No, thank you, Judge.
All right. All right, Ms. Branson, you're free to go. Thank you. And staff may call their next witness.
Thank you. Staff calls Ms. Sherry LeMay.
Good afternoon, Ms. LeMay. Would you raise your right hand, please? Do you swear or affirm the testimony you give today in this hearing shall be the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Ms. LeMay, can you please state your name for the record? Spell your last name, please.
Sherry LeMay, SherryeLesmes.
By whom are you employed and what is your position?
The Missouri Public Service Commission as a utility regulatory auditor.
Have you prepared and filed testimony in this proceeding, specifically direct testimony and rebuttal testimony, which have been pre-marked as exhibits 207 and 220 respectively?
Yes.
Do you have any changes or corrections to make to any of these documents?
No.
If I were to ask you the same questions in those documents today, would your answers be the same or substantially the same?
Yes.
And are those same answers true and correct to the best of your knowledge and belief?
Yes.
I offer exhibits 207 and 220 into evidence and tender the witness for cross.
All right. Now, the list that I was provided has 220 as cross rebuttal, sir rebuttal for Ms. Malky.
I apologize, that's 219.
Okay. So is there any objection to Exhibit 207 or 219? All right. Then I will admit Exhibit 207, both public and confidential versions, and 219. And Mr. Cooper, do you have questions?
I do, thank you. Ms. LeMay, were you here earlier? Well, let me back up. Are you familiar with DR 265, to which staff responded in this case?
Yes.
And that was a DR that you were responsible for, correct?
Yes.
And it concerned, as I understand it, a recounting of staff's sort of relook at various job positions, correct?
Yes.
And the sort of the explanation of that is an attachment, or the spreadsheet associated with DR 265 is a schedule to Mr. Cifuente's rebuttal, sir rebuttal, sir rebuttal, correct?
Yeah, I believe so, yes.
Okay. And within that response, that spreadsheet, you go through and you, position by position, explain the staff, as I understand it, updated payroll position, correct?
Yes.
And most of those explanations start with information Missouri American provided in DR 243 and 243.1, correct?
That's correct.
Okay. And does that represent a change in position, I guess, after the filing of your cross rebuttal testimony?
After my direct, yes.
Would it, and I guess maybe there was no calculation of payroll expense that shows up in the cross rebuttal, is that correct?
No, there was a correction after the cross, or at the cross. I apologize.
At the cross rebuttal stage?
Yes, that is correct.
Okay. Okay, that's all the questions I have at this time, Your Honor.
All right. Thank you, Mr. Kleiser. Any on behalf of Public Counsel?
Yes, I will try to make this brief. Good evening, Mr. Lemay. So again, I don't know if you were here earlier, but Ms. Sarver informed me that you were the person I needed to talk to when it came to this whole support services payroll component. So my question is focused mainly on that. It is correct that you were the staff employee who effectively was going through and determining whether or not support service payroll expenses should be included as part of the staff's recommendation. Is that accurate?
Yes, that's correct.
And you made disallowances related to, for example, business development and external affairs payroll, correct?
Correct.
And is it my understanding that for most of the external affairs, you were making the disallowance because staff concluded that the jobs were primarily focused on lobbying?
And political activities, yes.
Okay, so to the extent that staff claims that it was removing the lobbying expenses, that would include necessarily removing the external affairs and policy payroll related to the support services.
I need to clarify with you that what piece we're talking about that I handled was support services payroll only. The lobbying expenses were part of miscellaneous expense, separate issue.
I understand that, and I want to make sure that this is very clear. There were payroll expenses included in the support services related to external affairs and policy that were disallowed because you concluded they were effectively lobbying, that the individuals were engaged in lobbying. Is that accurate?
Yes.
Okay, so part of the removal of the payroll expenses for the external affair positions were removed because they were associated with lobbying.
Correct.
All right, that's the part I needed to make sure. And then again, you also removed the business development payroll expenses as well, correct?
Some of the positions that were classified as business development were excluded.
All right. And is it correct to say that the position of staff was that these costs were excluded primarily because they were not, they benefited shareholders over ratepayers?
That would be correct.
All right. And then as one last thing, as part of staff's investigation, when it reviewed the investor relations component of this, how closely did staff consider the performance related to the development of environmental sustainability, ESG report, environmental, social, and governance reports, or ESG reports?
That was not a consideration in the evaluation. It was more a matter of investor relations was looked at from the viewpoint that it benefited both the investor, the company, and the consumer.
Okay. All right, no further questions. Thank you for your time.
Any other cross? All right. Hearing none. Commissioner Kolkmeyer.
Thank you, Judge. Good evening, Ms. Mays. I'm going to ask you the same question I asked Ms. Branson about did you take any of that payroll out, or no? Do you audit the actual numbers, or do you put in projected numbers or a budget number for full staffing?
Sure. Actual.
Actual.
Correct.
Okay, thank you. And you left all of the investor relations in there,
Correct.
even the expense side, but you only deal with the payroll, correct?
Only the payroll.
Only the payroll. Okay, thank you. Thank you, Judge.
All right. Ms. LeMay, when it comes to the June 2024 amounts, will you make adjustments to those amounts related to payroll to bring the cost of service out to the December 31st, 2024 in your true-up testimony?
The work product that I did was one as of 6/30/2024. We did agree to do a true-up through December 31, 2024, so that will happen.
Okay. That was my only question. Would any of the parties like to recross based on the Commissioner's question or my question? I'm seeing no's. any redirect?
Ms. LeMay, MAWC referred a little bit to the schedule attached to Mr. Cifuentes', I think it's his rebuttal, sir rebuttal testimony. Can you tell me a little bit more about these positions?
If I may clarify and identify the document, it is labeled Schedule MCJ-1, is that correct?
That is correct.
Okay. So this would be my response to their DR request 265, asking what positions I was going to be disallowing and the reason for that. So that is the list that I have in front of me for this schedule.
All right, and then did you add positions back in?
Yes.
Okay. Can you tell me a little bit why you added those positions back in?
At the time of our initial filing, our direct filing, we did not have job descriptions or a list of duties associated with job titles. And so we excluded some job titles that were labeled and classified as business development by the company. So when we received their response to our DR requests, 243 and 243.1, we had an opportunity to re-review based on their information, and that is what those add-ins, add-back-ins were based on.
All right, thank you. And I do have one more question. Okay. And please tell me if I'm wrong, but do the corrected accounting schedules filed on February 18th reflect the changes discussed in cross-rebuttal?
Yes.
Okay. Thank you.
All right. All right, thank you, Ms. LeMay, for your testimony. You're free to go.
Thank you, Judge.
Mr. Kleiser, I've got a question for you. As I look at this hearing schedule, I don't see another day when Ms. Shaban is scheduled to testify. Is that correct?
I think that might be right, yes.
All right. So do we need to take her out of order in case Ms. Niemeyer's testimony goes long?
Unless Ms. Shaban taps me on the shoulder here imminently, I don't think that there's a problem with taking her up next week, as long as we're not trying to push things until tomorrow, because tomorrow will be incredibly busy.
Okay. Yeah. But is she willing to stay late tonight? All right. Then, staff, if you'll go ahead and call your next witness then.
Thank you, Judge. Staff calls Angela Niemeyer.
All right, Ms. Niemeyer, would you raise your right hand, please? Thank you. Do you swear or affirm that the testimony you give in this hearing shall be the truth, the whole truth, and nothing but the truth?
Yes, I do.
All right, perfect. Thank you.
Could you please state your name and spell your last name for the record?
Yeah, my name is Angela Niemeyer. ANGELANIEMEIER.
Thank you. And by whom are you employed and in what capacity?
I'm employed by the Missouri Public Service. Commission. As a lead senior utility regulatory auditor.
All right, thank you, Ms. Niemeyer. And have you prepared or caused to be prepared testimony in this proceeding marked as Exhibit 210, public and confidential, direct and rebuttal testimony marked as Exhibit 210, public and confidential, and cross-rebuttal and sur-rebuttal testimony, which has been marked as Exhibit 223?
Yes.
And do you have any changes or corrections to that testimony?
No.
And if I were to ask you the same questions contained in those documents today, would your answers be the same or substantially similar?
Yes.
And are those same answers true and correct to the best of your knowledge and belief?
Yes.
Judge, at this time, I would offer Exhibits 210, public and confidential, and 223 into evidence and tender the witness for cross.
All right. Are there any objection to the admission of those exhibits? Hearing none, Exhibit 210 and 223 are admitted. And any cross-examination by the company?
No questions.
Public counsel?
Yes, briefly. Good evening, Ms. Niemeyer. You are responsible for providing testimony on the incentive compensation program as staff's position on it, correct?
Yes.
And to verify, staff's position is to remove 50% of the APP for non-union employees and the entirety of the LTPP, and then maintain 100% of it for union employees. Is that accurate?
Can you say that again?
Yeah, I'll try and do it slower. The staff position was to remove 50% of the APP for non-union employees. Let's break it down. Was that part correct?
Yes.
And then remove 100% of the LTPP,
Yes.
and allow 100% for the union employees for the APP. Is that accurate?
Yes.
Okay, so my question is simply this. With regard to the union employees, staff's position, it was premised on its interpretation of the statute that would, in staff's opinion, require those costs to be included. Is that accurate?
Judge, I'm going to object to the extent that Mr. Kleiser is asking Ms. Niemeyer for a legal determination.
I would actually like to make sure this is very clear. I'm not asking her for a legal determination. What I want to know specifically is whether staff's decision was premised on that statute. Moreover, to the point, I actually disagree with the position taken by staff in interpreting the statute. I just need to make sure it's clear that that's what's driving their decision.
I think I'll allow that. You can answer the question.
Yes, but I would like to know exactly which statute he's asking.
Do you have it off the top of your head?
Yes.
Go for it.
386-3151.
Right. And so my question then is, in the absence of that statute, would staff have taken a different position?
Yes, I believe so.
All right. No further questions. Thank you, Your Honor.
All right. Is there any other cross-examination? All right. Seeing none. Do the commissioners have any questions? All right. And I don't have any questions myself, so you're free to go.
Okay.
Could you be done in 5 minutes, Mr. Kleiser? All right, Ms. Shaban, would you retake the stand? Go ahead, Mr. Kleiser.
Ms. Shaban's testimony has been offered and admitted, and I therefore tender the witness.
All right. Mr. Kaufman, any questions?
No questions, Your Honor.
How about on behalf of the staff?
I have no questions, Judge.
All right. And on behalf of the company?
Yes, Your Honor. Ms. Shaben, in your cross-rebuttal testimony, you discussed this section 386.315.1 that was just mentioned, don't you?
Can you tell me what page? Yeah.
Sure. On pages 3 to 4 and starting, about line 13, I believe, on page 3.
Uh, 13 on page 3. Oh, yes, I see it.
And you then go on to essentially opine as to the meaning of that statute, don't you?
My opinion on the statute is that it doesn't say who should pay. It doesn't specify whether ratepayers or shareholders should be responsible. That's about the extent of my opining.
Okay. Still on page 3, lines 18 through 20, you've got, starting with commission shall, you've got quote marks there, and that's a portion of that statute, isn't it?
That is a portion, yes.
Okay. And the part that is also in the statute that you didn't quote actually comes at the beginning of that section and says, in establishing public utility rates, comma, the commission shall, correct? That would be a full reading of the statute.
Oh, actually, I have a copy of it. In establishing public utility rates, the commission shall not reduce or otherwise change.
Okay.
Rate.
So would you agree with me that the statutory provision is related specifically to the establishment of public utility rates?
I am going to object to her legal interpretation of that part.
Guess my response is that her testimony already opines as to the meaning of this statute, so.
I'll overrule the objection. You can answer the question.
Okay. Well, in reading the statute, what it says to me is that the commission shall not change the rate, which they wouldn't be, because that's already defined in the union contract.
But it also, it limits it to establishing public utility rates, correct? I mean, there's no ignoring that that's at the beginning of that statute, correct?
Yeah, I'm going to again object. The statute reads for itself. The point he's trying to make can be made in the briefing.
I'll sustain that objection.
Well, let's try this then. Other than how costs associated with these collective bargaining agreements are reflected in public utility rates, to your knowledge, does the Missouri Public Service Commission have any authority or jurisdiction over a collective bargaining agreement?
No.
Okay. Now, also in your cross-rebuttal testimony, you state Illinois and Iowa have both removed incentive compensation from revenue requirement for both union and non-union workers, correct?
Where's that?
Page 5, lines 10 to 11.
In reference to the EPS portion, the financially based EPS, the 50%.
And only that 50%,
Only
correct?
that 50%, yes.
Right. But you also make the distinction between union and non-union workers, correct?
Yes.
And would you agree that Illinois and Iowa do not have a statute similar to 386, 315.1?
I mean, I'm not actually sure, but
So you just don't know?
no, I don't.
Okay. And is it also your understanding that West Virginia American, Indiana American, Pennsylvania American, and Virginia American Water Company all receive recovery of 100% of performance pay and rates for both union and non-union employees?
Oh, those are the only American Water affiliates that do allow full compensation. The other ones do not.
But for those, it's 100%, correct?
For those, it's 100%, but
That's all,
not for all the others.
that's all the questions I have, Your Honor.
Okay. Any questions from the commissioners? All right, I don't have any questions, so you're free to go. 2 minutes over. Oh, I'm sorry. I was trying to help you out. I was trying to get you under the wire. Okay, then you are free to go, and that was the last witness scheduled for today, correct? So we'll adjourn the hearing for today and go off the record.
Yeah, I think so.
Since we're off the record, can we do